All right, it's 9 o'clock here in New York City on this Wednesday, November the 18th. I'm Miles Ludland here with Yahoo Finance Live. I'm joined, of course, by Yahoo Finance's Julie Hyman, as well as Brian Sazi. Let's take a look at where futures are trading right now as we get set for the opening bell on Wall Street. All three majors are higher on the back of that exciting vaccine news we got this morning, as well as some strong results out of retailers. We're going to get to all of that in just a bit. But Boeing looking set to fly. The FAA clearing the 737 MAX this morning after a 20-month grounding of the jet. Alexis Keenan will join us in just a few minutes for the latest on that. But earlier this morning, Pfizer saying that its COVID-19 vaccine is 95% effective. Of course, joining Moderna, their news from Monday that their vaccine candidate 94% effective. This news coming as COVID cases continue to surge across the U.S., hospitalizations at a record high. So let's begin with the state of the pandemic right now. For more on that conversation, we're joined by Dr. Celine Gounder. She's a clinical assistant professor of medicine and infectious diseases at the NYU School of Medicine and Bellevue Hospital. She's the host and producer of American Diagnosis and Epidemic podcast. She is also a member of President-elect Joe Biden's COVID Advisory Board. And Dr. Gounder, thank you so much for joining the program this morning. Let's begin with that news that we got out of Pfizer. We now have two vaccine candidates essentially at the same level of efficacy, 94.5%, 95%. As you think about that news and what it means for the pandemic into 2021, how encouraged are you by this? Is this perhaps surprising any expectations you had for vaccine development earlier this year?
Well, I think to have two vaccines, not just one, that seem to be this effective is really quite promising. And I think should be seen as light at the end of the tunnel. The fact is, though, that tunnel, we still have a ways to go. We still need to double down on things like mask wearing, social distancing, trying to spend as much time outdoors if we're around other people, getting tested, and working with contact tracers if they reach out to you to help identify sources of transmission. So all of those things we really do need to keep doing. The vaccines will not be available to the general public until April or May. But the way I think about that is if you do each of those things, the mask wearing and so on, you are very concretely saving lives during that time, because once the vaccine gets out there, those are all lives your actions will have those actions you've taken will have saved in the interim. So I think it's really important to understand that we still have a little ways to go.
Dr. Gounder, Anjali here. Looking at what Operation Warp Speed has accomplished just in terms of elevating the development of the vaccines, is there any thought as to continuing it, or what elements you might change of it or advise to change of it as it stands right now?
It's really impossible to answer that question until the GSA goes through ascertainment, certifies that we can move forward with the transition, because we're not being allowed to have those conversations with career officials who have access to data that we simply do not have access to right now. We simply do not have details of what some of those negotiations and relationships with pharmaceutical companies have been. So we can't really assess how things are working well or not, and what we would change until there is more of a transition.
Dr. Gounder, let's talk more about that lack of communication over the transition. What exactly are the attempts that the team has made, and what have you heard back from the administration, or is it just sort of a silent treatment? I mean, give us some insight into what exactly is going on.
Well, we as a team are moving forward with our own plans while we, as you call it, get the silent treatment from the administration. So we are a very seasoned team in terms of government experience. The president-elect has had over 4 decades of experience in federal government and policymaking. And you have people like Ron Klain, who's worked in multiple different White Houses, who has the experience of being the Ebola White House coordinator under President Obama. So these are people who understand how institutions function, how agencies interface with one another. So that is a big part of the job, is just understanding the mechanics of how government works. And then in addition to that, we are moving forward with our own plans based on publicly available data. And we're moving forward with conversations with other stakeholders. So that may include transition team members speaking with governors, other state and local officials, including public health officials, and conversations with the private sector.
And in the interim, of course, before President-elect Joe Biden takes office on January 20th, presumably we will have a similar trajectory in terms of public policy. Doesn't seem like anything's changing on that front. And as every health expert who has come on the program has reminded folks, we need to wear masks, we need to wash our hands, we need to have social distancing. And yet, as I've been asking most folks, it doesn't appear that people are doing that. And so, or at least not doing it in high enough numbers to prevent the upward trajectory that we have seen. So, given the facts on the ground right now, what does one do from a public health perspective to deal with the crisis at hand, given that people don't seem to be following directives?
Well, I do think it's important, actually, if you look at the data, survey data on what Americans are doing, they are actually getting better at mask wearing. They're not perfect about it. They're not doing it all the time. You still have a vocal minority that's very opposed to wearing masks. But over 90% of Americans are wearing masks at least some of the time now. So that is definitely progress. And I think we really have to keep doubling down on our messaging about that. About the mask wearing, the social distancing. We really need to be communicating about the risk of the holidays being super spreader events and trying to figure out how we can celebrate these things safely. Maybe Thanksgiving this year is not sitting around a table indoors. Maybe it's an outdoor hike and picnic. So really trying to be creative about how we can do these things safely.
Doctor, there's been a lot of concern in our world of business and finance on the economic fallout if there is a national lockdown. Do you support a national lockdown? And if not, what would you recommend to President-elect Joe Biden do in his first 100 days to get this situation under control as we start distributing these vaccines?
A national lockdown or shutdown is simply not on the table. The president-elect has no intention of implementing a national lockdown. There may be some differences of opinion on the advisory board, but the consensus on the advisory board is also that we do not need a national lockdown is not indicated here. We have learned a lot since the spring. I think lockdowns are sort of coronavirus control 1.0. It's a bit like an on and off light switch. And we are now in coronavirus control 2.0. Think of it like a dimmer switch, where we can be a lot more targeted in what we do. I'll give you a couple examples of that. In New York City, when we had a surge in cases a couple months ago now, we were able to target based on zip code, and we massively ramped up testing and contact tracing in those areas. And that was successful in quelling transmission in those areas. Earlier this week, Governor Whitmer announced new restrictions in Michigan, but that is not a lockdown. She's saying for older students, for example, in high school and college, they need to go back to virtual learning. Younger students in elementary schools, so long as the schools can implement other safety measures like the mask wearing, the reducing class size, the ventilation, elementary school students can stay in school. Gyms, group classes, not a good idea, but individual workouts at the gym, if people can stand apart, be socially distanced within the gym, wearing masks, having good ventilation in the gym, that can continue. So we're really, based on what we've learned about the transmission, targeting our interventions much more specifically.
Dr. Gauner, I wonder from your perspective, as someone who's part of the medical community, we've seen a lot of mistrust build up with federal agencies like the FDA, and they're trying hard now to sort of assuage a little bit of that when it comes to the emergency use authorization of the vaccines. Any thoughts right now about the previous rushes to approve things such as remdesivir and what we can expect going forward if there's anything to address there?
Well, I think with the vaccines, what you're seeing is a return to business as usual in terms of the FDA approval process. Many of us in the medical and scientific community, including myself, have been outspoken about this, putting pressure on not just the FDA, but also pharmaceutical companies like Pfizer to abide by what are norms in terms of the scientific approvals of the vaccine. And I think that is what you're seeing. And I am confident that once these do get an emergency use authorization, that will be truly an indication of safety and efficacy. We will continue to collect data on these vaccines even afterwards, because that's still not a full approval. And these vaccines will still need to go through the full approval process. And so we'll still be monitoring to make sure that there are not any issues that have not been detected thus far.
All right, Dr. Celine Gounder, member on President-elect Joe Biden's COVID task force. Dr. Gounder, thank you so much for joining the program today. Hopefully we can be in touch soon.
Absolutely. My pleasure.
All right, some big news coming out of the aerospace industry earlier this morning. The FAA approving Boeing's 737 MAX jet to fly again, this coming after a 20-month grounding following those crashes back in late 2018 and then in March of 2019. Southwest just in the last couple of minutes saying that they expect to fly their 737 MAXs by the second quarter of 2021. Yahoo Finance's Alexis Keenan joins us now with the latest on this news. And Alexis, certainly a day that Boeing officials were long waiting for, perhaps a year or more longer than they expected. I guess what does this kind of mean for getting that jet actually in the air, considering the state of the airline industry and also, I think, rightly consumer concerns about getting back on this plane?
Absolutely, Miles. And those are all part of a really complex set of facts that Boeing is going to have to work with. The airline industry obviously taking huge hits, travel industry altogether. Now, what this FAA rescinding of their order means today is that they're really authorizing the 737 MAX to resume those passenger flights. It also opens up Boeing's ability to deliver planes that are on order and still in their possession. Now, essentially, this order says the planes are safe to fly again, pending a few things that they are asking Boeing to still complete. First, it must install that new software on all of the aircraft. And also, pilot training is a big deal here, and that does take a lot of time. Pilots might need to get into simulators. Boeing has recommended that. That's a longer path than a pilot simply looking at perhaps a computer program to learn how to refly this plane. Also, they're going to have to fix a wiring issue that was separate from the problems that brought down those planes. And also, they're going to have to do kind of a de-preserving of the aircraft because they've been sitting there idle for so long, whether they're in Boeing's possessions or whether they're in the possession already of some of the airlines. Now, right now, Boeing has an oversupply of those planes. And recently, they have said that even hundreds of its remaining about 4,000 aircraft that are on order are in jeopardy. About 10% of the buyers in 2020 alone canceled their aircraft orders for the MAX. Now, for Boeing's part and its CEO, David Calhoun, of course, who was not CEO at the time that these planes went down, he said this: "We will never forget the 346 victims." He also said that the company will honor them by holding close the hard lessons learned from this chapter in its history. He said some of those things that they're going to be implementing to do that include new safety practices at the company and also cultural changes within the corporation. Though that's not, of course, enough for some of the families of the victims. We heard earlier from Ralph Nader, who put out a written statement. His niece was killed on that Ethiopian air crash, and he said that it was really a warning to Boeing, saying that, look, if there's anything left to disclose about your decisions with regard to building and putting these planes up in the air, that it will come out. Miles?
All right, certainly a significant day for Boeing, but as you outlined, Alexis, the beginning of a long process to get this plane back to where they had expected it to be back when they announced it several years ago. All right, Yahoo Finance's Alexis Keenan with that. Let's turn now to the retail space. Of course, this week we've got major retailers. Yesterday we saw Home Depot, Walmart out with their results. And this morning, Brian Sazzi, Target coming out with another big quarter and showing how the biggest retailers, and this is a theme across the economy, the bigger getting bigger, and Target no different here.
Again, another quarter from Target, Miles, that I have never seen before in retail. Target is not an upstart company. They operate over 1,900 stores. They were founded in 1962. Target isn't some new phenomenon in the retail scene, but they were a phenomenon in the third quarter. Overall comparable store sales up 20.7%. online sales up 155%. For a little perspective here, Walmart US had a good gain in third quarter online of 79%. So Target did almost 2 times as that. Really, the strength by category, electronics up 50%, the home category up 20%. Clearly, a lot of consumers continue to invest in their homes. And I asked Target Chairman and CEO Brian Cornell about the resilience in the consumer on a conference call last night. And I do think he was perhaps a little surprised that given all the unemployment in the country and given the pandemic, people are spending this much. But all in all, he says the company's doing a lot right, and that's why they're shopping with Target.
And I guess that's why the shares, I think, are at a record in today's session, Brian Sozzi. What's also interesting to me is the market share that Target is taking. So this sales boost is not coming from nowhere. It's coming from competitors, it looks like, because the company said it gained market share across its core categories. It won $6 billion in market share year to date, and it cited internal data and market research it's done for that. So I guess the question is, where's it coming from? I mean, as we well know, Brian Sozzi, the department stores have been going down, and it does seem like increasingly, yes, this is a trend that's been going on for a long time, but more and more people are going to department stores, and maybe they're buying some of that stuff at places like Target, whether it's clothing or electronics, which I know saw big gains in the quarter. So it's interesting that it represents not just because of the pandemic, but as we've said about everything, exacerbated and accelerated by the pandemic, a fundamental change in consumer shopping habits.
That's right, Julie. A lot of these stores, department stores, hundreds of department stores have closed across the country. If you no longer have a department store in your town, where are you going to get a pair of Levi's jeans? You're going to Target.
Or even if you do still have one.
Yeah, look, Target, really nice store. Walmart, really nice store. I think these are all more pleasant experiences.
Macy's kind of dumpy. Let's just be real.
Macy's not as good. Sozzi, very quickly, let's talk about Lowe's. Yesterday, we saw a big quarter at a Home Depot, and Lowe's continuing that trend in the home improvement space.
Yeah, Lowe's is another one. Miles, really, I just have never seen quarters like this in retail. Same-store sales for Lowe's up 30.1%. Their .com business up 106%. These are abnormal numbers, but again, really reflects consumers staying at home more, investing in their homes. And look, we just talked to PPG CEO Michael McGarry last week. They're seeing strong paint sales, so that trend remains very much intact.
Yeah, the DIY business for both Lowe's and Home Depot continue to be strong, even as we get into the winter months when folks don't typically embark on these kinds of projects, though I suppose indoor painting is friendly for the winter months here in the Northeast. All right, coming up on the other side of the break, we're going to have more here as we watch the markets heading towards the open on this Wednesday morning. Julian Emanuel of BTIG will join us for a conversation coming up right after this.
This is Yahoo Finance Live. I'm Julie Hyman. We've got futures pointing to a mixed open now this morning. NASDAQ futures have slipped slightly into the red. We'll see where they open up in about 10 minutes from now. Dow and S&P futures still pointing to a higher open. We, of course, got more vaccine news this morning with Pfizer coming out with more full results of their vaccine trial. And it looks like markets, by and large, are reacting positively to that. Let's bring in Julian Emanuel. He is BTIG Managing Director and Chief Equity Derivatives Strategist. Good to see you, Julian. So as we weigh that possibility of a vaccine coming, as you pointed out in a recent note, it's not going to be coming for some time. It won't be given out to the population in full for quite some time. And we still really need stimulus. And before January 20th, are we going to get stimulus before January 20th? And if we don't, what are the markets going to do?
Well, Julie, it feels like it's, I don't know, maybe 50-50 that we get stimulus before January 20th. And if we do, it's likely to be sub $1 trillion, which frankly, I mean, obviously everything helps at this point, but really is not going to be sufficient to prevent entirely this sort of economic scarring that Fed Chair Powell has talked about so frequently in the last couple months, you know, to where local businesses, Small Business USA won't have enough funds to tide them over till the point where we get the vaccine and they end up closing. And that's really something that we don't think the markets are fully prepared for, because that combination of events, along with the restrictions we're seeing across the country because of the virus's proliferation, could cause us to slip into, close to no growth or maybe negative growth again in the first quarter. Stocks are not ready for that, despite the fact that the vaccine gives us hope for a longer term positive outlook.
Julian, when you talk to clients, how concerned are they about incoming President Joe Biden installing a national lockdown and the economic fallout from that? We just had on a key COVID-19 advisor to President-elect Joe Biden. She downplayed. She said there will not be any national lockdown. But do you believe those comments? And what are you hearing from clients?
Well, I think, President-elect Biden has been very consistent in his messaging, whether it's, this idea that he doesn't intend to rip up the Affordable Care Act, just improve it at the margins, or it's something like thinking about the virus itself. The only issue that we have, and we take him at his word, as I say, that he's likely not to implement a national lockdown, is, we just don't know what the virus trajectory is going to look like by January 20th. So, we would say at the margin that that's not going to be the case. And in fact, what you're seeing is governors and mayors across the country are being proactive about doing what they need to do, because they don't want a situation where there needs to be a lockdown on January 20th.
And Julian, thinking about the kind of the strange period we find ourselves in, right? We have a very serious present situation as it relates to the virus, and yet the market right now quite bulled up on what's going to happen in 2021, given the news we've seen over the last couple of weeks. As you look out to 2021, are there going to still be upside surprises once we get there, or are we discounting all of them today? Because that's the habit folks learned back from the spring. You were rewarded for betting that things would be better in the future. Are there still surprises left as we get to next year?
Well, we do think there will be surprises left. And because essentially, if you think about it, there's a lot of cash on the sidelines. Money market balances are at all-time highs. Interest rates on the long end, yes, they've been creeping up, but they're still, very low by historical standards. And what we've seen this entire year is an entire generation of new investors coming into the markets, buying equities, with thinking about a 30 and 40-year investment horizon, knowing that with yields where they are, you have to increase your allocation to equities. So we do think there are surprises. But again, what we've seen over the last really 3 years is that in order to get to the long term, it's a series of often very volatile short terms. We've seen that numerous times in 2020, both to the downside and the upside. And our view here is that if the virus continues to proliferate and we don't get, proactive about it and we don't get stimulus out to those who needs it, that there will be potentially one of those sort of volatile periods straight in front of us.
Yeah, 2020 has taught us there are always surprises, some larger than others. Julie and Emmanuel, stay with us. We're going to be right back in a few moments with the opening bell and with some more commentary from Julian, who's BTIG Managing Director and Chief Equity and Derivatives Strategist. Futures, as I mentioned, are mixed. We'll be right back with the opening bell.
All right, welcome back to Yahoo Finance Live. We're just over 2 minutes away from the opening bell here on this Wednesday morning. But let's take a look at an asset that's been on the move in major fashion over the last couple of weeks, and that's Bitcoin. Starting to feel a little bit like 2017 around here. Bitcoin back above 18,000. A lot of dunking on the timeline these days. Everyone is very pleased with themselves for having stuck through the dark times with Bitcoin. You see it here on the screen. I'm even hearing noise about the altcoins, Brian Sazi. Ethereum holders are congratulating themselves as well. Bitcoin's market cap, we should note, is at a record, though the price is not at a record because there are more Bitcoins now than there were 3 years ago. But just a thing that's out there. Animal spirits, Brian.
Miles, Tom Lee, he's still looking for Bitcoin 100,000. Can you confirm that?
I cannot confirm that, but I know it had been thrown out there.
Okay.
We'll see if it can maintain. As we know, Bitcoin can get toppy and then bad things happen. We'll see what happens. Jared Blickery sharing in our Slack some elevated forecasts for Bitcoin. Just wanted to mention, I'm watching Tesla. Speaking of elevated, I'm watching Tesla this morning. A long time neutral or skeptic of the stock is upgrading it. It's Adam Jonas over at Morgan Stanley, an overweight rating on Tesla for the first time in more than 3 years. He says that Tesla is on the verge of a profound model shift from not just selling cars to really being more of a software and services model. We'll see if it materializes, but his price target is now at $540 a share. Of course, this coming on the heels of the company's announcement, or the S&P's announcement, that it is putting Tesla into the S&P 500 next month. Also, I know moving this morning, Sazi, retail.
That's right, Julie. Let me get beneath some of these headlines in retail, because now you're starting to see retailers open up their checkbooks and give money away again to shareholders. You have Target saying it's going to restart its $4.5 billion. There you have the stock market open there on Wall Street. You have Target saying it's going to give $4.5 billion away in stock buybacks next year to shareholders. Walmart bought back nearly $500 million in stock last year. And yet TJ Maxx say this morning in its earnings report, it's going to reinstate its dividend. Kohl's also signaled it may pay a dividend as well soon as well.
And, Sazi, that's a great point. I wanted to bring up the Target news because that stuck out to me in their release. They're resuming their share repurchase program. I think investors maybe forgot a little bit how much shareholder return in a lot of cases was put on pause, considering what happened in the first and the second quarter. And it's not a factor in investing we talk about too much, but if you're a very large investor with a very large position in a lot of different stocks, getting the dividend matters. Having repurchases matter. So at Costco with a special dividend coming out, what was that, on Monday afternoon they announced or maybe yesterday morning, $10 per share special dividend. Those kinds of things do move the needle as it relates to these big institutions who really move the market. And so I think that's a very salient point there as we get towards a more normalized situation perhaps in 2021. All right, let's go to Jared Blicker now for a look at how things are shaking out as we get today's trading underway. Mixed market, not a whole lot going on the headline indexes. Jared, I would actually love to start talking about Bitcoin with you because I know it's something you've looked at quite closely, and the technical setup for Bitcoin played out beautifully over the last couple of years. You were talking about some kind of declining triangle pattern that absolutely served as the kind of marker of when we saw prices rise and stay higher.
Yeah, Miles, if you go back a few years and we can look at the Wi-Fi Interactive, this is a candlestick chart of Bitcoin. And we've been tracking this negative trend line for probably a year. Finally broke out several months ago, and it's just been off to the races ever since. And you look at a year-to-date chart, pretty stunning. We sunk all the way down to 4,000. Now we're back up to 17,875, 20,000. I'm going to go back to that 5-year chart. 20,000 or thereabouts is that high. But, I talked to Yves Lamoureux, the Canadian whale. He's been one of the best Bitcoin timers I've met, and he was getting in at 10,000. And he just said, it's too frothy. I'm seeing the same signals I saw in late 2017. He still has higher targets in the coming years, but just backing off a little bit right now.
All right, so we see Bitcoin there on the move. Jared, just very quickly give us an overview of where we stand in today's market. Again, it's been an interesting week, been an interesting couple of weeks. Today's open a bit more muted than what we've seen.
Yeah, muted today for sure, low volatility, but we're heading in the right direction overall. We don't have the participation of the big guys every day. That would be on the left side of your screen. But we can see a mixed market. So if the market can just go up and not have Apple sink 5% in one day, I think we have the makings of a rally. Stocks want to go up here. Do we have headwinds? Yes. But let's take a look. Apple's down about 2/3%. Tesla's up 1%. Action is in the Dow, although it's only up about 11 basis points right now. But Boeing is a big standout, 737, returning to the skies. Southwest saying that it could happen in the second quarter. And then industrials faring overall well. Here's the sector leadership. Got industrials, financials, and energy all in the lead here.
All right, Jared Blicker with a look at where things stand as today's trading gets underway. And we are still joined by Julian Emanuel. He's the Chief Equity and Derivatives Strategist over at BTIG. Julian, we talked in the last segment a bit broadly about, kind of how you're thinking about the setup right now, things to look out for in 2021. What are some areas of the market right now that you like, some areas you don't? And is this kind of rotational trade that has really become the topic du jour on Wall Street? Is that something that interests you with, small caps, financials, just a classic cyclical type rally?
We do think there is a great deal to be said about this rotational trade. If you look at it, if you look at 2020 in its entirety, you look at the things that led to the downside during, the height of the panic in February and March. Those were small caps. Those were financials, energy, all of the deep cyclical things, correctly discounting the imminent recession that we had. But the work that we did in getting more positive on the markets in April shows that sustained bull markets, by definition, need to see a period of outperformance from those very stocks that were laggards. And what we've seen over the course of the year, particularly zeroing in on the fact that the NASDAQ 100 made its top on September the 2nd, And if you look at the last week and a half, it's the only major index in the US that hasn't made a new all-time high. There's information there. And the information is that the market is looking forward to a resumption of more normalized growth. It may be delayed until the second half of next year, but the fact that we've got this, incredibly great news in terms of multiple vaccine efficacies that we know has a finite endpoint to the situation we're in means that the confidence in investing in these deeply cyclical names with very depressed valuations and the potential for extremely large earning gains next year really is something that, the rotation is likely to continue.
Julian, do you think 2021 will be all about the big growth stock hangover? I look at a company like Lowe's out this morning, sales up over 30%. You look at quarters from Zoom recently, a company like DocuSign. How are their growth rates going to look any better next year as we start to get back to work? The reality is they won't. So should the stocks come under pressure?
Well, look, relatively speaking, they are likely to come under pressure as this rotation occurs. In an absolute sense, because of the backdrop of liquidity and the Fed and the potential for earnings growth in general to resume, they're not going to have negative year-on-year comps in all likelihood. They'll grow at a more modest rate. And so what we could potentially see is things that we've seen in the FANG names. If you look back over the course of the last 7-8 years, everyone remembers that these stocks were up 500, 600, 700%. But there are multiple periods of a year, 2 years where they go sideways. They're market performers. They're slightly underperformers. We think that's more likely the scenario. So for patient long-term investors, those names still make sense. But are you going to be rewarded in the near term? Likely not.
All right, Julian Emanuel is the Chief Equity and Derivatives Strategist over at BTIG. Julian, great to have you on the program this morning. Hopefully we'll have you back soon.
Great to be with you.
All right, coming up, we're going to have more here on Yahoo Finance Live. We're back in just 2 minutes.
A tepid rally in stocks here in the United States. We are seeing a little bit more of a lift in European stocks. Tom Belger is over in the UK to give us the very latest, even though, like here, the COVID numbers do not look good in Europe.
Yeah, for sure. We did get a slight vaccine boost to stocks, as you say, in Europe from Pfizer's latest update. Nowhere near the kind of gains we saw on Monday. Last Monday, though, it's a similar picture to some extent to the US. FTSE, the DAX, CAC, all trading up less than 0.5% today. Analysts say investors really are focusing more on just how quickly some of these vaccines could be game-changing, focusing more, probably similarly to the US as well, on the short-term picture in Europe. And it looks pretty bleak for a lot of firms here. We've seen Reuters having its reporting globally even, daily death toll hitting a record high. But in Europe specifically, a lot of countries are now tightening restrictions. Germany, Britain, both considering doing that. Sweden's done that. And while we have seen, as you say, declines yesterday in European markets, it's worth saying it's not a serious pullback. FTSE is still up 14% this month. And really, it's remarkable when England's going to face another lockdown to see those kind of gains. Over to you.
All right, Tom Belger, thank you very much. Appreciate it. When we come back, we'll be talking about the transition to President-elect Joe Biden and what an administration, what a cabinet might look like under Joe Biden. We'll be speaking with Larry Summers in just a few moments.
All right, welcome back to Yahoo Finance Live. Miles Upton here in New York. We're about 15 minutes into today's trading session. Let's take a quick look at where things stand on this Wednesday morning. We've got all three majors higher in the early going, though no huge moves here among the major headline indexes. Do want to look at financials. We see bank stocks moving higher. Once again, KBW Bank Index is up better than 1%. Citigroup, the big mover there, that stock is up nearly 3% today. We also see Wells Fargo shares up more than 2.5%. The regionals are up about 0.5%. And so that rotational trade, we were just discussing it with Julian Emanuel of BTIG, continues to be a big theme within this market. And we continue to have strategists on this program talking about a bull market that may be just beginning. We've seen comparisons drawn to the 1982 beginning of that bull market, 2009, another year that is getting thrown out as an analog. Those are all years that long-term stock market investors certainly want to hear about. If we take a look at what's happening, S&P sectors here in the early going, we have 9 of the 11 sectors higher right now. Utilities and healthcare, the only two that are in the red. We mentioned financials, energy, also leading up about 0.5%. Industrials, consumer discretionary, also doing some work today. We talked about those strong results we got out of Target before the market opened. That stock is up nearly 3%. All right, coming up on the other side of this break, we're going to have a bit more here on Yahoo Finance Live. We're back in just 2 minutes. All right, welcome back to Yahoo Finance Live. Miles Udland here in New York. We are talking now about the transition between the Trump administration and the Biden administration, the future for monetary policy, fiscal policy here in the U.S. And few better guests to join us for that conversation than Larry Summers. He's the former Treasury Secretary, as well as former president of Harvard University, among other distinguished titles. And Larry, it's great to talk with you this morning. I'd love to begin our conversation with a piece that you wrote recently to the future incoming Treasury Secretary about the unique challenges that that office will face as the administration gets fleshed out here. And I'd love if you could just outline for our viewers some of the unique challenges that you see facing the next Treasury, again, as things come into focus here for the Biden administration.
My piece focused on the global economy and those aspects, but broadly the challenge is restoring reasonable economic growth and maintaining it in the post-COVID environment. I think it's going to be a very different environment than most of us grew up in. It's going to be an environment where there's going to be slow and sluggish growth of demand, where interest rates are going to be essentially on the floor. So there's not much that the Fed can do. It's going to be an environment where the issue is going to be more insufficient inflation than excessive inflation. It's going to be an environment where, because of the shortage of investment opportunity, there's going to be a tendency for savings to flow into purchasing existing assets and bid them up, leading to more leverage and more possibility of financial instability. So I think it's going to be a challenging environment. On the other hand, an environment of such low interest rates is an opportunity with historic opportunities to invest and earn very high returns. And so taking advantage of this high saving, low investment, low private investment opportunity to do really important public sector things is going to be a major challenge for the next Treasury Secretary.
And what about where growth in real assets and growth in the underlying economy is going to come from? I mean, what you're describing is something that has characterized the past, say, decade or so in terms of markets going up and investors benefiting from a low interest rate environment as rates have gone ever lower. But what about the underlying economy? What about the need for
those opportunities? There are millions of children under 5 who should be getting more education than they are in pre-K. There are huge opportunities for environmental investments that would have a huge payoff down the road in terms of averting climate change. We've got an infrastructure, both in terms of traditional things like roads with potholes, an air traffic control system that still uses vacuum tubes, and we've got more modern challenges like building out 5G. But government's going to have to be a catalyst if all that investment is going to take place. And it's going to be the job of a new Treasury Secretary to lead that strategic thrust of government towards the promotion of investment, which is both a demand side imperative and ultimately growing our economic potential as a country imperative.
Mr. Summers, in your view, how severe will the economic scarring be from the pandemic? And because that scarring, do you think some of these tax hikes that President-elect Joe Biden has proposed will be off the table?
I don't think that right now is the moment for tax hikes, but I think we need to put in place a satisfactory revenue system for our country. What I'd start working on now, my most important recommendation in the tax area, would be we could collect $1 trillion over the next decade at least from better enforcement on the $7 trillion that is owed but not paid, with most of that coming from the richest taxpayers. And so restoring audit rates to previous levels, having modern information technology, having reporting on all income flows, not just wage income. These are all things where we can do better. And this isn't a partisan view. Former IRS Commissioner Charles Rosati is advocating that, and he's actually rather more optimistic than I am. You're showing Joe Biden's tax plan. I don't think that's what's likely to be legislated in this political environment, and it's not what I'm talking about. So I'm not sure why you have that graphic.
Larry, to come back to the memo that you wrote to the future Treasury Secretary, I have to ask, were you envisioning anyone as you were writing that memo, picturing anyone in your mind?
Answer, get into questions like that.
No, you don't want to even say who. What would the qualities be of the person who should take us?
You were told that beforehand.
I wasn't, in fact, but I wouldn't be doing my job if I didn't ask it. All right, Miles, why don't you pick it up?
Yeah, Larry, I want to talk about, something you were touching on earlier. And of course, I think right now, going back to your secular stagnation thesis from some years back is quite an interesting frame in an environment where I think there's a major risk that too little is done probably on the fiscal side, particularly with the other side of the virus coming into focus. And you wrote about how fiscal policy is really in charge now, whereas monetary policy perhaps was more important in earlier cycles. And as you're thinking through that and talking to folks about this dynamic, is it maybe understated perhaps in policy circles how significant of a shift that really is?
I think certainly I believe so. I think that if the dominant concerns of economic policy between 1980 and 2010 were about yielding to the temptation to inflate, and were about running excessive deficits that crowded out valuable private investment. In today's world, where there's no investment that's being inhibited by excessive costs of capital, none at all, where product price inflation, the problem is that there's too little, and asset price inflation, the problem is that there's too much. That's a fundamentally different environment that requires fundamentally different solutions. I believe those are much more fiscal and structural solutions than they are monetary and liquidity solutions. And that's why I've advocated both more expansionary fiscal policy and a revision of norms about sustainable debt to reflect the fact that we've got these very low interest rates, and also measures like strengthening pay-as-you-go Social Security, measures like successfully promoting the redistribution of income that even without changing the budget deficit will expand the level of demand and push the economy forward. But I think there's no question that this is a very different period than we've had in the past, and it requires very different solutions.
Mr. Summers, how should the new Treasury Secretary, whoever that is, how should they go about rebuilding relations with foreign countries?
A lot of it's being there. A lot of it is diplomacy. A lot of it is showing a willingness to listen. A lot of it is being willing to meet our obligations to the U.S. international financial institutions in a more generous way than we have in the past. A lot of it is not blocking the initiatives of other countries. We should be for a major SDR allocation agreed at the spring meetings of the IMF and World Bank. We should be for an energetic program of involving other countries and especially involving private banks in appropriate debt write-offs for the poorest countries. We should be for a much more aggressive financial approach coming out of the World Bank and the other development banks. We should be for an enhanced, substantially enhanced cooperation in environmental lending. If we are prepared to join with the rest of the world on what it cares about, they will be more responsive to us on what we care about. Obviously, at the top of that agenda is rejoining the Paris Agreement and being an energetic participant in global environmental diplomacy.
And Larry, I'd love to conclude with a conversation that I think is certainly unique in fiscal policy or policy circles, but has come up recently, which is the discussion around student debt. We have seen several lawmakers talk about perhaps forgiving or canceling some amount of debt, and you're speaking quite a bit about demand side policies we can perhaps put in place. Have you thought about this idea? What kind of conversations have you had? Does it make any sense to you?
I think that there are clearly cases where relief is needed. There are clearly cases where it's not possible to restructure student debt, and it should be. I'd be rather skeptical of across the board massive student debt reduction programs, because I think many of those programs would benefit the well-off who made an investment in themselves or earning a high return on that investment. And fundamentally, I'm more worried about the Americans who don't go to college than the Americans who do. So I worry that unless it's done carefully, this could be upwards redistribution of income rather than downwards redistribution of income.
All right. Former Treasury Secretary Larry Summers. Larry, really appreciate you taking the time to speak with us this morning. I hope we could talk soon.
Thank you. Bye-bye.
All right. We'll have more here on Yahoo Finance Live right after this short break.
It is 10 a.m. in New York. This is Yahoo Finance Live. I'm Julie Hyman, along with Miles Udland and Brian Sazi. We have been watching stocks that have not been making big moves this morning, at least not on the overall index basis. We got some big moves underneath. Right now, the NASDAQ down slightly as the S&P and the Dow are on the rise here. A couple of things that we're watching include Pfizer, which says now its COVID vaccine is 95% effective as coronavirus cases and hospitalizations continue to surge across the United States. Also, Target's blowout quarter. The retailer cashes in as COVID-19 fuels demand and changes shopping habits pretty conclusively. Let us start with that and start with those Target numbers here this morning. The company said that its comparable sales were up by nearly 21%. A lot of that demand coming from online orders. Digital comparable sales up 155%, although comparable sales in the stores were no slouch either, up by almost 10%. Let's bring in Jerome Martis to talk about this. She is Refinitiv Director of Consumer Research. Jerome, this has just been, I mean, we already saw the numbers for Walmart, but Target's are even better in terms of magnitude here. There has been this combination during this pandemic of pandemic trends fueling an acceleration of things like online shopping, but then the retailers themselves, some of them have really risen to the challenge. What stands out for you about Target?
Well, today's numbers were really outstanding, not only for Target, but Lowe's also. Both of them posted triple-digit growth in digital sales. And this is pretty much in line with what we seen yesterday when the government reported October retail sales. When we look at the overall picture for 2020, e-commerce grew about 29.3% in the first half of the year. And this is expected to continue even further in the second half to about 43.6%, according to Refinitiv IFR. And when we look at the results yesterday, Walmart, Home Depot, today, Target, the conversation during the earnings call really seems to be that this trend is here to stay, especially because it offers consumers a fast, efficient, and safe contactless way of shopping. And it's very important because winter is here. There's another wave of coronavirus that is, threatening the consumer spending again. And so therefore the retailers that have a strong omni-channel presence are the ones that will continue to do well going forward. Because when you look at the overall retail sales pictures, earnings growth rates are expected to drop even further into the fourth quarter as a lot of the government stimulus programs will come to an end and the unemployment rate is still very high.
Sharon, Julie was talking about this at the top of the hour. Target put a stat in its earnings release that they gained $6 billion in market share. Where is that coming from?
It's coming from the department stores. The department stores have been struggling for some time, even before the coronavirus. But then because of the pandemic, this accelerated that shift in pace. Target has become a little bit more renowned and popular when it comes to their athleisure wear, for example. The department stores have been out of favor, especially when it comes to their fashion sense. But the fact that Target has been able to give consumers a more value-oriented line of athleisure in a time when a lot of consumers are using their house as a gym and a home office, and their health and wellness is such a big priority, and they're working out more and more at home, they're able to purchase a lot of the merchandise that's very similar to Nike and Lululemon for a significant lower price, while what is very key and what makes Target a big winner is the fact that consumers are doing consolidated trips. So while they're purchasing, the key essentials, groceries, and they're thinking, oh, you know what, I want to work out at home, they're also buying the weights and the athleisure merchandise that's stealing that fashion market share from the department stores. And that's been key for Target.
And, Jerome, on that point, Doug McMillan talked about this on the call yesterday, that the consolidation of trips, many of which begin online and then they're picked up in store, that's leading to that higher ticket price. And he thinks that's like a long-term behavior. And I think we can all find it ourselves. You buy something online, you're more inclined to buy a couple other things. You're maybe not quite as disciplined. Do you see the trend sticking around, this omni-channel that we've heard so much about? Seems like it's actually happening. And we seem to hear more executives arguing that it's not going to revert when the pandemic finally does come to an end, whenever that is.
Absolutely. The conversation around it has been that this is a trend here to stay. When we look at the forecast from Refinitiv, we're continuing to see that this is going to continue to grow into the second half of the year. But I think a clear point differentiation of how important e-commerce is when we look at today's results, when we compare to Lowe's and we compare to Target. Both of them posted triple-digit growth. But, Target has been investing in their e-commerce strategies for some time, and which helped them post an astronomical number of 155% growth. Lowe's also did well, posting triple-digit growth, but they're still catching up. They're still trying to get to the point of trying to steal a lot of that market share from Home Depot. Target, when you look at Target offers a wide variety when it comes to e-commerce service. They offer ship, drive up, pick up, which grew over 200% this quarter alone, which underlines the importance of having a very strong omni-channel and giving the consumer really a fast and efficient way of shopping, whether that is pick up in store, drive up, or have it shipped, because consumers want it now. And so when we say that this is a trend that will continue to stick, it's because now the consumer has been conditioned to know that they can rely on this service and do exactly what it does, offer them a safe, contactless, fast, and efficient way of delivering their product in front of their doorstep without having to be exposed to COVID.
Jerome, I don't know if that was audio from yours, but you timed it perfectly. The revving up of the cars. You're talking about people picking up from stores. Jerome Martis, thanks so much, Refinitiv Director of Consumer Research. Appreciate your insight. Thank you. Well, we have been watching the rotation in stocks broadly very carefully, kind of a little bit of rejiggering back and forth between growth and value having a bit of a moment. And so it is a perfect time to talk to Charlie Bobrinskoy. He is Ariel Investments Vice Chairman and Head of the Investment Group. Charlie, you're a value guy. And so I'm sure that you have been watching this trend very attentively as well. Value has been struggling over the past decade or so. Do you think that this is going to be a longer term shift in the market that's taking hold right now?
Well, it's important to emphasize that it's a return to the traditional shift, to the traditional relationship. Value has beaten growth consistently for more than 100 years since finance professors started tracking it. The statistic we would like to quote is that value has beaten growth for every rolling 10-year period since 1926, except for the last 10 years. And you're absolutely right. The last 10 years have been brutal for value. But we got to the point where value became so cheap relative to growth that we really did think some kind of reversal was almost undeniable. And we're seeing it. Since the end of the third quarter, since September 30th, the Russell 2000 Value Index is up 24% compared to 8% for the S&P 500. That's 1,600 basis points of outperformance.
And Charlie, when you look at what's happened in the market just this year, it seems like we've had several market cycles within the last 9 months, really. And I would ask how you think about the next decade, because you mentioned the decade we're coming off, that aberration where growth outperformed value, kind of based on the work you guys have done. Are you concerned at all that we've compressed perhaps an expected strong period of value into just a couple of months, given how fast things change in the modern market?
So that's a great question. We still think the valuation disparity is outsized. At the end of the third quarter, the S&P 500 was trading at 23 times forward, and the Russell 2000 value was trading at 13 times forward. That's a 10 multiple point gap, and that's one of the biggest gaps we've ever seen other than the year 2000. So now after this massive rally, we're still at 8-point differential. So we still think there's a lot of room for value to outperform. And what's going to happen over the next 10 years is that interest rates eventually will return to more normal levels. And when they do, that helps value, because value's earnings, a value company is making money today. A growth company is making money 10 years from now. So higher interest rates help value relative to growth. And frankly, we think it's dangerous what could happen to growth stocks if we get a return to normal interest rates, because that discount rate is going to bring those future earnings back almost like gravity. And it's going to really, in our opinion, affect growth stocks.
Charlie, aren't those higher interest rates still, though, at least a couple of years down the road? I mean, I know one of the other areas, one of the traditional value areas that you like is financials. You named a couple to us in a note: Goldman Sachs, Northern Trust. And while they're hanging on for those higher interest rates, the lower interest rates, especially for Northern Trust, which doesn't have the trading business to offset, that's not fantastic for their business.
Yeah. So we think interest rates can go higher faster than a lot of people think. I mean, I think the general perception, and I fall into this, is to think that interest rates have been at this incredibly low, below 1% 10-year forever. Back a mere 2.5 years ago, we had a 3% 10-year. It's in 2018. So if we get even a 3% 10-year again, we think that this effect will kick in. And the other thing I would mention is that inflation could come in a hurry. When you're running $3 trillion deficits, when you have the government talking about forgiving student loans, when you have the kind of infrastructure spending that people are talking about, you can get a lot of inflation in a hurry, particularly when the economy starts to heat up again, when we all go back to work. So I think we could get higher interest rates faster than people think.
And remember when we thought 3% was so low? Charlie, yeah. Great to see you. Thanks for joining us. Charlie Bobrinskoy of Ariel Investments. Appreciate it. Well, I want to take it to politics now because it seems as though, in the mind of President Trump, the election is still not settled. And yesterday, we learned, of course, via Twitter, that he had fired the top U.S. cybersecurity official, Christopher Krebs. Rick Newman has been following all of this and the implications of it. Rick, it seems to be done and dusted, and yet, how much of an obstacle are these delays in certifying election results ultimately going to have on the whole process?
I think they're going to have no effect on the whole process. I mean, we also saw this short eruption up in Michigan where a couple of Republicans on the county board tried to disallow a lot of the votes from Wayne County, which includes Detroit, but that didn't last after a huge uproar over that. Joe Biden won the election, and Chris Krebs, who you just referred to, he oversaw the cybersecurity of the election at the Department of Homeland Security. He convened election security experts, and they said this was the most secure election ever in the history of the United States. So that's why Chris Krebs got crosswise with President Trump, because President Trump, of course, is trying to spin a completely different narrative that he lost because of fraud. There has been essentially no fraud, no meaningful fraud. And actually, for all the uproar over all of this, it looks as if these votes are actually going to be certified more or less on time, as they should be. And we're going to have an electoral college outcome in mid-December, just as we're supposed to. Trump will not be in the White House after January 20th.
Well, Rick, I was going to ask about that timeline aspect of it, because I think it has gotten a little bit lost in all of the Sturm und Drang about each of these lawsuits and, blah, 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 blah. Like, there's a pretty standard process that we would usually ignore because it's like, oh, it's called and then that's it. And that process is not going to change. And that's basically 3 weeks from now.
Yeah, we're all getting a civics lesson here, Miles. And I will acknowledge I actually refreshed my own memory on how the Electoral College works. So the electors are equal to the number of members of Congress. So that's 535 plus 3. And they get together in mid-December and they certify the vote. So, I mean, Trump is actually correct about one thing. The media does not determine who wins the election. What the media does is forecast or project what the results are going to be based on the popular vote in all the states. And we know what the electoral vote is based on those votes. So this will all be official in mid-December when the Electoral College and all those electors actually get together, and then Congress certifies their decision, the outcome, in early January. So for everything that's going on, nothing Trump has tried has really worked here. I mean, these lawsuits are just failing one after the other because, remarkably, in this pandemic, with all the partisan hostility, election officials actually did a remarkable job.
Indeed, in localities across the country. Rick Newman, thank you so much. Appreciate it.
You guys.
Well, as we take a break, just want to mention what's going on with stocks here broadly. We are still seeing a bit of a mixed picture here today. The S&P up just slightly as the NASDAQ slides, the Dow, the leader here. And quick mention of what's going on with cruise lines. We don't have to show you, but I'll just mention we've got cruise lines lower today. Carnival Cruise Line said it is postponing or canceling embarkations from U.S. home ports January 1st to 31st. There had been the news a couple of weeks ago that they were going to start taking bookings for next year, but it looks like that is a setback. That's affecting it and the other cruise stocks today. All right, we'll be right back.
All right, welcome back to Yahoo Finance Live. If we have learned anything from the recent earnings out of the grocery store space, it's that consumers are stocking back up on essentials as the pandemic rages on. Let's bring in Albertsons CEO Vivek Sankaran to discuss. We're also joined by our very own Julia LaRoche. Vivek, good to speak with you here. What are you seeing right now in some of these stores that are surrounded by rising infection cases? We've talked to a lot of executives in the food space. Consumers appear to be back out there really hoarding goods like they were back at the start of the pandemic, and a lot of companies are seeing out of stocks.
Yeah, Brian, good morning. I wouldn't say it's back like about March, April. It's not that way. We were ready. We expected that consumers will shop differently when we got to the second wave. And, it coincides with Thanksgiving. So people are pulling up some of the Thanksgiving shopping. We are seeing consumers shopping a lot more of paper goods, cleaning supplies, disinfectants, the usual things. But we're not seeing yet the surge in shopping in other areas of the store. What we're seeing is people pulling up some of the Thanksgiving shopping to a week earlier. We're selling a lot more turkeys than we did at the same time last year. That's as expected, a lot more small turkeys. Because we think there'll be smaller gatherings. But I want to make sure people know that there's plenty of food. There's no reason to panic when it comes to the food supply.
Vivek, it's Julia LaRoche, and certainly good to hear that. And I was going to ask you what Thanksgiving might be looking like during COVID-19. So thank you so much for sharing that. I do want to dig in on just a broader conversation we were having earlier about omni-channel and this kind of secular trend that we are seeing within the grocery retail space. Would love to kind of understand what you all are seeing across your store footprint, and what are some of the trends that you think will persist going forward?
Yeah, Julia, good morning. The omni-channel, the pandemic has accelerated the trend, right? So I always imagined that omni-channel will get to 10% penetration in the market around 2025. I think that'll be pulled forward. And people started engaging in omni-channel as part of the pandemic, but now they're seeing the value in it for convenience. And we offer drive up and go, where you just pull up curbside and we bring it to your car. We offer deliveries. What we're excited about is that we're seeing new consumers coming to our franchise because of that. We're seeing existing consumers who engage in omni-channel spending more with us, which is really exciting because and they buy bigger baskets. They still come to the store and do that. We have a lot more headroom. So we are in 950 stores as of the end of last quarter. We'll get that to 1,800 stores in the next 12 to 18 months. So we see a lot of upside. We see that being a part of the repertoire of how consumers shop the store in the future. It'll just be how we do things every day.
Beck, I am very interested. You have, obviously, Albertsons has pharmacies in its stores. You play in the space. How are you preparing for a COVID-19 vaccine rollout?
Yeah, Brian, in our pharmacies, we have a history of immunizations. We provide that to all our customers, typically flu, shingles, and such. We are prepared. We've worked with all the state agencies to make sure we have the vaccines available because we are in certain markets. We have such a strong presence that we can be of great service to our customers. So we're ready, looking forward. It's been great news over the last few days. We just hope that gets to the markets pretty quickly.
Mm-hmm. Vivek, I want to go back to what you were just talking about earlier around omni-channel and some of the key points there. And of course, when I look at your most recent quarter, the second quarter is what you all reported, digital grew 243%. So I kind of want to ask you a bit of a strategy question here, because Albertsons has so many different brands. When it comes to executing on your digital strategy, how do you think about that? Is that more of a centralized process or a decentralized process where you try out different things at different brands and then can kind of iterate and scale across your footprint? Would love to kind of go inside that playbook.
Sure, Julia. It's a little bit of both. So let me start with what our brands stand for. So if you go to Dallas, Tom Thumb is a brand in Dallas. Many generations have shopped Tom Thumb. You go to Boston, it's Shaw's. Many generations have shopped Shaw's. And each of them have a little bit of a unique flavor that's totally adapted for that local market. And so we want the brands to stand on their own locally. But everything you see behind that brand, so the app says Tom Thumb, but the engine behind it is the same engine that you'll see at Shaw's, that you'll see at Jewel Osco, that you'll see at Safeway and Albertsons. So that's how we like this notion of being locally great and nationally strong. And we think there's value. It's very hard to be vanilla in grocery. You've got to adapt to local markets. And this approach allows us to do that.
Vivek, you've highlighted some initiatives on tap next year. I guess a customer could drive into your parking lot and they have those groceries delivered out to them, but also a lot more self-checkouts. Talk to us through some of those rollouts and how are they changing your business?
Yeah, Brian, when I think of a store, I think of three pieces to it, right? There is the right side of the store. It's the fresh product. It's the meats. It's the bakery, the smells, the visuals, the fruit and vegetables. I mean, it's an exciting part of the store. People shop that slowly, right? And they engage. Then you go up and down the aisles to pick up what are typical grocery items. And there you're going through a list. You're trying to shop that really fast. And then you get to the checkout. And at the checkout, we believe you should have one of two experiences. One, somebody says hi, you have a conversation, you enjoy that, or you don't remember anything about it because it was so smooth and convenient. That's what these self-checkouts do for us. And we have a scan and go approach now. We continue to innovate on that front because for a segment of the population, absolute speed and convenience matters at the checkout lane. And by the way, it's also a good labor productivity opportunity on the other side.
Let's talk about labor, Vivek, because you're just referencing, some of the changes that we'll see at the checkout. I know I can tell you this as a shopper, I love curbside, and I don't know if I'll go back to going in the store when I'm in the suburbs going forward. So how do you rethink your labor and the talent within the stores and within, I guess, your distribution network as well? How are you thinking about that going forward?
Oh, it's a great question, Julia. So first is we are thinking of applying a lot of technology to improve productivity in everything we do in a store and everything we do outside a store. So that's the overarching theme. And then when you think about what's happening in a store today, you have what has been the traditional store labor. It's the somebody cutting the meat, baking a cake, etc. You have that. You have the cashiers, people who stock the shelves. But you also have labor that is acting much like a distribution center. They're going around and picking product. That's a different mindset. It's a distribution center mindset. And so we're trying to do both in stores. We want the service orientation of the people behind the counter and at the check lanes, but we also want the productivity mindset of people picking product in the store. And we continue to improve that with algorithms, software, reallocation of product. And then the big breakthrough is in automation of that picking. That's when we're going to make a step change in our industry, and certainly at Albertsons, on cost of labor for the omni-channel business, so that even though you come and pick it up at curbside, we are giving you all of the service without adding a whole lot of cost to our business. And that's where we're all heading.
What I've heard from you really is this is a different company than when I think back to the Safeway merger in 2015. You have a lot of tech integrations. You're also executing on $1 billion in cost savings through fiscal year 2022. And you also have the sales lift from the pandemic. Do you think the street understands the story yet?
I think they're beginning to, Brian, but I'm focused completely on performance. You are right. We integrated Safeway and Albertsons for the first few years. We started the transformation journey that's accelerated through the pandemic. We're going to come out stronger out of the pandemic than we went into it. And it's because of all the things you mentioned. We are delighted about our progress and our potential.
All right, we'll leave it there. Albertsons CEO Vivek Sankaran, good to see you. Please do stay safe. And thank you very much. Julia Roche, good to see you.
Take care.
And we'll be right back.
All right, welcome back to Yahoo Finance Live. Miles Udland here in New York. It's time now for our financial advisor part, sponsored by PIMCO. And for that, we're joined by Andy Schwartz. He is the founder and managing partner over at Bleakley Financial. Andy, great to have you on the program. I'd love to talk just kind of broadly about how you've seen the markets this year and how you've talked about it with your clients, considering all that has happened and I think all the changes that perhaps are anticipated as we get into 2021.
Well, it's certainly been an interesting year. I think in March, April, I would have made a bet with anybody and sold my soul if we could have just held on to what we had made last year. And then obviously, there's been a complete, reversal or turnaround in the markets. I think what everybody has to understand and what clients struggle with the most is that the market and the economy aren't necessarily directly connected at all times. Especially right now. I mean, the economy is going to start to struggle a bit. We're having this resurgence of, the virus. And so clients are asking if things are slowing down, things are starting to shut down, not 100%, but around the country. Why is the market responding so favorably? And obviously the market's responding for two reasons. One is because the market's forward thinking. And with the vaccine news, the market knows that eventually this will be over. So the market's sort of past that. So it's important to remind people, that they're not particularly connected.
It's an interesting way to frame that, I guess, from the clients that you're talking to, Andy, because we see, in retailers, grocers, right? Those executives are talking about some of the consumer behaviors from the spring starting to come back now. And I suppose, would you echo that in conversations you're having with clients where some of their fears from the spring are starting to come back and you are finding yourself once again trying to reinforce to them what financial markets are seeing that is not happening in their daily lives?
I think you wouldn't be human if you weren't feeling a little uncomfortable after living through what we lived through in the spring and then just watching the news and all the things that are going on in various states as far as shutdowns and regulations, and seeing what's happening in the hospitals. I mean, it's serious. The virus is definitely revisiting. So I think everybody has that fear. But I think the difference is that in March and April, we had no idea how long this would last. And when you listen to the experts in the professional community on the healthcare side, the idea that one, it's possible there would be no vaccine, right, for certain types of viruses. And two, it could take it could take 2 years. And now here we are sort of on the cusp of knowing that it's going to roll out. So that alone makes this entirely different. It's not a matter of, is there going to be a vaccine? Will this end? But it's just a matter of when it will end. So I think it just completely changes things. We have to just remind clients that we are in a different set of circumstances than we were in the spring.
And Andy, I'm curious, it's Julie here. I'm curious as well what you're hearing from clients in terms, obviously everybody has a different investment horizon and priorities, et cetera. But in terms of capital preservation versus growth, have you seen any kind of shift over the course of the year as to what your clients are prioritizing? And do you have to sort of talk them off the ledge in some cases, so to speak?
Yeah, Julie, it's a great question, because where we start all of our conversations with clients is what is your liquidity need? Because a lot of times people say, well, how should we be investing today? And the place to start is one is how much money or liquidity do we need from these assets, say over the next 12 to 18 months? For clients that have liquidity needs over the next 12 months, that should not be investable, because everybody also has to recognize that we are where we were before COVID started as far as the levels of the market. And I'm not saying it's too high, and I'm not making any predictions, but you have to recognize the fact that earnings aren't where they were, the economy isn't anywhere near where it was, and the market is at this level. So I think as long as clients have a long-term outlook, then the real question is, over the next 3 to 5 years, do you think equities are going to outperform fixed income? And we are more than confident that that's the case. So as long as you've got an investable time frame, then people and clients need to be thinking forward. And that's how we try to frame that.
All right. Andy Schwartz is the founder and managing partner at Bleakley Financial. Andy, great to talk with you on this.
Thanks. Take care.
All right. We're going to have more coming up here on the other side of this break on Yahoo Finance Live. Watching the markets here about an hour into today's trading session. NASDAQ in the red, S&P and the Dow in the green.
Shares of American Superconductor have just about doubled so far in 2020. This is a company that services various energy firms as well as the U.S. Navy. It's gotten some new contracts this year. And of course, there has also been some interest in renewable energy with an incoming Biden administration. We're joined now by Daniel McGahn. He is the CEO of American Superconductor. It's good to see you, Daniel. So I want to talk to you about that Biden transition, first of all, before we dig down into your business, because I'm curious what, if anything, you think is going to change for you under a Biden administration, and what kind of policy changes you expect that might affect the renewable energy market in the United States.
Hi, Julie. It's great to be back again. I think some of the changes ahead, relating to Paris and climate accords and further focus on sustainability, that our company really is trying to help enable the supergrid of the future to bring more renewables to bear, and also to bring more inherent resiliency to that system as that system evolves over time. So politically, it looks like there's some emerging tailwinds that are coming. But I think we still have to figure out where we're going to be with the Senate and what policies are going to dictate. But only a piece of our business is in the U.S., but we're looking very optimistically at 2021 and beyond.
And so then, Daniel, thinking about some of those tailwinds for your business, and thinking more broadly, and when your business comes up, I think about the trends in ESG that we've seen from a lot of investors, and the way that the investment community now sort of thinks energy is going, as you mentioned, around the world where a lot of your business is. I mean, have you been sensing that in conversations and seeing those trends in your business as well? Because on the investment side, where we tend to focus our energy, everyone talks a lot about ESG and especially the E as that part of the equation. Is that something you're seeing as well in your business?
Yeah, I think, where our challenge is, a lot of times ESG, they're focused on the operation of a company, which we certainly are very clean and green in what we do. But we're unique in a way where our products are inherently environmental and sustainable. I mean, we're ultimately trying to become, a resilient company, financially delivering resilient products for a sustainable future. That's at the essence what our company's about. So I think the more things move in that direction, I think the more people are going to understand that it's not just the operations of companies, but it's the operation of the world. And we're hoping at the tip of that.
And Dana, you also work with various power companies around, as you said, around the globe and also around the country. You signed a contract with the Chicago utility provider. Where are we in smart grid penetration? Obviously, there's going to be a lot of focus on municipalities saving money right now because a lot of them are running short, especially after the pandemic. And how are they to sort of weigh the cost equation, right, of putting in these smart grid systems, which presumably are expensive to put in, but then save money in the long run?
We're really trying to look at it maybe a different way, where we're trying to make the grid itself actually more resilient and more sustainable and more smart. We're trying to make it inherently smarter. It's really part of our mission. We're not trying to work against utilities. We're trying to work with them. So the way we see the future is we're going to compete against traditional capital spend. The way we bring smarter energy to the grid is by enabling more renewables on, be it large-scale wind, be it residential solar coming to the grid. There's a play as well coming with us with electric vehicles, both in connection to the grid, but also in the mining of the raw materials. There are power issues there that we think we can help mitigate. But in every case, we look at the utility as our customer base and our advocate. We're not going to try to change the way that the edge of the grid works. We want to change inherently how the grid across the entire system works. And if we can make that smarter and enable more clean energy, I think we're going to be better off.
Daniel, how or if is your business impacted if a President-elect Biden cuts back on military spending compared to the Trump administration, or is what you're selling essential to the Navy?
Well, we've been an essential operation. We've been, open in business here. We're very much manufacturing focused, so that's really we've tried to keep product and people moving so that we can deliver high quality products to our customers on time. We do have a ramp in our business already coming with existing contracts for existing ships that have already been procured. We just received this summer an order for our third ship. So We think, smarter ships are going to be part of the future. I think thinking also about operating cost and environmental impact of the operations, I think also fit in with very well with what we do. So we're not trying to be cutting edge and trying to come up with the next generation ship. We're trying to make the current fleet more secure and more safe from harm's way.
And Daniel, finally, I want to ask you about profitability, because right now you guys are posting losses. What does the trajectory look like on that front?
Yeah, we've had a few quarters here where we've been close to positive operating cash flow. If we go back past 2 years or so, we've had a couple quarters. We've never guided to we're going to have positive operating cash flow until this past earnings report. So we actually guided to revenue levels that were within our model that we said we could potentially be operating cash flow, and we did indeed guide to be positive operating cash flow for the first time, at least over the last decade or so that the company has been through. So I don't want to say we fully turned the corner, but we have a lot of tailwinds behind us. Revenue has grown. We really focused on our grid, our smart grid growth. We've been able to grow the past 5 years running. We expect to grow as well as this year ends for us at the end of March.
Daniel, nice to see you. Daniel McGahn is American Superconductor CEO. Thanks so much.
Great to be here. Thank you.
Yesterday at this time, we were hearing from Jack Dorsey and Mark Zuckerberg at hearings on Capitol Hill. Coming up next, we're going to talk a little bit more about the future for tech regulation.
All right, welcome back to Yahoo Finance Live. Miles Upton here in New York. Yesterday, we saw Facebook CEO Mark Zuckerberg, Twitter CEO Jack Dorsey on Capitol Hill testifying before lawmakers on election integrity, as well as facing some questions about Section 230 regulations. And joining us now to continue that conversation, we're joined by Kareem Hijazi. He is the CEO at cybersecurity firm Prevallion. Kareem, great to speak with you this morning. So yesterday, it's kind of a jumbled sort of hearing. I know it was about election security, and Section 230 came up there as well. Let's maybe take election concerns and kind of the broad integrity, I suppose we could say, of the state of the internet in the U.S., if that's a way to think about things. Are you as concerned as some lawmakers are about the kinds of interference that we've seen come up in elections, the ways in which regular Americans are finding their internet experience essentially manipulated by nefarious actors, be they based in the U.S. or elsewhere?
Yeah, certainly. It's a serious concern. I think that we've been talking about this all year, prepping for the actual election and when the rubber meets the road, so to speak. And I think that it's not changing. I mean, the reality is that social media is a fact of life now. I don't think it's going away. I think with all the talk of regulating it in some ways, if anything, it'll foster other challenges in. So for example, some of the AI concerns people have had about this to say, hey, let's take this out of the hands of human analysts that have a bias and give it to an AI apparatus. That has its inherent challenges too, because those can be manipulated. It's all about what you give it. And if you educate it with something that's biased by volume, it'll slant in that direction. So I think what the adversaries have capitalized on, foreign or domestic, is they've realized how these systems work. And if you are able to work the curation systems that these social media systems need for their revenue generation, that's what's so complicated here, is that the protection components are directly related in a lot of ways to the curation engines that they have to use to make money. So to kind of just get rid of it altogether is just untenable. So it's a really complicated answer. And unfortunately, it's just fodder for the adversary in a big way.
Yeah, and I guess, Karim, maybe I should ask it this way. I think in kind of the media and political circles, right, everyone says election interference, right? That would seem to be the primary concern. But you're talking about the way the algo actually works on the site, the way it's actually coded, and the loops it's actually designed to respond to. As someone in the space, what are you most concerned about, I suppose, with the systems that exist in place, be they on social media platforms or just the kinds of things that we probably encounter in our regular internet usage that we don't really understand, or we don't even know that we're sort of being programmed for certain behaviors?
Yeah, definitely, Miles. So it's absolutely multifaceted. That's the hardest part about this. Whatever your feelings are about, Krebs, for example, CISA had a really hard job. They continue to have a very hard job because the vectors of attack are numerous and wide open. So to your point, general internet access, people working from home, social media influencing campaigns, hacking actual environments, and changing things fundamentally are all on the up for the taking right now. So you're absolutely right. I mean, the issue is this sort of combined collective effort. The harder ones to navigate are the ones that seem like they're using the systems that are in place by design to work that way, right? So it's hard to differentiate between what looks like it might be fabricated versus what's real. And if you're building a curation engine to feed someone something and they're using the system to its own demise, that's the hard part. The hacking stuff, which is really where we live, a little bit more black and white, a little more binary, right? We can say, hey, this was manipulated, this is fundamentally changed, and therefore it's easy to kind of call out things. The ones that are sort of using the system against itself, those are the harder ones here. Even us in the industry have a hard time sort of figuring out the solution around.
Karim, do you think regulation of any kind against these social media companies, that it would ultimately stifle innovation to the point where fixing misinformation on the platforms, it just simply won't get done?
Absolutely, because that's what the subjective nature of this is the problem. The provenance of where the data comes from is really the key here. And in many cases, and that's at the heart of this whole Section 230, there's really no clear, I think, understanding about how to figure out what the provenance of some of this is. And the amount of effort and research that goes into that is really difficult, because you're having to go and determine what is being said is accurate and factual versus an opinion or a slant on something. And then, how do you decide whether something gets taken out that is just just partially incorrect and part of it is? And then you sort of say, there's algorithms for that, but they're gonna err toward curating it and giving it to the viewership that has been looking for that type of information anyway. So to carve it out entirely does add a layer of censorship that is beyond anything we've ever seen, and probably could disrupt the revenue streams of these organizations, which is why they're pushing back.
All right, certainly a conversation that sounds like it'll be continuing for some time. Karim Hijazi is the CEO of Prevail. Karim, thanks so much for joining the program. We'll talk to you soon.
Thank you.
All right, coming up, we're going to have more here on Yahoo Finance Live. We're back with that in just 2 minutes.
This is Yahoo Finance Live. We have some final stories that we want to tell you about. Brian Sozzi, you've been watching this trend. It was Home Depot earlier in the week that said it was going to spend a lot more money on salaries, wages, I should say, for its employees. Dollar General now is doing that as well.
Yeah, Julie, long overdue with these retailers finally starting to pay their workers some real wages that you might actually be able to pay your bills on. So today it's Dollar General. They're out today with a $15 million, what they're calling an appreciation bonus. And that will bring their second half investment in appreciation bonuses to $100 million. It's unclear how much each worker is getting as part of this appreciation bonus. But to your point, Julie, you saw Home Depot out yesterday. They are investing $1 billion in raising wages for their workers. I asked Home Depot how much that will take the minimum wage up in their stores. They didn't want to tell me. So Glassdoor gave me that number, $11 an hour the average cashier makes per hour at a Home Depot. So Costco is continuing to pay its workers more, $2 more an hour, somewhat what you'd call pandemic pay. But I go into a lot more. I just had a story on Yahoo Finance hit on this. Click on it, read it, share it, because it's actually a feel-good story.
Yeah, definitely. And it's interesting these various retailers are moving before we see legislation on a national level on this. By the way, it's not retail workers who make the least in the United States. It's fast food. If you look at the per hour wage that folks make.
Here comes the $20 Big Mac, Julie. It's coming. It's time. You got to pay these fast food workers.
Another group that's maybe saving more of their money. Small businesses who deal with Apple. Apple rolled out something today called the App Store Small Business Program. And if you're a developer who earns less than $1 million in annual sales from your apps, you can qualify for a reduced fee on the App Store. Most developers are paying Apple 30%, and that's a number that's come under a lot of scrutiny and a lot of criticism and some legal challenges. Now you only have to pay 15% if you're a store of that size. So this is sort of a concession seemingly on the part of Apple. I don't know if how much it will get them sympathy or get the controversy away from them with regards to the App Store, but it's an interesting gesture that they are announcing here today, Miles.
Yeah, I mean, I think, look, when in doubt, you say we're supporting small businesses, the backbone of the economy. So Apple, I think, knows it has a problem here with the App Store. I'm not really sure how they're going to get out of it more broadly, but this is certainly a step in a direction to maybe take a little bit of the heat off, that behavior they've developed there. And I think behavior that certainly bears close watching.
It is. Let's stick with tech, Miles, because you and I have been debating a new feature on Twitter, and it's called Fleets. It sort of appeared out of nowhere, right? With not a lot of fanfare. It's basically Instagram stories, but on Twitter.
It's Instagram stories on Twitter, which were Snapchat stories on Instagram, which goes back to Snapchat. By the way, LinkedIn also now has a stories feature, which I know absolutely no one was looking for. Look, I think fleets are fun. I think they're great. I mean, I use Twitter as my platform of choice. I lurk on Instagram a little bit, mostly just to watch Sam Rowe's TikToks that he posts on his Instagram story. So it's sort of a derivative play. I don't really care what else is on Instagram. So I find the fleets fun in the first day. I think it's also important to look at the fleet rollout, which you mentioned, Julie, is kind of out of nowhere. Engagement based on the people I follow has been okay. And remember who the CEO is and the agreement that CEO just reached with some activist investors who were in Twitter. The street was disappointed by the number of active users that Twitter signed up. And you basically have two levers that you can pull as a social media company. You can get more users or you can engage your users more often. Fleets are very obviously a play at the latter. Twitter needs to find out a better way to monetize the users they have because they don't really grow users at the kind of rate that I think the street wants to see. And if Jack Dorsey wants to keep his job, he's going to need to start pulling the levers on monetization and engagement a little bit more aggressively, a lot more aggressively, to kind of keep everybody happy there. Long-term investors in Twitter still not happy. This was a $70 stock a couple of years ago, but I think fleets are very fun. I think the name is fine, and I look forward to tweeting more often.
Miles, what are they called on LinkedIn? Linkies? What do you got for me? Come on.
I don't know. You go ask your friends over at Microsoft. They'll tell you.
All right, I'll give Satya a call.
I'm definitely going to complain about fleets and probably use them. I don't know how many new users it'll get them, but it'll probably take us further down the rabbit hole for those of us who use it regularly. All right. On behalf of myself, Miles, and Brian, thanks for watching for the last 2 hours. We are seeing a modest gain in stocks across the board. The NASDAQ now just a wee bit in the green here. Akiko Fujita and Zach Guzman going to take you through the next 2 hours.
Happy Wednesday, everybody. You're watching Yahoo Finance Live. I'm Zach Guzman alongside Akiko Fujita right now as stocks are a bit mixed here. The NASDAQ just briefly swinging from red into green. The Dow up by about 100 points today as Boeing gives that index a lift. The FAA officially clearing the 737 MAX model this morning after a 20-month grounding of the jet. We're going to dig into what that means for Boeing in just a bit. But first, I want to start with the fact that Pfizer now says its COVID-19 vaccine is 95% effective with no serious side effects recorded in its final data set. That news comes as coronavirus cases continue to tick higher and set records. Hospitalizations also continuing to surge across the country. So let's kick the show off with the focus there and bring in Yahoo Finance's Anjali Kamlani. And Anjali, importantly, Pfizer is highlighting here that it could highlight for emergency approval from the FDA within just a matter of days here. So how's that shaping up?
Correct, Zach. So what we know right now is, of course, just after hearing from Moderna earlier this week that they hit 94.5% with no serious effects. We also know that Pfizer is now on par with their partner BioNTech, we must note, to apply for that EUA, having reached the end of their phase 3 trial based on the metrics that were set, the protocol that was set by the FDA. The FDA has been anticipating this, of course, and this is good news because it means that the U.S. is now going to have at least 2 vaccines come out possibly by the start of 2021, if all goes well. Of course, this all goes under regulatory review, and there will be even more discussions at the upcoming Vaccine Advisory Committee on December 4th. So all waiting for information there, but it is still promising, of course. And this is, again, against the backdrop of course, rising cases across the country, records being set in states on a daily basis. Wisconsin with 7,000 cases yesterday. Meanwhile, North Dakota, South Dakota continue to be a really central potential hotspots and concerning rises there, but across the board, seeing more than 150,000 cases in one day. Of course, this all goes to the question of what strategies each state is using, even down to the local level. We've seen so many different strategies, protocols put in place, restrictions, curfews, the like. Yesterday, Ohio talking about a curfew being implemented starting tomorrow. So while there is still that patchwork going on, there are questions about, whether or not this patchwork strategy will continue and whether or not a Biden administration could take on a different tactic. As we know, health workers and the scientific community is waiting for some sort of federal strategy. On that note, an advisor to the Biden COVID-19 task force, Dr. Celine Gounder, spoke to Yahoo Finance earlier today to cover just that. Listen to what she had to say.
A national lockdown or shutdown is simply not on the table. The president-elect has no intention of implementing a national lockdown. There may be some differences of opinion on the advisory board, but the consensus on the advisory board is also that we do not need a national lockdown is not indicated here.
So as you can hear, no full spread a national lockdown, but definitely some sort of, continuation of possibly what we see where hotspots get extra attention. Zach?
Yeah, perhaps a nod there to the view shared by Dr. Osterholm, who was on the show last week talking about potential reasoning behind a 4 to 6 week lockdown. Clearly, the clarity there coming President-elect is not necessarily of that mind, but Anjali, appreciate you bringing us that. Shifting gears over to what we're seeing play out, though, on the aviation front here, the FAA officially clearing the 737 MAX model from Boeing after a 20-month grounding of that jet following 2 deadly crashes. That news was giving Boeing shares a boost in today's session. For more on that story, I want to get over to Yahoo Finance's Alexis Keenan, who has more on that for us. Alexis?
Hi, Zach. Yeah, long time coming here, but maybe too soon for some. The FAA today approving the 737 MAX to resume passenger flights. For the most part, this order really deems the MAX safe to fly again after those design problems that led to those 2 crashes and killed, let's not forget, 346 passengers and crew that were on board. Now, there are some contingencies to this FAA order that really lifts the ban here. First, Boeing is going to have to install that new software on all of the planes. It will also have to fix a separate wiring issue that was unrelated to the MCAS and the systems that caused those 2 planes to go down, rather. Also, they will have to bring these planes out of storage. They've been preserved for quite some time now. You mentioned that 20 months at least for the grounding of those planes. So that will have to take place. And also, airlines are going to have to start implementing their pilot training programs. Now, early in November, that seemed to still be kind of an unsettled issue. But today we had Southwest CEO Gary Kelly issuing a statement saying that the company is confident in the FAA's requirements along those lines. But just a few weeks ago, we had pilots unions for both Southwest and American saying that the FAA should really make some improvements to what they're recommending here. Now, pilots will have to go through both simulator training. That's where they actually sit in a simulation type apparatus and they man the plane that way. They'll also do computer training here, both dictated by the FAA. Now, also separately, the Senate Commerce Committee today approved a bill that will change the way the FAA aircraft are certified. That's been, of course, such a contentious issue around the globe that Boeing, the contention is that Boeing had too close of a relationship with the FAA. So perhaps some movement along those lines as well. But let's not forget there are open investigations into the 2 crashes with the Department of Justice in the United States, also the SEC, and also Boeing could still possibly face some fines from the FAA. So a lot to continue to follow here, Zach. But for now, things are moving along with the 737 MAX.
Alexis, there are, of course, the planes that were grounded that were already in service prior to the accidents. What about the backlog that Boeing has to deal with now? We're talking about roughly 3,000 orders, I believe. What does today's ruling mean for that?
So Boeing actually has about just over 4,000 unfulfilled orders, and they have previously said that hundreds of those planes are also in jeopardy. You had about 10% of outstanding 2020 MAX orders, with buyers canceling those aircraft orders. So a lot remains to be seen here. And like I said, all of these planes that have been grounded and have been delivered, they will have to now come out of storage and get all of these fixes. And added to that, of course, is the coronavirus pandemic that is putting an unbelievable amount of pressure on the travel industry. So whether or not these prospective and past buyers even want these planes, that is another issue that Boeing is certainly going to have to deal with here.
All right, Alexis Keenan bringing us the latest on those developments. Appreciate that. Of course, Boeing is one of those companies that's still down at 36% year to date. We've been seeing some of those beaten down names due to the pandemic. Of course, Boeing has its own issues, clearly, as Alexis was just highlighting here. But one of those names is getting another look as we get the vaccine news, potential reopening coming sooner than investors had been bracing for. For more on that rotation, I want to bring on our first market guest today. That's Emily Rubin, UBS Senior Vice President, Wealth Management, joins us now. Emily, appreciate you taking the time here. We've been talking for a few days here about this rotation away from some of those growth names into some more cyclical names like a Boeing, perhaps those more levered to the reopening here of travel and the economy in general. But what's your take right now on how investors are maybe starting that rotation now and where it continues from here?
Yeah, I mean, when we look forward to the year 2021, we definitely think it's going to be a year of renewal. The world is steadily returning to normal. And with markets high, we do think it's time to diversify for the next leg. And we do expect some of these 2020 laggards to have the biggest upside potential. So whether that be consumer cyclicals or mid-cap stocks, both of which should do better on a reopening. So we're trying to, when we're talking to our clients right now, we're not only looking towards, everyone wants to get past 2020. So there's a lot of 2020 year-end planning. But from a market perspective, we are now able to look forward and allocate them for 2021 and even beyond for longer-term trends.
Emily, Anjali earlier talking about the news out of Pfizer today with a 95% efficacy. Now you've got two vaccines between Pfizer and Moderna. Has the news out of these drug makers, has that changed your base case for you at all?
Well, the market has gone up a lot on the vaccine news, and we do think that these returns are justified. I mean, a lot of these uncertainties are through. We now are past the election, and the vaccine news at least gives us somewhat of a timeline. We think there'll be more volatility as that, we learn more about how long it's going to take and actually getting it out to the people. But that combined with corporate earnings, which have come out much stronger than expected, and an accommodative fiscal policy and monetary policy, we think the case for equities right now is clear over cash.
Yeah, you kind of mentioned that investment horizon there. Obviously, we can talk about stocks being beaten down this year, but when you look at the investment horizon, maybe a little bit longer here, maybe back up and look at about 10 years or historical long run averages, you're talking about how some of those cyclical names match up to some of the growth names that we've been watching over the years. What does that look like to you when you back up and maybe put 2020 in context?
Well, interestingly, I mean, all of our clients are only talking about large cap growth and some of those big tech names that have done well specifically. But if you look back over the long term, value has outperformed growth over the very long term. But this last 10 years, growth has outperformed value by over 6% a year. And just looking back the last 2 years, cumulatively, growth has outperformed value by 50%. So a lot of our clients are getting frustrated with this and wondering if value investing is a thing of the past. But when we look at value investing, it does include a lot of these sectors that should do better on a reopening trade. And the outperformance of growth versus value is historical and at historical levels. If you're not going to invest in value now, I don't know when you are.
Emily, one of the things that you've highlighted are sustainable investments there. We're looking at more than $1 trillion invested or dedicated to SI funds. How much of this do you think, or how much of Joe Biden's policies, given that he has made climate really one of the central points of his administration, how big of a catalyst do you think that's likely to be for ESG investing as a whole?
I think sustainable investing has a lot of momentum and is definitely going to be part of the next 10 years and become more and more important. It's become much more relevant to our clients, and as a result of this pandemic, and they have a reduced tolerance for unsustainable practices. our clients already may, give their time to their community and invest in charities, but they want their investments now to reflect their personal values. And with, as you said, $1 trillion already invested in sustainable funds and more to come, the momentum from both investors and governments, like Joe Biden's green agenda and others that are committing to a green recovery, we think this will continue, and supported by a growing track record of investment options. At UBS, we've actually made sustainable investing our preferred solution for clients who are investing globally. You no longer have to sacrifice returns to invest for good and have an impact.
Yeah, we know that millennials in particular do enjoy, focusing in on ESG efforts here. But the other question I get from newer investors watching this all play out in 2020 is the fact that we're already back at record highs on the Dow and the S&P. So some people might say, "Oh, I missed my opportunity to invest there." I was looking over your notes, and you kind of highlighted the fact that just because you're trading at new highs doesn't necessarily mean you missed the top. Talk to me about what history might say as to why maybe new investors looking to put money to work haven't missed the boat yet.
Yeah, I mean, as you said, new highs are historically not an obstacle to further gains. If you look back at monthly data since 1960, the average one-year return of the S&P after reaching new highs was 11.7%, which is actually slightly higher than 11.3% from years where the S&P was not at a high. So there is, just because the market's at new highs doesn't mean that there can't be more upside potential. In fact, if we look back through this pandemic, savings accounts have increased by upwards of $2 trillion since March. And that represents almost 10% of GDP. With all of that increased savings, there's tremendous potential for a huge boost in consumer spending once the reopening continues.
Again, right now, there's not a lot of options out there if you're looking to travel or perhaps go on a cruise either. A lot of money there sitting on the sidelines. But Emily Rubin, UBS Senior Vice President, Wealth Management, appreciate you taking the time to chat.
Thank you very much.
Zach, retail a big focus today in the markets. Yesterday, we were talking about Walmart and the big bump they got on the back of their earnings. Today, the focus is on Target and Lowe's, and these are two stocks going in opposite directions here. Let's start with Target. That stock up just over 5% right now after a strong third quarter. Comparable sales grew 20.7%. But like so many of these big box retailers, the focus really is on digital. Digital comparable sales growing 155%, accounting for roughly 11% of the overall sales growth. Lowe's also seeing strong sales in the quarter, but it is down in the session here, more than 5%. Third quarter comparable sales there grew 20.7%. Traffic up 4.5% there. And when you think about digital comparable sales, also seeing significant growth on that front, but Lowe's under pressure while Target's getting a big pop today on the back of their earnings. We've got much more coming up on Yahoo Finance Live. We'll be right back. Welcome back to Yahoo Finance Live. Well, a higher corporate tax rate and stronger unions may not be a recipe to win over corporate America, but our next guest says President-elect Joe Biden's policies will actually lift big business. Let's bring in Deepak Malhotra. He is a professor of business administration at the Harvard Business School. Professor, it's good to talk to you. You penned this letter in the run-up to the election, essentially calling on the top CEOs here to push back against President Trump and sort of the 4 years that you talked about with the lack of leadership as you characterized it. What do you see as priority number one as you look to a new Biden administration and what his policies are likely to mean for some of the big corporations?
Thanks, Akiko, for the question. Delighted to be here. I think your two questions are very related. The first priority and what it means for business are intimately tied because as anybody looking around their neighborhood can tell, the first priority is getting the pandemic under control. Now, there's some good news recently because of the vaccines, but the fact of the matter is the numbers are going up. They're getting to dangerous levels. Hospital capacity is at lows. And so the first thing that the Biden administration is going to have to do is start working on the pandemic. And what's going to be coupled with that is probably a stimulus plan. And those two things are good for small business and they're good for big business. And they're good for employees and they're good for your neighborhoods in general. And I think that's going to be priority number one. And I think that's one of the reasons big business is very relieved that there is going to be a transition.
And Professor, I mean, when we talk about relieved about that transition, that's one thing. The big question now looming is how quickly it's going to take, or how long it's going to take, rather, before you get that stimulus bill through here, because we continue to see no progress being made between Republicans and Democrats, now in a lame duck situation here. So talk to me about how long Americans can actually wait for that to come through here as we continue to see economic data come in a little bit weaker than expected, if you look at the retail numbers we got yesterday.
Yeah, Zach, you're absolutely right. I think the delay is a big part of the story right now. In September, Moody's came out with a projection as to what would happen under different scenarios after the election. And their projection was that if Biden wins the presidency and Democrats take the Senate, that is going to be the best thing for the economy. It's going to be the best thing for job growth. And one of the big reasons was they projected that the stimulus would not only pass, but it would pass early and in a large way. It was going to be less good for the economy, according to the Moody's analysis, if it was going to be Democrats take the White House, but Republicans take hold of the Senate or keep control of the Senate. Now, what's interesting right now is if a stimulus does pass during the Trump presidency, during the last 2 months, it's likely to be smaller than what it would be if it gets delayed. And either the Democrats take the Senate after the Georgia elections, or if when Biden just takes the presidency. So I think what's going to really matter here are those three scenarios. Does the stimulus pass now, in which case it'll be smallest, but it'll be soon? Does it get delayed? And if the Democrats take Georgia, it will be potentially larger. And if it waits until Biden becomes president, it will probably be the largest if the Dems have the Senate.
Professor, I know you're focused on big business right now, but it does seem like there's really two narratives that are emerging. We're talking about sort of the retailers today, for example, that have seen huge success on the back of this digital acceleration. More and more people buying online, they're able to meet that demand. And then you've got the small businesses who, despite getting the PPP loans, are not able to survive as well. I'm curious how you're looking at those two narratives and what's likely to be waiting on the other end if there is this long lag on stimulus.
Yeah, I think the stimulus is the short-term fix. The medium-term fix is dealing with the pandemic. And I think both of these are hurting small business a lot. If you look at what's gone up, if you look at the NASDAQ versus the S&P at the times when the news has been bad, you see a disconnect there for this reason. Small businesses require people to come inside, eat, come inside, buy something, come inside and browse, be out on the streets, window shopping. That's what communities all over the country need. That's what small businesses need, and that's what people that work in these small businesses need. That's the number one problem right now in the economy, is that employers and employees in the small business sector are really, really struggling. A lot of the other big businesses, either because they have an online presence or because they have the ability to weather the storm for longer, are a little bit more protected in the short run, which is why the urgency is now. I think that a Biden presidency will make a positive difference, but there's no reason that Trump, McConnell, and Pelosi can't reach a deal even now to at least get us through the next couple of months, even if there's going to be something more done afterwards.
Yeah, Professor, I mean, your expertise is in negotiation. A lot of people were expecting that once we moved past the election, Republicans and Democrats would have been able to come together because neither side really wanted to risk having any kind of impact on the election outcome by passing something before it. Now that we're on the other side, how surprised are you that nothing has been done? As you're noting there's still a lot of benefits to come from this, even if it was to come under President Trump.
Well, I have to say, I'm not too surprised that nothing is happening right now while Trump is still president, because I was one of the people who, for a very long time, was quite sure that he would not accept the results of the election, no matter what they were. The only question mark was, would the Senate Republicans echo that narrative, or would they push back against it? And it turns out that that has been adjudicated, and it turns out they're going to echo that narrative for a little while longer. As long as that is going on, I think it's just one more barrier to getting a deal done. Now, the good news is, as you said, other than what's going to happen in Georgia, there's no more elections to look forward to in the next 2 years. Now, we know that election cycles start a lot earlier these days than they used to some decades ago, but there is a window of opportunity once the dust settles on this election. Right now, everybody is slowly trying to move Trump out of this sort of delusions of I'm going to stay in power and sort of dealing with the tantrums that are going on. But as soon as that moment is over and Trump has he won't officially concede, but when he has admitted essentially that he will not be in office after January 20th, 2020, then the only question is going to be, does he see it as part of his legacy that he got a deal done on stimulus? And my guess is that he very well might.
Okay, certainly a lot of people hoping for that as well. Professor Deepak Malhotra joining us from the Harvard Business School. Good to talk to you today.
Nice talking to you too, Kiko and Zach.
Appreciate it. Yeah, coming up, we're going to be digging back into some of that dysfunction here as Senate Republicans failed to get the Trump nomination through to the Fed of Judy Shelton, the drama that played out in that vote, as well as where things go from here. We'll chat that on the other side. Stay with us. Welcome back to Yahoo Finance Live. Yesterday, as far as nomination votes go, we saw quite a dramatic one. After 16 months, Senate Republicans failed to get through the Trump nomination for Fed governor, and Judy Shelton through. That vote failed, but potentially still leaving a window open where it could still go through. And for more on that, I want to bring on Yahoo Finance's Brian Chung. And Brian, I mean, this was a lot of math on your part and a lot of people watching this play out, but it ultimately not enough votes.
Well, a very dramatic scene unfolding on the floor of the Senate yesterday with Judy Shelton, again, the nominee from the Trump administration for a seat at the Federal Reserve Board, getting a 47-50 vote that sunk that nomination. This doesn't effectively
end her shot at becoming a Fed governor. I'll explain that in a second. But essentially, the vote last night came down to really Kamala Harris, the California senator, also vice president-elect, having to get on a train from Delaware to come down to Washington, D.C. to cast her vote because the margin was that narrow. Essentially, what it came down to were 3 Senate GOP members flipping over, not supporting her with concerns about her ability to respect the Federal Reserve's independence, in addition to 2 GOP senators, that being Chuck Grassley from Iowa, in addition to Rick Scott from Florida, being unable to physically be there to cast their votes because they were both in quarantine after possible exposure to COVID-19. So a lot of moving parts that ultimately led to a very thin margin for Judy Shelton not to survive that vote. Now, her hopes are still alive because Mitch McConnell switched his vote last minute from a yes to a no. This procedurally allows him to bring back up this nomination if he wanted to. The problem is that the Senate GOP is running out of time because Mark Kelly from Arizona, who's a Democrat, he'll be replacing the incumbent Republican Martha McSally in about a few weeks. We don't have the exact timing. Once that happens, that flips a red seat, which means that the narrow margin is really effectively going to lean in the Democrats' favor, which could spell trouble for her nomination. So not completely done yet, but at least yesterday, Judy Shelton did fail to finish that bid to become a Fed governor.
All right, Brian Chung bringing us the latest there. As I said, not a lot of drama expected out of these, but we got that finally there. We'll see what happens moving forward. Appreciate the update there. We're going to take another quick break here on Yahoo Finance Live. We'll be right back with a lot to discuss here in terms of big tech and everything else on the stimulus front and where we go in battling coronavirus. The NYU professor of marketing, Scott Galloway, joins us next. Stay with us.
The CEOs of Facebook and Twitter grilled for more than 4 hours on the Hill yesterday as they testified before the Senate Judiciary Committee on the issue of content moderation. Republicans and Democrats divided yet again, with Republicans talking about censorship on the platforms, while Democrats say more needs to be done to rein in hate speech and disinformation. Let's bring in Scott Galloway. He is a professor of marketing at NYU. Scott, it's always good to talk to you about these big tech issues. Yesterday it seemed like sort of the similar arguments that we've heard from previous hearings coming out yet again, but I'm curious how, as you look ahead to a Biden administration, how you think the regulatory environment shifts for these big tech companies.
Yeah, it definitely feels like Groundhog Day at this point. When you look up and you see in your Twitter feed testimony from Dorsey or Zuckerberg in front of a senator or a congressperson posing for the camera with
a statement disguised as a question. So in terms of what likely happens, I think you're probably going to see a modification of Section 230. Well, there'll be some carve-outs around things such as national defense or health or security-related issues that create greater liability or greater risk of liability for the platforms. I mean, you've seen these platforms all of a sudden find God, and to their credit, they've done a better job of labeling misinformation around the novel coronavirus. The question is, how come they haven't done it for the last 10 years? So the shadow of a Biden administration is casting a long shadow, and I would argue it's already having more impact on their behavior than anything previously.
When you talk about those carve-outs with Section 230, how is that likely to move through Congress, especially given how divided it's going to be? Again, I mean, when you look at the arguments from yesterday, it doesn't feel like there's been a whole lot of movement to the middle on where either party feels like Section 230 should go.
Yeah, but they're bipartisan in their dislike for these platforms. And even the president was calling for the removal of 230. So anything that is seen as holding these firms more accountable, I think will likely get enough support from both sides to pass. Something's definitely going to happen here. They've kind of gone from everyone's favorite rock star. The biggest argument 4 years ago was which of these CEOs or Sheryl Sandberg was going to be the Democratic nominee for president, to which company is a bigger menace to society. I mean, it's just striking. We don't notice it because the changes have been incremental. But in the last 4 or 5 years, these companies have been hauled in front of Congress more often than big tobacco or big oil ever was. So something's definitely going to happen. The legislation, how it's crafted, what's required to get it passed, I don't know. But I think that'll probably be one of the first things you'll see in the first year of a Biden-Harris administration.
Yeah, Professor, it wasn't too long ago. I remember Zuckerberg's tour around America, his listening tour, as people were talking about potentially him running for president too. It's a good flashback. But when we think about the pressure now mounting in terms of these people, not just being, power brokers in America, but also the CEOs of the companies themselves, you've been pretty outspoken about Jack Dorsey's failings in leading Twitter. I'm curious to get your take on what you made of his appearance before the Senate yesterday and where you think he should be changing his role in how he's running that company now.
Well, let me start with the last part. The change of role he should be fired. Any board that lets it part. I mean, this is a big company with thousands of employees that plays an important role in the discourse of society. And about 1 p.m. every day, he pieces out and he goes to another firm. I'm on the board of several, or been on the board of several public companies, and I've never met an individual who can manage a company like this part-time. So unless there's some superpowers we're not aware of, I think it's just starting right there. The fact that he's a part-time CEO and 89% of his wealth is tied up in his afternoon job renders him totally incapable of providing the attention and leadership that this company needs. And distinct of the regulatory conversation, I think if you look at product innovation, Twitter looks scarily 2015. So I just don't. The role for Jack Dorsey is for him to declare victory and leave and be kicked upstairs to chairman. So in terms of his comments, I find his comments are slow and thoughtful, and the beard and the nose ring don't make you thoughtful. They just make you slow. I just find his comments are encephalitic, irrational, nonsensical, anemic, and make no damn sense. I don't think there's any excuse. I think our idolatry of innovators is in full swing here, where we decide someone who's a billionaire and the founder of a tech company should play by different standards than every other CEO or every other leader in corporate America. This is a company that is fueled on rage, fueled on hate, and has done the ultimate slow roll, not as effectively as Facebook. They invented the slow roll, but has delayed and obfuscated any real change. And we continue to see this platform be weaponized by bad actors.
Yeah, and we were kind of split here on the beard. I think we were going back and forth. Some people liked it, some people didn't. But when you look at the metrics themselves in the way that Jack Dorsey has been running this company, you've also highlighted the fact that they've failed to monetize and really implement some of those changes when we're talking about subscribers and paying subscribers and the potential there on the platform, that it's taken too long to get that done. What have you, made of that in the longer it takes, and how investors are growing a little bit, worried about that?
There isn't a single platform that has the influence of Twitter that isn't trading at 20 to 30 times the market capitalization. And disclosure, I'm a shareholder. I think that if Twitter commands the space it occupies and moves to a subscription model, it doesn't have the scale the requisite scale of a Facebook or a Google to be in the ad-supported business. But it does have so many influencers, whether it's from media, the economy, or celebrities, that they need to better monetize it through subscriptions. Say 0 to 10,000 followers are free, 10 to 100,000 or 10 or $50 a month, and anyone above 1 million followers pays $1,000 to $10,000 a month. There's tremendous value when you have that type of influence and followership on the platform. And the moment they move to a subscription model, as we've seen Apple has done, Apple hasn't increased its earnings tangibly nor its top line revenues, but its stock has doubled over the last 18 months. Why? Because they've moved from 9% of revenues that are subscription to 24%. If Twitter can grow its subscription revenues with a series of verticals are starting to charge its users, you could see its revenues decline 10 or 20%, but you could see the stock double. So it is time for this company to move to a subscription model. They've threatened that. We'll see if they come through with it, but that's why I'm a shareholder. I think this company has tremendous value to be unlocked via the exiting the advertising industrial complex and moving to a subscription model.
One of the companies that have emerged that are trying to take market share away from Twitter is Parler, which I know you've been following closely as well. Obviously, a huge chunk of the user base on Twitter now believes that there is a form of censorship. They don't believe that conservative voices, or they believe that conservative voices are being suppressed there, whether even if there's no evidence to that. Is social media kind of headed in the way that we've seen sort of cable news, where we see this division of where your party affiliation is will determine which social media platform you use? I mean, what do you make of this sudden rise of Parler? Is this just sort of an election year phenomenon, or do you think there's something bigger behind it?
I'm all for Parler. I think we need something to skim the waste and the toxicity off of the pool of information here and dispose of it somewhere. And if Parler ends up being the septic tank for the misinformation and conspiracy theories, more power to them. Let them be the amoebas that clean up the toxic waste of the dump. And this notion that, censorship is effectively editing. And it's about time that these companies were acknowledged that they are media companies. And ultimately, even an algorithm is going to have a bias. I don't think there's anything wrong with that. I think it'd just be easier for them to get on with life if they said, yeah, we have editors. It's the Wild West, we end up with hate speech, we end up with bots, we end up getting weaponized by the GRU. We're going to see more and more polarization in media unless we get rid of an ad model. If you'll notice, Netflix, HBO, and LinkedIn haven't been weaponized by the GRU, and the discourse is just much less toxic, because when you have an ad-based model, it goes to the lowest common denominator, and rage is a fantastic way to get engagement and serve more Nissan and opioid-induced constipation ads. So your temptation is the algorithm just constantly figures out the way to get you more and more engaged is to anger and enrage you. So social media is nicotine. It's addictive, but it's not necessarily bad for you. The thing that gives you cancer, the tobacco here, is the ad model, because it leads to algorithms that want to put people in a left or a right positioning and then enrage them. So until we bust out of that and move to a subscription model, we're going to continue to have platforms where novelty and conspiracy takes precedence over truth, because quite frankly, truth is just kind of boring, and misinformation and falsehood spread 7 times faster, meaning there's 7 times more Nissan ads to be served, meaning there's more shareholder value. This is a huge issue. We need to bust out of the advertising model.
And to the point of it being addictive, we did hear Jack Dorsey yesterday sort of acknowledge that in the hearing, saying there are addictive elements of the platform. Let's talk about 2 companies that are now coming to market, Airbnb and DoorDash. We had the S1 filing coming out. Certainly these are companies, as we've seen with so many tech companies, that are in their growth mode. But it does feel like these 2 companies have their finances in order a little more. I mean, what do you think is the appetite for a company like Airbnb, for example, coming to market right now?
I think Airbnb is going to be one of the most successful IPOs of 2020. If you to type in Hilton Orlando, Marriott Orlando, Four Seasons Orlando, and then you did that Airbnb Orlando, and you did that across the 50 biggest tourist markets in the world, by far the number of searches done for Airbnb in that city are greater than all the other hospitality or airline searches combined. 91% of all the traffic to Airbnb comes from non-paid direct traffic, meaning this may be the first consumer, unicorn to bust or break out of the stranglehold that is Google and Facebook that exact a toll on all traffic. So this is a company, I think, that has one of the biggest moats in business because, Akiko, if you and I had 50 million bucks, we could start a ride-hailing company. We could create the supply, drivers, and the demand ride-hailers in a city of Denver. But in order to compete with Airbnb, we need billions because we not only need local supply, people willing to rent their apartments, you need global demand because 90+% of the people renting those apartments are from different corners of the earth. So they have the ultimate moat. They have arguably the biggest brand in the history of hospitality already. And it's a company that was profitable in Q3. And they were able to get in fighting shape. A crisis is a terrible thing to waste. They did not waste it. They cut marketing costs by over $1 billion. They cut their staff by 25%. So when you reduce costs and the economy and travel comes back, what you have is a path to profitability that is much wider and much shorter. I think Airbnb is arguably the most successful tech IPO of the last several years. I'm obviously very bullish on Airbnb. I think it's an incredible company. And instead of arbitraging gig workers as DoorDash and Uber does, it's arbitraging assets, and it's set up a fund for hosts. So 40 million people on the platform, 7 million rooms. I simply put, as you can tell, I'm very bullish on Airbnb. I think it's going to be an outstanding IPO and an outstanding performer.
Yeah, and a lot of those hosts taking part in the IPO as well, getting a little bit of the kickback here once that company goes public. So a lot of people hoping for the same thing there. But stay tuned. We got much more coming your way here with Professor Galloway. Got to sneak in one break as we are not on the subscription model just yet, but we'll be right back after this. Welcome back to Yahoo Finance Live here. We're continuing the discussion with NYU Professor of Marketing Scott Galloway, sharing a lot of thoughts here on big tech. But I wanted to ask Professor about the stimulus negotiations and where we're at in this recovery as well, because we've seen that discussion maybe shift a little bit back from where we were when we got the CARES Act through. Obviously, the framework back there was to help businesses survive, keep people on payrolls until you could get this bridge back to reopening. Now that we're past that, though, and we have businesses moving in the opposite direction with states locking down again, New Mexico, for example, what do you make of how long this negotiation has taken to get something through, and how this recovery is looking shakier and shakier?
Well, Zach, first I want to acknowledge that you can't let, excuse me, you can't let perfect be the enemy of good here. There's a lot of people hurting. And you probably need a certain amount of, $1 trillion of prevention here might be worth $2 trillion of permanent scarring that might happen if we have, permanent job loss or people who get evicted, what have you. I would argue that the stimulus, in retrospect, we're going to decide that the stimulus itself was not deftly deployed. And I believe that in general, you need to protect people, not businesses. We have a tendency to personify companies and make it sound tragic that a restaurant goes out of business. What you need to do is put the money in the hands of the employees, and then quite frankly, let them decide which restaurants survive and which go away, because the food business and the quick service food business is going to be reshaped permanently. And I worry that a lot of the stimulus financed not bridges to the other side, but peers. And a lot of these companies are going to go out of business. And the real tragedy here, government is supposed to prevent a tragedy of the commons. The real tragedy here is there's more time on business news networks talking about restaurants going out of business. The real tragedy that's doing real damage to our society is replacing more restaurants are open right now while schools are closing. I mean, you want to talk about a household that comes crumbling down, whether they can get food at Shake Shack. I mean, that's an inconvenience. But a 9-year-old at home whose mom is not home to help him or her with the iPad, and let's be honest, it's usually the mom, who is no longer socializing. You can see families literally imploding under the weight of school closure. And the fact that we haven't been able to allocate resources to keep schools open, we are going to lose a generation of doctors, civic leaders, of scientists, because what's happening in public schools is that to date, low-income kids keep track with their middle and higher income peers in public schools. Since the novel coronavirus and remote learning became the norm, over half of lower income kids have substantially fallen behind. That's not only morally wrong, it's stupid for our economy. We're going to lose 50% of our leaders and our scientists. So yeah, restaurants closing down and going out of business is meaningful. A loss of a generation of young people is profound. We need to rethink our priorities. And the only reason we're not sending stimulus to schools is because 9-year-olds don't vote. So I think our priorities are messed up here. I think we've lost the script.
Do you think there's a backlash waiting on the other end? When you talk about that generation that's being affected right now, certainly they're not of voting age, but you're already hearing from some of the younger students in high school or college who are saying, look, we're in this position because of a lack of leadership from the top. What does that backlash, you think, look like?
I certainly hope so. I mean, we did see greater turnout among young people. And for the first time, people under the age of 18-year-olds, sub-18-year-old Americans are now, whites are in the minority. And if you look at the Biden-Harris administration, their numbers just went higher and higher as you went younger and younger and more people of color. So there's just no getting around it. Demographics are destiny. I would like to think that the Gen X and the millennials and the Gen Zs, that we've all have jokes around them being expectant jerks. I would like to think that we're maturing a generation that looks at us and says, we need to embrace our species' superpower, which is cooperation. Why does Taiwan have 6 deaths with 20 million people? And with a similar population, New York has 28,000. Why have we decided to leave the Paris Accords? Why have we decided to not hold hands with our brothers and sisters overseas and embrace the treaty and the cooperation that has kept the peace, the North Atlantic Treaty? Why wouldn't we elect people who have served in social service and see country before party? So I would like to think we're maturing a generation that looks at us and says, okay, you borrowed from my future with record deficits such that you could keep your champagne and cocaine party going. But I've learned from this, and I'm more about cooperation. I'm more about empathy. I realize that forward-leaning investments such that 1 in 5 households with children aren't food insecure is a good investment, that ultimately these families end up in emergency rooms, or we pay for this injustice one way or another. So the silver lining here is I'm optimistic. Hopefully we're producing and maturing a generation. I think there's evidence of this that realize capitalism has to sit on a base of empathy or it collapses on itself. So I'm hopeful that this new generation is taking notes and learning.
Yeah, I'm not sure how optimistic some of those millennials might be when you look at, I guess, one of my favorite stats is the fact that that's the highest percentage of millennials now living with mom and dad in history. Yep. That's obviously one problem here. You're a professor, I'm sure you know well, maybe students being worried about graduating into this economy right now. On that front, a lot of people are talking about whether or not Joe Biden's going to move forward with some more progressive ideas about canceling student debt for a lot of Americans out there. I'd be curious to get your take on that, since some economists are going back and forth on saying, to your point exactly, that it might not be that big of a boost in terms of demand out there when you wipe when you wipe student debt off. So where would you fall on maybe that argument?
So a lot of calls on the progressive side of the party around debt elimination or free college. And I would argue that I'm all in for of debt relief for social service or for entering into certain types of neighborhoods or certain types of jobs in certain low-income neighborhoods. But what do you say? I'm not for debt relief at the end of the day. What do you say to the people who have sacrificed for the last 20 years, and there's a lot of them, to pay off their student loans, and the day they pay them off, all of a sudden there's debt relief? And almost every bailout, I believe, including this one, only results in moral hazard that results in a bigger bailout. Whether it was the bailout of Chrysler that led to a bailout of the two of the remaining three 15 years later, or the bailout of long-term credit management, which resulted in a bigger bailout of Wall Street in 2008. You create moral hazard here. And also, free college is nothing but a continued transfer of wealth from the poor to the rich, because who are in our colleges? Mostly middle income and wealthy kids. Wealthy kids are 77 times more likely to get into an Ivy League college than the other 99% of income earning households. So if you make college free, be clear, you're just, again, transferring more money from taxpayers to the wealthy. You need to make, college shouldn't be free. It's not your birthright to go to college, but college should be affordable for good kids that get into school such that any kid can go to college. I went to UCLA and Berkeley, undergrad and grad, for a total tuition of $7,000. And I needed student loans. I needed to work, and there's nothing wrong with that. But it was attainable for the son of a single immigrant mother who lived and died, a secretary. We need to go back to higher ed. We need to increase admittance rates. We need to lower costs so it takes back its rightful position as the upward lubricant of the middle class versus the engine of the casting system, which it has become. So free college, absolutely not. Debt forgiveness, debt reduction, yes. But debt elimination and free college are nothing, again, but a transfer of wealth from poor people to rich people.
Yeah, we've seen these arguments play out. We're going to see where the final answers come down as President-elect Biden moves forward with his agenda items. But appreciate you taking the time to chat, as always. NYU Professor of Marketing, Scott Galloway. Appreciate it again.
Thanks, guys.
We've got much more coming up on Yahoo Finance Live. Looking to the markets right now, all three majors firmly in the green. We'll be right back. Welcome back to Yahoo Finance Live. We are seeing the Dow now up roughly 90 points, the Nasdaq up 16, and the S&P 500 up about 7. Inez Ferré is checking all the market action for us today. And Inez, Boeing, a big mover on the back of that announcement from the FAA today.
That's right. As industrials are gaining today, Boeing up more than 1% after the FAA approved the return to flight of the MAX jet that's been grounded since March of last year. If we just take a look at some of the travel stocks, those are in the green. The airlines are in the green. You are seeing Norwegian down more than 3%. The cruise liner announced a secondary stock offering at $20.80 a share. That's why you're seeing this stock that's under pressure. If we look at the NASDAQ, we're seeing that the best component on the NASDAQ right now being Tesla, up more than 7% after Morgan Stanley's Adam Jonas upgraded Tesla to overweight with a price target of $540, citing the company's software and services revenue opportunity. Year to date, the stock is up 465%. Akiko?
Okay, thanks so much for that, Inez. Much more live market action or coverage here on Yahoo Finance Live. We'll be right back. It is noon here in New York City on this Wednesday. Welcome to Yahoo Finance Live. I'm Akiko Fujita here along with Zach Guzman. Let's take a look at where the markets are trading. Midday, we are seeing all three major indices firmly in the green. The Dow, the biggest gainer so far, up 80 points. The Nasdaq up 25 and the S&P 500 up 7. Bitcoin in focus yet again, that breaking 18,000 as the rally powers on. We're going to break down the moves for you a little later this hour, but let's begin with the big headlines on the coronavirus. Pfizer now saying its COVID-19 vaccine is 95% effective with no serious side effects. That news comes as coronavirus cases and hospitalizations continue to tick up in all 50 states in the U.S. Let's kick things off there with our very first guest for the hour. We've got Dr. Jeremy Faust. He is an emergency medicine physician at Brigham and Women's Hospital. And Dr. Faust, it's good to talk to you. Let's start with that vaccine news. We've certainly been talking a lot about the efficacy rate here. 2 vaccines now on the market. How big of a success is this? And how are you looking at in the context of the surge that we are seeing in COVID cases right now?
In a sea of bad news about cases, it's nice to have something positive to talk about. These data from Moderna last week and Pfizer the week before, now updated information from Pfizer, really a bright spot.
we have to contextualize it, right? Whether this means that people can't actually spread the infection is really unknown. What we are seeing, though, is that it's preventing severe symptoms and severe illness in the people who get it. So it's a big bright spot. Look, it's been a terrible year for pandemics. It's been a great year for vaccine science. We had a sequence of this virus in early January. 2 months later, people were getting injected with these vaccines. And now in the same calendar year, efficacy numbers like this. I think it's positive. It's a reason to celebrate. But of course, the problem is with delays, we don't want to sort of dance before we get to the goal line, because we have to save lives so that people can be alive to get the vaccines, assuming that everything plays out.
Yeah, and that's obviously top of mind right now in terms of where we go in the next couple of months. Obviously, Thanksgiving and Christmas approaching here. You're going to have a bunch of gatherings. On that front, earlier today, we did chat with one of the doctors named to President-elect Biden's coronavirus task force. And she was talking about how he's not necessarily on board with some of the other views shared by that same task force, potentially about locking down for another 4 to 6 weeks here. Here's what Dr. Celine Gounder had to say on that topic.
A national lockdown or shutdown is simply not on the table. The president-elect has no intention of implementing a national lockdown. There may be some differences of opinion on the advisory board, but the consensus on the advisory board is also that we do not need, and a national lockdown is not indicated here.
So, Dr. Faust, I mean, we've seen governors take some action here. New Mexico instituted their own lockdown for 2 weeks here. What do you make of the discussions on lockdown right now? What do you think needs to be done in that interim before we get the vaccine?
Yeah, I mean, I'm a friend of Dr. Gounder. I know what she's saying. She's saying that in the room, there's a debate about theory versus reality. It kind of reminds me of HIV. Yes, abstinence is perfect if it's done, but it's actually not achievable on a population level. So you don't just teach abstinence. Same thing here. It's like, if you really could just lock down and everyone stayed put for a little while, you could squash the virus. But what I think the task force, the advisory board, is saying is they realize that it's just not really possible politically. And so let's choose the things that we think people will do that have the maximum benefit with the least likelihood of leading to sort of mass rebellion against whatever is suggested. So I actually really appreciate that they're in that room being more than just academic. They're saying, look, the rubber hits the road. Let's see what's practical, what's possible. And I think that therefore it'll kind of change from jurisdiction to jurisdiction. Like you said, some areas are going to have no choice, and there will be the political will to say, you know what, we're willing to take some pretty extreme measures. And other places where it's not the case, then you really home in on the things that we know matter the most and try to mitigate while we wait for that vaccine to come out.
One of the other concerns the doctor raised in that interview was just the transition process as a whole, saying we're not being allowed to have access to data that the current administration has. So we can't really assess how things are working. I know you're on the outside looking in, but what are the key concerns that you have with this transition process, especially given that you've got an administration in office right now that is not willing to concede yet?
It's really unfortunate that this is being politicized and that we're not having the usual transition. I remember reading about George W. Bush transitioning to Barack Obama and how outgoing President Bush was actually doing things that he may not necessarily agree with because he felt that for continuity, President-elect Obama needed some things done. I'd like to see the same thing happen here. We can respond federally if we have the right information. Let's imagine that we knew a little bit more about capacity in real time. Well, FEMA could react to that, or the Army National Guard, who can pop up a field hospital in a matter of, very quickly. They could really respond. So it's not necessarily the case that the current administration would do anything, but it would be nice to know that on January 21st or 20th at noon, that we know what's possible, we know where the needs are, and then a new administration could immediately activate without any sort of lag between what they perceive as the need and what they know is a possible response. So yeah, we need that transparency so that the second it's possible to change course, we can do so.
Yeah, Dr. Faust, you talk about politics playing a role here. We've talked about how that impacts Americans' ability or willingness, I should say, to get a vaccine when that comes through. The latest poll from Gallup shows that things are improving on that front. 58% of Americans saying they'd be willing to take that vaccine. That's up from about half in September. Yesterday, we were asking one of the doctors who treated President Trump when he came down with COVID-19 about that and what percentages are going to be needed in vaccinating Americans to hit herd immunity. He was saying about 65 to 70% of the population is going to need to get it if you're talking about a vaccine that's about 90% effective. What does that look like to you in rolling this out effectively to reach that ultimate goal of getting back to normalcy relatively soon?
Well, one thing that I will say is that the fact that we have multiple vaccines sort of competing is actually a good thing in a sense that there are going to be slightly different supply line issues and some other issues that I think actually makes it good that we're going to have more than one. So Pfizer can get this many doses in this situation, Moderna can do the other. So rollout is going to be a little bit shaky, but at least it's not going to be all the eggs in one basket. So I think that's one good thing. Unfortunately, the spread is so rapid right now that about 10% of the population is probably going to be infected by this thing before a vaccine is really available. So again, I agree with the statistics that you cited that we have to, not everyone has to do it, but over half have to do it. And then on top of it, unfortunately, some will have some degree of natural immunity from having recovered among those who do. So I think that those numbers are going to go up. I think that we're going to get above 58% with that number. And I'm not surprised because when there's a perceived need and when there's trust in the scientific community, or even just trust with you and your healthcare provider, your physician or whoever you're working with, to say, look, I got the vaccine. What are your concerns? Let's talk about it. We find that we can't get everyone to do it, but we can actually get a lot of hesitant people and a lot of maybes to yeses, just by having a really open, honest conversation about everyone's concerns. So I think we'll get there. And I hope it's 95, 100% adherence, but I think we're going to get to a high enough number where we'll have success.
Dr. Jeremy Faust, emergency medicine physician at Brigham and Women's Hospital. It's good to talk to you. Thanks so much for your time.
Thanks.
Let's turn our attention back to the markets right now because we have seen this vaccine news really keep this rotation out of growth into value, sort of facilitate that. That's been accelerating. I want to bring in Max Gockman. He is the head of asset allocation at Pacific Life Fund Advisors. And Max, you've clearly started allocating towards value as well. How are you weighing these two good news, bad news scenarios the doctor just laid out? On the one hand, you've got two vaccines now that have more than 90% efficacy rate. And yet, when you look through the states across the country, we are seeing a dangerous uptick in infections.
Yeah, I think it's going to really matter if we can get through this period. There's actually a third risk, which is really the fiscal cliff, right? So there's no fiscal stimulus anymore. There are no benefits being given to people, as there were, for example, when we were much more bullish on equities more broadly, even as we were going through a second wave in August and July. So in terms of weighing that, we do think that it's time to start tilting towards value and away from growth. We do think that those sectors will benefit from the tailwinds of both the Biden administration in terms of infrastructure plans, as well as a bipartisan move to regulate big tech, which will be a headwind for growth, obviously. But at the same time, it makes sense to be more neutral on equities overall, as we are in this very risky period. It's, they say it's always darkest before the dawn. And I think that's kind of where we are with much higher cases spiking. I mean, positivity is at a highest level it's been since May. And I think right before a vaccine starts getting rolled out through the EUA, that is when we're going to have to be most careful. And, the other risk factor that we're also makes us cautious is the lame duck session of the Trump administration. We think that investors who aren't paying attention to that lame duck session may wind up with an egg on their face.
Yeah, Max, there aren't a lot of people issuing caution right now, so you'd kind of be in the minority there when we think about other firms raising their price targets next year and beyond that. So I guess there are concerns about short-term chop for sure, and I guess how long it's going to take for that next wave of the stimulus bill to come through here. On that front, though, when you weigh risk and reward, one of those firms that was upping their price target here would be Jefferies, and they're focusing on financials, saying that they're moving from being moderately bullish on that sector to outright bullish, highlighting easing lending conditions as well as the catalyst there of that next stimulus bill. So talk to me about where you're seeing this risk reward in sectors that you do like longer term.
Sure. So I do think financials is something we are liking more now. I think net interest margins will improve, especially if we do get more of
infrastructure spending, more stimulus, that's going to start kicking up the long end a little bit. I don't think the Fed's going to let it get too far, but certainly that's a possibility. I think lending standards improving, and also more importantly, demand for loans improving as companies start getting more comfortable with doing more CapEx. That's going to be a benefit for financials as well. I think that consumer staples is another value sector that should be looking better. Again, as consumers start spending more, that's obviously going to be first driven by staples and later by discretionary. Utilities benefit from investors' search for yield and continue paying good dividends. I think utilities especially also can benefit from some of the green initiatives that the Biden administration will put forth. And finally, materials and industrials, again, leveraging infrastructure. Those are going to be sectors that I think will benefit both from a return to being outside and return to work, but also benefit more directly from infrastructure spending.
Max Gauckman, the head of asset allocation at Pacific Life Fund Advisors. Good to talk to you.
Thank you. Great
One
to hear.
area where we're seeing huge movements today, of course, is Bitcoin. Right now, trading below that $18,000 level, but we did see it hit that level earlier today. Bitcoin now up roughly 146% year to date. It's gained nearly 70% this quarter. Let's bring in Catherine Coley. She's the CEO of Binance. And Catherine, let's start with the moves that we have been seeing here. I mean, what's been driving the gains?
Thanks so much. It's really been amazing to see this rally driven largely by spot buyers. You're seeing the funding premiums of the perpetual futures still actually be relatively low, stuck in that kind of range where they were at 12,000. So this acceleration of price has been largely led by the real gains in validation that we're seeing that we didn't see in 2017. So for the first time ever, you're seeing congressmen and women understand Bitcoin. You're seeing macro investors understanding Bitcoin. You're even seeing corporate treasuries understanding and adding Bitcoin to their balance sheets.
And Catherine, we've seen a few other commodity traders, big names in the commodity space. You can look at Paul Tudor Jones coming on board as well. But one of those early adopters, Mike Novogratz, was on CNBC earlier talking about a price target of $50,000 to $60,000 per Bitcoin by next year, kind of stretching into that idea that you can capture about 10% of the gold market. That's where the price comes from. But talk to me about how the enthusiasm right now, compared to what you saw back in 2017, could maybe make that a reality, considering, I guess, this new breakout we're seeing play out now.
Very much so. This industry is in constant motion. So what we've seen in the last week isn't us sitting on our laurels, but still building. You've seen Novogratz have an amazing week of announcements. You've seen PayPal come into the US retail market. Binance US has launched our connection with Silvergate Exchange Network, allowing institutional traders to come through. And we're even launching a new app coming out in the near future. So the best part about this industry is we're still evolving, still building, regardless of the price.
Certainly a lot of new investors looking to get in. And I'm curious how you think they should be looking at this. There's been so much debate about whether it is considered a safe haven asset, whether it is a hedge, whether it should be traded in tandem with gold. I mean, what have you seen shift around the trades in this most recent surge that we've seen?
We've definitely seen the infrastructure mature since the last year or so. And in that, you've seen different ways of people being able to come into trading. So dollar cost averaging has actually been quite popular and quite successful for many investors in this past year, knowing that what lies ahead is definitely a digital future, accelerated by the pandemic for sure. And what they're going into is not necessarily timing their entries and exits with expectations, but just growing their position over time. So having dollar cost averaging integrated into these exchanges, as well as seeing just the maturity of the products available. Grayscale is at an all-time high in terms of the Bitcoin they hold under custody. And as you just see, this access is becoming more and more available for everyone.
Yeah, Catherine, as one of the CEOs of the largest exchanges here in the U.S., I mean, talk to me about regulatory changes, because we saw the chairman of the SEC is going to be stepping down. That's news. Each time I see Bitcoin back up at these highs, it gives me a little anxiety just kind of watching the way things have changed over regulatory updates. What kind of clarity have we gotten over the last couple of years on that front, though, and how much is still remaining to be seen? What changes could come through when we get a new chairman of the SEC?
You've seen a tremendous amount of collaboration in the US, specifically with the industry players, to make sure that we are not falling behind as a country involved in digital assets. So the great work of the Blockchain Association, getting involved with other groups that are really pounding the pavement in Washington to make sure people are understanding what we're building and the access we're providing. That being said, we're doing everything through the books. So it is a compliant and regulated platform where we make sure that our users have that confidence in us to be leading them forward in where we're headed with the US regulation. So we're excited to see the changes. We've ourselves been going through the money transmission license process across the states, now available in 41 of the 50 states and continuing to add more states going forward.
Catherine Coley, the CEO of Binance US. It's good to talk to you today.
Thank you so much.
All right, coming up, we're going to be digging more into what agenda items President-elect Joe Biden might have on the table and why it's not just Democrats that are enthusiastic about that. We'll chat with former Republican presidential candidate Carly Fiorina on the other side of the break. Stay with us. Welcome back to Yahoo Finance Live. We are seeing President-elect Joe Biden start to plan and perhaps piece together some cabinet picks here as the transition process looms a bit longer than some Democrats might be comfortable with. But a lot of former Republicans, even on the other side of the aisle here, enthusiastic about what opportunities might be out there for President-elect Biden and his administration to get some key items through here. And for now, I want to dig into that with our next guest here. Carly Fiorina is Enterprise's CEO and, of course, was a former Republican presidential candidate who endorsed Joe Biden for president. We're joined by her alongside Yahoo Finance's Rick Newman as well here. Mrs. Fiorina, I mean, I guess we'll start on what has you most enthusiastic right now about some of those agenda items that might come through. Obviously, it's not just going to take Democrats here to get behind those Republicans as well, depending on how the Senate shakes out. So what are you most excited about and looking forward to in Joe Biden taking over?
Well, first, I endorsed Joe Biden way back in June because I think leadership matters and character counts. Secondly, however, to your very specific question, I think many Republicans agree that we need to get this pandemic under control and that President Trump simply hasn't taken it seriously enough. I think many Republicans agree that we need to rejoin multinational alliances and strengthen our relationships with traditional allies and push back on those who have been traditional adversaries, like Russia, for example. I think there are many Republicans who are excited as well about an infrastructure package. I honestly had hoped that President Trump would move forward with an infrastructure package in 2017. He did not. But I think there is a lot of bipartisan support for infrastructure build, and Biden has spoken a lot about that. And finally, I think that if it is likely that Republicans retain control of the Senate, or at the very least that it is a very small margin one way or the other, depending on the outcome in Georgia, I think there are many Republicans who believe, okay, a big tax hike probably isn't in the cards. And yet, there are many things that can be done around the pandemic, around education reform, around health care, around infrastructure build, around multinational alliances, as I said, that there's a lot of bipartisan support for.
So let's talk about what should be done around the pandemic, because there has been so much back and forth, this very long lag on a stimulus bill. What do you think should be prioritized, even in this lame duck session?
Well, I would hope that finally Democrats and Republicans would get together in this lame duck session and pass a stimulus bill. I mean, clearly there is assistance required at the state and local level. Clearly, working families and small businesses in particular are continuing to suffer, particularly in this very difficult and dark winter. I think the question mark for me, honestly, is the Republican Party, at least elected Republicans in Washington, D.C., still seem to be in the Trump party. And so I think they are watching and looking for signals from Trump about what he is willing to support. And so that's the only thing that makes me nervous about whether or not a stimulus bill will get passed. He has been kind of all over the map in terms of what he's willing to support. But clearly the need is there, and I think both Republicans and Democrats, if they stop and think about it, realize that it is a failure of the political class to do nothing when the need is so great.
Carly, we will be beyond President Trump, and we will be beyond the coronavirus at some point. You were in 2016 as a kind of a pragmatic, centrist, pro-business Republican. Does the business community need anything, putting aside stimulus and aid for small businesses and things like that? Does the business community need anything structurally, or does it just need the Biden administration to leave it alone?
Well, you know, I think the great example of the business community going to get something from the Biden administration, whether they want it or not, is big tech. I mean, there's no question now that these large technology companies have a degree of market power, whether it's in data privacy or content management or lack of competition, that Republicans and Democrats alike believe needs to be curtailed or regulated in some way. And so I have been advocating strongly over the last several weeks that big tech, Facebook, Twitter, the rest of them really need to decide to become part of the solution here and work with government, work with politicians on both sides of the aisle to craft a set of solutions that are going to work. I just don't think it's realistic anymore for the technology sector to say, just leave us alone, we're going to do our thing. I think those days are past because of the power they have in our society over data, over content, et cetera. And so I think something's going to happen. I always get very nervous about politicians crafting solutions on their own, particularly around an industry that they don't understand very well. And that's why I think leaders in the industry need to step forward and help.
Just one more question about politics and maybe a bit more on tech. You joined us in October for our All Markets Summit, and that, of course, was before the election. We've now seen Biden won, Trump lost, and we're seeing this fairly shameful performance by many Republicans plus Trump, where they won't acknowledge that Biden won. They won't help Biden with the transition. we asked you in October, do you consider yourself a Republican still? And where is the Republican Party even headed in your estimation? Could you just update us on your thoughts on that?
Well, you know, I tweeted this morning that this is shameful. That's one word for it. I think, honestly, President Trump has cemented his legacy as being inadequate for the job. And Republicans who continue to refuse to say or do anything about this unwillingness to engage in an effective and peaceful transition are also demonstrating that they're inadequate for their jobs. This is all about Donald Trump's political power with the base, but some things are actually bigger than politics. The coronavirus is bigger than politics. National security is bigger than politics. And so I would hope that fairly soon here, you would have notable Republican elected officials stand up and say to the president, enough is enough. It is a time to acknowledge the obvious. Joe Biden is the president-elect, and to begin an effective transition.
Yeah, Carly, let me ask you a personal follow-up on that, too, because, I mean, you were on the debate stage back in 2016. You had your own battles with President Trump. I'd be curious to get your take on what it's like to watch other people who had their battles on that same stage, and Senator Rubio and Ted Cruz, you know, basically lining up behind President Trump after those personal attacks. You're obviously not in that line with them. How much of that comes from just principle, or how much of it comes from maybe your ambition here to maybe join Joe Biden's cabinet picks or play a role in that administration too? What's your take on how that's shaken out?
Well, to the second part of your question, I don't have an ambition to join the Joe Biden cabinet, so that doesn't factor into any of my decision making here. And I've not been in touch with the Biden campaign from the moment I endorsed him until now. So that's not the issue. To your specific question, I find it deeply disappointing, as well as, frankly, mystifying. Why men that I thought had principles seem to be willing to throw those principles aside for short-term political gain. And I think that's what it's all about. It's all about politics in the relatively short term. Perhaps I told you in October that, you know, George Washington said the trouble with political parties is they'll come to care only about winning. And what I think we've seen in politics is too many in politics are focused solely on running and winning, and they have a very short time horizon as a result. And so people are fixated on Georgia, that's pretty short term, or they're fixated on 2022, that's also short term. But in the meantime, there are bigger, longer term issues at stake, and our principles are part of what's at stake.
I wonder if we could just go back to big tech. You mentioned that before, and you ran a big tech firm in Palo Alto for a while. This is a complex problem. It does not apply to all these companies equally. But if you could point to one single reform or fix that might address these problems with these technology giants, what would it be?
Well, first, let me say, when I ran Hewlett-Packard for 6 years, I testified multiple times on Capitol Hill. It's not the most fun thing to do, but it is part of the process. So to answer your very specific question, I believe what we need now are a set of rules that are uniform, consistently applied, and completely transparent. And those rules need to cover how data is maintained and how consumers' privacy is protected and how content is managed. You know, yesterday in the hearings where Mark Zuckerberg and Jack Dorsey were testifying, Mark Zuckerberg made a comment around, well, you know, Steve Bannon's tweets about beheadings don't violate our rules. And a lot of people said, well, what are your rules? That's exactly the problem. No one knows what the rules are, and no one knows whether the rules are being consistently applied. And so when these CEOs show up and just say, trust us, we have rules, but we don't know what they are, and we don't know how they're applied, then honestly, we can't trust them. So transparency around those sets of rules and assurance that those rules are being consistently applied is absolutely necessary now.
I want to get back to what you said earlier about the stimulus and you saying that, look, there's a lot of lawmakers who are looking to President Trump for some kind of signal on which way to vote. The president, according to reports, have indicated that he may consider running again in 2024. I mean, how big of an influence do you think the president is going to be within the Republican Party beyond his administration? Come January, is he going to continue to be a huge influence over the party? And if so, what does it mean for the future of the Republican Party?
So first of all, I, of course, have no insight into what Donald Trump is going to do, but I certainly think he is laying track for running again in 2024. And let's just back up and give President Trump his due. President Trump turned out massive numbers of voters. He gained more votes, millions more votes in 2020 than he did in 2016. And he also turned out votes for Joe Biden. So Donald Trump has real political power. He has a real base that is loyal to him. And so, of course, that gives him influence in the Republican Party. It's why I said to you in October, I'm not sure that the Republican Party isn't Trump's party, and I don't see myself in Trump's party. But make no mistake, he isn't going away. He's not disappearing. He won't be president, but he will retain enormous political influence. And so the question is what he chooses to do with that influence. But right now, I think what you're seeing is politicians who don't want to get on the wrong side of him, because through that influence, he can make a difference in a Georgia Senate race. He can make a difference in congressional races in 2022. And I'm sure he intends to try and make a huge difference.
And we'll see what kind of difference that ends up being. But fascinating to get your take on all this. Carly Fiorina, thanks again for taking the time to chat with us today.
Great to be with you all.
Coming up, the latest company to come to market through a SPAC. We're going to be speaking to the CEO of MP Materials, James Litinsky, after the break. We'll be right back. Welcome back to Yahoo Finance Live. We've been talking a lot about the SPAC boom this year, and we've got yet another company coming to market today through a SPAC. Rare Earths miner MP Materials going public through a $1.5 billion SPAC merger. The company today started trading, and we've got James Litinsky, the MP Materials CEO, joining us from the stock exchange. James, it's good to talk to you today, and congratulations on your IPO. Let me first just ask you a question. We've been asking a lot of CEOs that have been coming to market. Why a SPAC?
Sure. Why a SPAC? So, a SPAC, and obviously it's topical today, and I think when you look back at the, sort of the year 2020, there's probably going to be some great success stories in SPACs, and then there'll be some, some failures, and obviously there's, very diverse outcomes here. But when you look at a SPAC, it's really just a structure. It's a mechanism to raise capital and get to the public markets. And in our situation, we hired Morgan Stanley. We were in the traditional IPO process early this year, and we were able to put together a transaction that allowed us to get to markets more quickly, have more certainty around valuation, bring in some investors like, our PIPE was led by Slate Path, Lee Cooperman, Chamath Palihapitiya, and so we were able to kind of gather some strategic partners and thoughtful investors and get to market quicker. And we set up a deal that was great for all stakeholders, and obviously the market reflects that today. And so, we think it was a great outcome for us and for our shareholders. And I think every SPAC is different, and I think you're going to see, like I said, you'll see a variety of outcomes in them. But then the last thing I would say on it is, at the end of the day, once it's done, we're an NYSE listed company, and whether we straight IPO today or SPAC today, SPAC today, de-SPAC today, we've got to execute, and we've got to deliver the cash flow for shareholders, just like, no matter what we do. So from here on, it doesn't matter.
Yeah, James, let's talk a little bit more about what the company's trying to do there then, because you guys operate Mountain Pass. Obviously, it's a big rare earth mining processing site, makes up about 15% of the global rare earth content coming out of that mine. Through this, though, as Akiko was mentioning, you guys are raising more than $500 million here to put to work. So what is your plan there in taking on China, which obviously controls a large chunk of this market? What are you looking to do with all that cash?
Absolutely. And so, yeah, we today we now have north of $500 million of cash on our balance sheet. We're a profitable business, and we're 15% of the global rare earth content today. You mentioned in rare earth magnetics, ultimately it's probably important to point out rare earths go into the magnets that go into motors for electric vehicles, wind turbines, drones, robots, defense technologies. So when you're, viewer at home, when they buy their Tesla or their iPhone, inside that device or car is a magnet that was made in China. And we simply want to move downstream. That supply chain today is all in China. And we want to make sure that the Teslas and Apples of the world have an option to buy from an American company so that they can have some diversity of supply chain. And that's the mission that we're on. Our mission is to restore the full rare earth supply chain to the United States of America. And obviously we have an equitized balance sheet and a profitable business, and we'll continue to move downstream. Our next step is separated rare earth products, and then after that, magnetics.
Yeah, I mean, to that point, even if you do mine them in Mountain Pass, you still have to send them to China for final processing, which does beg the question of how independent you can really be from China. We had the administration, or President Trump specifically, sign an executive order last month calling for a national emergency, essentially trying to boost production in this particular area. How much do you think you can move the needle on that?
Well, we're 15% of the global market of content today. We're the second largest producer in the world. So we think that the key thing is that we don't need to take over the industry. We just need to be a stable, strong source of supply so that it really does remain competitive. The Chinese have very thoughtfully taken over this industry over the last 20 years, and you can see it today. Look at the public markets. You see a lot of Chinese electric vehicle makers. The auto supply chain is the single largest private employer in our country. It's 10 to 14 million jobs, hundreds of billions of dollars of GDP. And 25 years ago, the Chinese didn't have a rare earth industry or a magnetics industry or an EV industry. Now they've got it all. And so if we want to make sure that we have supply chain end to end, we're going to need some Western champions in this space. And that's the mission that we're on. We have to be that. And again, we don't have to be all of it. We just have to be a big player, and obviously having an NYSE listed company that is transparent, and we have a remarkable board, so we think that that's a great thing for American industry.
And James, the national security questions that are raised here kind of reminds me of the positioning in oil too. When you think about how dependent the U.S. was on the Middle East for that, obviously there was a big push into changing it. Now fracking here has changed that story completely. But there is a question about pricing and what pricing pressures was placed on crude here too. So on that front, I mean, if you guys are successful in really driving production here in the U.S., what do the pricing pressures look like if it changes the dynamic between the U.S. having these options here and what China's been offering?
So that's a great analogy. There's a famous quote from Deng Xiaoping, the former ruler of China. The Mideast has oil, China has rare earths. And if you think about it, and there was an Economist cover story on this maybe a couple months ago. When you think about petrostates like Saudi Arabia, the new electrostate is China. They have very thoughtfully taken over this supply chain. And so now as we think about the fact, and with this new administration, we're talking about climate change, and if you look at Elon Musk talking about going from 2 million to 30 million EVs manufactured globally over the next 6 or 7 years, the entire, a significant portion of the industrial landscape is getting electrified. And so, strategically, this is happening. And so, China is the electrostate. They control the supply chain. And so that's what makes a company like ours so strategic. And when it comes to pricing, we need to compete. I mean, I'd love for American companies to want to pay us big premiums because we're American, but that's just not the realities of the market. We need to compete. We need to be a low-cost producer to the world. We're one of them. We're profitable, even just making an intermediate product at today's prices. And by the way, we have the added attribute of, we're right in the state of California, so we're environmentally friendly. So for those who do care about sustainability in the supply chain, we've got the best attributes from an environmental standpoint of any rare earth operation in the world by a landslide. So we think that positions us for success. But to be clear, we need to be a low-cost producer. We need to make sure that industry can come to us and that they feel like it's a thoughtful business decision to come to us. We're not a charity.
James Litinsky, the CEO of MP Materials. It's good to talk to you today.
Thank you. It's great to be here, and we appreciate it. It's a great day for MP, and we'll get back to work tomorrow.
All right, congrats once again. Appreciate you joining us. We're going to shift gears here. Coming up after the break, the NBA draft is tonight, in case you forgot, and there is one company doing its part to help teams identify perhaps the best talent out there. You've heard of IQ. But what about Athletic IQ, the test and the company behind it? We'll chat with the CEO and founder right after this. Welcome back to Yahoo Finance Live. Of course, tonight kicks off the NBA draft. It's a big day for a lot of athletes out there, especially in a world where we didn't have any March Madness games to watch some of these potential draft picks earlier in the year. So it raises questions about how teams are going to be assessing these would-be draft picks. And one of the companies out there helping them do just that is a company with a new test called the Athletic IQ test. It comes from Athletic Intelligence Measures. The co-founder of that company, Scott Goldman, joins us now. And Scott, appreciate you being on here to chat about this. I mean, we were talking about, obviously people know IQ tests, but talk to me about what your company, which we should mention, did over 7 figures in revenue here. You work with teams in the NFL, the NBA, the MLB. A lot of teams out there turning to you guys to measure some of these players. So what do you learn from something like your Athletic IQ test?
Yeah, so it's interesting, right? Because a lot of times you'll hear people talk about, oh, he's got a great basketball IQ, which really they're referencing knowledge, like the guy knows the game. If you think about intelligence in its truer sense, intelligence is really about problem solving and puzzles, right? So I always describe sports as an unsolvable puzzle in a chaotic situation. So the AIQ has been used by the teams to help people understand how players acquire, process, and apply information in lifetime scenarios and situations.
So Scott, when you look at the sports landscape right now, so much of it is very data driven. We're talking about sports analytics and in basketball, baseball. And so when you look at your measurement, how does that fit into that? If we're talking strictly these owners and GMs looking at the numbers, where does the IQ fit into the calculation?
Yeah, no, great question. So it's pretty cool because compared to personality, intelligence is a genetically stable trait. And across a lot of different professional domains, it's one of the greatest predictors of success. So, for example, with our database, we've been able to do some analytics because, again, of that stability that intelligence is, a genetically stable trait. And we have found statistically significant scores regarding, so just NBA alone, people who score higher on the AIQ tend to make it to the league. People who score lower, they either go G League or overseas. Similarly, in the NFL, we have found statistically significant correlation with on-field performance, like rushing yards and running backs. We just discovered a new one where offensive linemen and false starts. And then with Major League Baseball, we have found statistically significant correlation with on-field performance with like batting averages and ERA.
Yeah, I mean, Akiko's mentioning the importance of data here, but I imagine it's even more important in the year 2020 when I said we don't have March Madness. We don't know what these players are going to do at the peak of the pressure moments, playing out in March. We didn't get to see that. So in your discussions with GMs and teams now, how much more of a premium is being paid to learn about people like this, athletes like this at the top level ahead of draft day?
Yeah, so it really becomes an interesting thing, right? Because when you're studying game film, you got to kind of figure out, well, how does this game translate to the next level? And when the game's faster and the guys are bigger and stronger, how will this individual calibrate? And so sometimes what we're doing is we're providing more clarity on the signal and helping them eliminate the noise when it comes to that decision making. So for example, let's say you're dealing with a big, and you're going, gosh, I noticed that his offensive rebounding and his defensive rebounding statistics are very different. Now, to fans like you and I, it's like a rebound's a rebound. But most NBA experts and most basketball aficionados would tell you, like, offensive rebounding and defensive rebounding is very different. So when you see somebody who can do one side of the court but not the other, and they're trying to kind of understand that becomes a question. And that's where the AIQ data comes in, because some of the cognitive demands of an offensive rebound task versus a defensive rebound task can be quite different.
I mean, without giving away your secret sauce, how do you measure that?
Yeah, so my partner and I, his name's Jim Bowman, and an incredible human being and a really great ally to have developed this thing with. We followed the American Psychological Association's ethical guidelines for test construction. So it took us about 15 years before we even brought it to market. And what we did was we used a theory of intelligence called the Cattell-Horn-Carroll theory of intelligence, which is the predominant theory of intelligence used for most intelligent testing. So, if you're looking at diagnosing learning disabilities or giftedness in school settings, you're using that CHC theory. So the Wexler scales, Stanford Binet, Woodcock Johnson. Now, what does that look like to the player? What we did is we put it on an iPad. And the best analogy I can give you is it's kind of like you're playing a series of games like Tetris or almost like a Where's Waldo task. It's kind of stuff like that. And most of the players, that's what they'll say. The two things we hear most is, wow, that was really hard. Because again, we're trying to differentiate the best from the best. And that was really fun. Like they like the fact that we're not asking questions like, do you like dogs or cats? That we're actually putting them through challenges.
Yeah, and it's a test coming from two clinically trained PhDs as well. So we should stress that here too, that it's not just some questions thrown together. A lot of money went into it. But I appreciate you coming on here to chat. Very interesting stuff. Scott Goldman, Athletic Intelligence Measures co-founder. Thanks again, and good luck on draft night. Thanks
for the time. Really enjoyed the conversation.
All right, Zach, coming up, we're going to be talking about Apple and some changes in the fees for their app store. We'll have much more on that story and another market check on the other side of the break. Welcome back to Yahoo Finance Live. Shares of Apple trading pretty flat, up about 0.1% in the session today. The company earlier announcing a new fee structure for their app store, specifically the commission the company takes, slashing that in half. Right now it's 30%, cutting that to 15% for the smaller developers who make less than $1 million in sales. And Zach, this is obviously a response to the pressure that Apple has faced for what a lot of lawmakers have said is anti-competitive behavior by them taking that 30% cut in the App Store. But you have to wonder, in the context of these discussions about whether tech should be reined in a big way. I mean, this is just one example of a company that's responding even without any kind of regulatory crackdown.
Yeah, that's true. I wonder how much of it is just because they want to get out ahead of what crackdown might come, because that's something we've seen tech companies do before, is kind of this idea of, oh, we'll self-regulate. Hopefully that's going to appease the regulators and we'll get away with that. Because keep in mind, this won't affect the split fees paid by some of the bigger companies. If you look at a Spotify or a Netflix or other companies like that are above that $1 million threshold you're talking about. But yeah, it is interesting because in the eyes of the regulators, what they're all talking about is protecting some of those smaller businesses from the undue pressure of what could be a monopoly and a tech giant putting pressure on some of the smaller guys. And so this would at least address some of those concerns in smaller businesses, those doing below $1 million in revenue. But you're right, it does still add the question of if regulators are going to be pleased with this step, or perhaps maybe come out on the other side and say, look, it's not going far enough.
It does make me think about what we hear a lot in Silicon Valley in the context of what happened with Microsoft, which is that the trial is the remedy, that even if there is no real breakup of any of these tech companies, the applied pressure, both from lawmakers and publicly, will ultimately rein in some kind of anti-competitive behavior that some allege these companies have been engaged in. And, look, Apple will probably say this, no, this is just a long time coming. This is something we've been considering. But you do have to wonder if that pressure has been building up for the company. 15% certainly, that's a pretty significant one. If you look at some of these smaller developers who are looking to get real estate within the App Store to try and build out their sales.
And let's not forget, too, a lot of that pressure, too, came before the hearing that we saw Tim Cook at from Basecamp, the CEO there, talking about all this. Their app was taken off the App Store because of questions he was raising around that front. Some of it got resolved, but even he was out tweeting today saying, look, this doesn't go far enough to address the monopoly power that Apple wields over developers and the pressure that they still have in saying, look, we need us, you got to pay us first before you can get access. I think that's a big question that still remains to be solved moving forward.
Yeah, no question about that. We are wrapping things up here in our hours, but before we go to break here, the Dow pairing some of the gains that we've seen in this session, now up of only about 9 points, and the NASDAQ up 27. We've got a lot more coming up here on Yahoo Finance Live. Keep it right here.
Welcome to Yahoo Finance Live. I am Kristen Myers. It is 1 p.m. Let's check the markets right now. All three major indices are in the green. The NASDAQ actually had been lagging a little bit earlier today. It flipped into the green. Now the leader on today, up roughly 0.25 percentage point. Over at the S&P 500 and the Dow, however, fairly flat right now, less than 0.1 percentage point for the both of them. Looking over on a sector basis right now, we are seeing industrials and financials both leading today, up roughly 0.75 percentage point. But health, utilities, consumer staples, and real estate all in the red right now. Healthcare, actually the worst sector on today, down 0.8 percentage point right now. Again, as I had mentioned a little bit earlier, Dow is fairly flat right now, had been the leader on the day earlier, as it looks like Boeing is going to be seeing their 737 MAX planes in the air again. And we do have some positive news on the vaccine front. Pfizer saw Moderna's 94.5 efficacy rate and decided to raise them to 95%. So let's look over at Pfizer right now. Pfizer in the green, up 1.5% right now. And as I mentioned, Boeing going to be seeing their planes in the sky again. That was after nearly 2 years of having their 737 MAX planes grounded. Well, the FAA, that's the Federal Aviation Administration, has now given them the green light. Boeing right now up about 0.25 percentage point. I want to look over, however, at Tesla. They are having a great day today, up over 8.5% right now. Of course, Tesla was added to the S&P 500. They will be joining that index, of course, starting December 21st. And they also received a raise in their price target by Morgan Stanley to $540. So a nice little boost for them there. They're standing right now at roughly $479, just over $479. I want to talk now about the coronavirus, of course, on the backs of that vaccine news, because this vaccine is needed now more than ever. We have nearly 11.4 million cases of coronavirus in the United States, and we are just shy of 250,000 deaths. This is all according to the Johns Hopkins University COVID tracker. Nearly 249,000 Americans have lost their lives. We have Yahoo Finance's Anjali Kemlani here with us now for more details on this pandemic. Hi, Anjali. Hey, Kristen. Yeah, so as you noted, we got the great news from Pfizer about its results for that vaccine candidate. So now we have two very effective vaccine candidates on tap, ready for emergency use authorization review. And we know that the FDA is planning to go through the process and make sure that, in fact, everything does line up and we do have these two vaccines ready to use. Of course, the two main differences being that Pfizer's does have that ultra cold chain problem. Meanwhile, Moderna's has just one sort of manufacturing partner, even though it requires a less colder temperature. So really going to be interesting to see where they all get distributed and how that happens in the process, but still waiting to hear more. No adverse events from Pfizer, so that's really good news. And they did see that the vaccine was effective in older individuals, which of course is a priority population. Meanwhile, looking at it from the greater perspective, because of no vaccine, we're still looking at states weighing lockdowns, weighing restrictions, weighing curfews, and debates about which of those strategies are in fact effective or not still going on while we lack any sort of national strategy. But that national strategy, even with an incoming Biden administration, is unlikely to include a national lockdown, according to one Biden advisor who we heard from earlier today. Take a minute to listen to that.
A national lockdown or shutdown is simply not on the table. The president-elect has no intention of implementing a national lockdown. There may be some differences of opinion on the advisory board, but the consensus on the advisory board is also that we do not need a national lockdown is not indicated here.
So as you can hear, not on the table. That's a little bit different from when we heard last week when one advisor said there could be a short period of lockdown. So definitely looking at what actually ends up happening. But mask mandate definitely on the table, and that's something that we anticipate seeing very shortly. It's important to note, of course, that the Biden administration has not, or the transition team has not had access to any of the officials to clarify or get any other insight in terms of the vaccine specifically and Operation Warp Speed. There's a call going on right now with Operation Warp Speed officials, but we have not heard much about the distribution just yet, just that there are plans. Important point to know about that. CDC Director Dr. Redfield is an individual who would be involved in that process, and he unfortunately declined to come on Yahoo Finance today. Kristen, back to you. Thanks so much, Anjali. I know you and I were both very excited to chat with the CDC director, so hopefully he'll be able to join us in the coming days or weeks. But I do want to continue this conversation, and now we're joined by Dr. Dara Kass, Yahoo medical contributor and an associate professor of emergency medicine at Columbia University. So, Doctor, I want to kind of pick up on something that Anjali just said, which was about those mask mandates. And I feel like I consistently repeat this question to every doctor that I chat with. Everyone is saying, of course, we need to wear masks, we need to wear masks, we need to wear masks. But we don't have a mask mandate as yet. I mean, I'm seeing folks that are in Congress calling masks oppressive. So I feel like we have to kind of put the whole everyone needs to wear masks to the side. I'm wondering from you that if we continue on the path that we are currently on, where we have almost 11.5 million people in the United States testing positive for coronavirus, do you think that lockdowns are going to be the only thing to keep people safe? We just heard from Dr. Celine Gounder saying, there might not be necessary, but I just keep seeing these cases surging all around the country. And I'm sure many folks like myself are feeling a little bit nervous and anxious to see these numbers.
So I think that what Dr. Gounder said, and I think what's consistently coming from the Biden administration, is that it's about leadership and data that will get us out of this pandemic. And so what I mean by that is that we need to have real numbers against why we would close certain businesses and keep others open. For example, we know that there really isn't a lot of transmission in schools. And so a lockdown across the board would only have to happen in communities that had such large viral spread that their schools would be unable to protect their students. What we need to know is, what would the positive test rate have to be? What would the number of tests per day have to be? And with the mask mandate, what's very interesting is that this is purely a leadership issue. There is no conflicting science about whether or not masks work. We know they work not just to protect the person wearing the mask from spreading the virus, but also from protecting the person wearing the mask from getting the virus, or more importantly, getting a severe form of the virus. So what we'll see with the Biden administration is a national mask recommendation at federal spaces, and then obviously the partnership, I think, with local officials to continue to reinforce mask wearing in their local jurisdictions, knowing full well that it's going to be up to the local communities to reinforce mask wearing and to really show leadership at the community level, at the school level, and at the elected official level to keep masks front and center as we get out of this pandemic with the therapeutics and the vaccines that are coming, our way.
Now, as I mentioned, we're standing right now at a daily case count of 11.4 million. And every day on this show, I share the numbers of those daily case counts. And it was under 10.6 million on Friday, less than a week ago. And we've seen a huge jump. I'm wondering, as you're seeing, looking out across the country, do you think we're going to get to a point where this virus really starts spiraling out of control? Or would you describe this as a spiral already, where we start to see these numbers? I mean, it's almost unthinkable to me that we're seeing these numbers jump 100,000 cases a day. But I kind of want to know, how bad could it really get going forward?
So honestly, we don't know. This is really unfathomable to those of us, especially those of us that were in March and April in New York City, and we were dealing with 20, 30,000 cases a day and really felt like we were at our breaking point. The idea that we have let ourselves get to the point of 100 to 200,000 new cases per day, with a death rate right now seeing between 1,000 and probably up to 2,000 deaths per day, and really not interested in doing much about it at the federal level, is astounding to those of us that are watching these cases on the ground and feeling the personal effects of this virus. I don't know what our threshold is for tolerance for suffering and death under this current administration. I do know that things will change come January 20th, because new leadership will enforce new restrictions and, more importantly, new guidance about what we need to be doing to get ourselves out of this pandemic.
So you, of course, are an associate professor of emergency medicine, and we've heard a lot of talk around hospitals, emergency rooms, of course, that they are going to be getting inundated. I have friends that are doctors that are telling me, and they work in pediatrics, that their children's hospitals are now having to take on adults because the adult hospital, those beds are becoming filled. What does a worst case scenario really look like going forward between now and, as you mentioned, January 20th, when we're going to have a new administration?
And remember, there's no light switch that happens January 20th. On January 20th, we'll see the beginnings of new leadership, which will hopefully start to take effect between 4 and 10 weeks later. But it's not going to happen overnight. Unfortunately, when we need hospital beds, we take them from where they are. And so we've seen the conversion of children's hospital floors to adult hospital patients. The worst case scenario is one where you go to the hospital for actually something unrelated to the coronavirus or the coronavirus in a critical illness, and there is no bed for you.
right? You go there, you need to be intubated. Maybe you are having a heart attack or a stroke, or that's your family member. And you get there and there's no more room, because the patients who get sick with this virus stay in the hospital for a very long period of time, even when they survive. It's been very poor messaging from the beginning to act like just because this virus didn't kill you right away, it somehow wasn't a stress on the system or the patient. It is a devastating virus, even for those who survive. And we need to not forget that as we head into the winter and see our hospital systems get stressed.
You know, I would be remiss if I didn't ask you about the vaccine. Roughly 95% efficacy rate across both the vaccine candidates from Pfizer and also Moderna. Wondering if you can share some thoughts, if you are enthusiastic, optimistic looking forward, or do you have some questions even in the back of your own mind, since that data has not really been released yet in a peer-reviewed journal? It's just coming out to us in press releases right now. And of course, there's a lot of concerns and questions about what the rollout is going to look like.
So I think that we've all learned now that press releases are not peer-reviewed data, and that we need the data to really understand what those numbers mean. But those numbers are encouraging. And more importantly, Pfizer and Moderna and the other vaccine companies have really walked the walk. They put out a process and they're following the process. This is happening faster than any other vaccine development ever before. But part of that has to do with the investment in not just the production, but in the pre-purchasing of the vaccine doses, and also in the pandemic itself. The number of people that were exposed to the virus in phase 3 has happened at an extraordinarily fast rate. I am very encouraged by this data. I think that it's a new vaccine process. Seems to be a really good fit for this particular virus. And I think that we're going to see encouraging data with a great safety and efficacy profile. The delivery is going to be complicated. Obviously, both of these vaccines need cold storage and are harder to distribute than a regular room temperature vaccine. But I am encouraged by this information. And I think it means that there may be a light at the end of the tunnel for all of us. And we just need to stay the course through the rest of the winter.
All right, Dr. Derek Haas, Yahoo medical contributor. Always great to chat with you. Thank you so much for breaking all of that down. All right, well, coming up, the Trump campaign is going to be shelling out money for a partial recount in Wisconsin. We will be talking that next. Welcome back to Yahoo Finance Live. Checking market action right now. All three major indices remain in the green, with the NASDAQ up 0.25 percentage point right now, the leader on the day. S&P 500 and the Dow up
roughly a 1/10 of a percentage point just underneath that level. But let's check in now with the presidential elections. Today was the deadline for the Trump campaign to file for a recount in the state of Wisconsin. We did get news a little bit earlier today that they have decided to do so. We have Yahoo Finance's Jessica Smith here with more details. Hi, Jess.
Hey, Kristen, the Trump campaign is seeking a recount, but only in 2 counties in Wisconsin. They are focusing on 2 heavily Democratic counties. That's Milwaukee and Dane. Dane is home to the city of Madison. The campaign says that this is where the worst irregularities are, though there's been no evidence of any wrongdoing. And election officials have said that the election ran smoothly and there's no reason to doubt the results. This is costing the Trump campaign about $3 million. This recount could start as early as tomorrow, but has to start by Saturday, and then it has to be completed by December 1st. President-elect Biden won Wisconsin by more than 20,000 votes, and recounts historically have not changed that many votes. And if you look specifically at the 2 counties where the Trump campaign is seeking this recount, Biden received more than 364,000 votes than President Trump. That's a pretty huge gap to overcome, and legal experts don't expect this to significantly change anything. There have also been some developments in Michigan. Yesterday, officials in Wayne County, Michigan's most populous county, which includes Detroit, backtracked and did certify its election results yesterday. That twist came just a few hours after they were deadlocked and decided not to certify more than 800,000 votes. They were deadlocked along party lines, but Republican members of the Board of Canvassers initially blocked that move, saying there were discrepancies in the poll books. There was immediate outrage about this from both local and national leaders, saying that Wayne County Republicans were not listening to the will of Detroit area voters. Detroit is a majority Black city, so we heard many people saying that this was a racist decision that disenfranchised Black voters. President Trump, on the other hand, tweeted saying that the deadlock was a beautiful thing. Ultimately, the officials did agree to unanimously certify the results with a promise of a comprehensive audit. Kristen?
All right. Thank you so much, Yahoo Finance's Jessica Smith. I want to continue this conversation now about what Jess was just talking about, that about face in Wayne County, Michigan, which, of course, as she just mentioned, does include the city of Detroit. Now, of course, they did certify those election results after Republicans originally held up that certification. We're joined now by Jonathan Kinloch. He's the vice chairman on the Wayne County Board of Canvassers, and he is one of the Democrats on that panel. Jonathan, you're going to have to unmute yourself here so we can chat. But I first want to start with reading some tweets from President Trump this morning. He said, quote, "The numbers have not improved. It is still 71% out of balance." Stated Wayne County, Michigan canvassers. There's widespread irregularities in poll numbers. There are more votes than people. The 2 harassed Patriot canvassers, so he's referring to the Republicans on the board, refused to sign the papers. He then went on to tweet, "In Detroit, there are far more votes than people. Nothing can be done to cure that giant scam. I win, Michigan." And I see that we just have lost, actually, Jonathan Kinloch. Again, he was the vice chairman on the Wayne County Board of Canvassers. We're going to try to get him back on the other side of a quick break. Welcome back to Yahoo Finance Live. Apologies for some of those tech difficulties that we had just before the break. We have Jonathan Kinloch back with us again. He is the vice chairman on the Wayne County Board of Canvassers. He is one of the Democrats on that panel. So Jonathan, just before we lost you, I was reading some tweets from President Trump a little bit earlier, where he essentially is alleging that there is fraud in Wayne County and specifically in the city of Detroit. And I'm seeing again that we have lost Jonathan Kinloch, it looks like. So I'm going to just move on here to our next guest and let's chat about what we are seeing today in the markets. Again, all three major indices are in the green. So we are joined now by Aneta Markowska. She is the Jefferies chief financial economist. So Aneta, you were seeing today that markets are fairly flat, even though we have improved efficacy news about the vaccine. And you're going to have to unmute yourself here. I'm wondering from you if all the good news on the vaccine has already really been baked into this market. And what do you see as the next catalyst here for the market? Is it going to be once the rollout happens?
Yeah, I would say, the bulk of the good news has been discounted already. I think the market's actually in a little bit of tug of war at the moment between the near-term downside risks to growth, stemming both from, the withdrawal of fiscal support and obviously the COVID resurgence. We've already seen some loss of momentum in retail sales data, and I think there's a good chance that slowdown continues. Holiday shopping surveys suggest that it's going to be a rather weak holiday shopping season. So I think there's a lot of negative near term, and I think the markets are struggling a little bit with, kind of what time frame to focus on. And I think ultimately the answer depends on what market you're in. I think if you're, looking at the equity market, I think there's a good chance that equities will look through that near-term weakness and look toward the vaccine and the post-vaccine economy. I think the rates market is a little bit different because, any kind of short-term setback in terms of growth will weigh on the Fed's decisions, at the very least delaying, the taper and maybe even pushing the Fed to do a twist. So, if we do get this near-term slowdown, actually it might end up being a little bit of a blessing in disguise from the investor's perspective, in that it sort of takes this risk of a sharp disorderly backup in yields off the table for now.
Now, Annette, I was reading your note, and I thought you put it pretty nicely, saying that we're seeing a tug of war right now in the markets. I know you were just describing a little bit what we're anticipating between now and the new year. Wondering what you're anticipating into, looking a little bit farther out next year, especially once we do see that vaccine really start to get distributed to many Americans.
Yeah, so I think, obviously you're going to see another reacceleration in growth. I expect growth to average about 4.5% next year. So that's a little bit higher than consensus. And I think that will really start to kick in the second quarter. And I think within that, you're going to see a significant rotation, right, out of sectors that really drove the early phase of the post-COVID recovery, and that was consumer and retail in particular. And I think that next leg up will be the post-vaccine leg up will be driven by service spending and kind of more traditional early cycle spending, which, I think will be certainly supportive for industrials, materials, and your more typical, cyclical sectors.
I want to ask you about tech right now. And this is something that we have been chatting about a lot lately. We have seen some rotation out of that sector. And of course, every time we get some positive vaccine news, we see some of those really big tech names taking a hit. Right now, we are seeing Facebook and Alphabet, the parent company of Google, in the red. Twitter, however, is up. Pinterest, we see up. Apple right now is also in the red. So pretty similar to what we've been seeing every time some of those vaccine news come out. Do you think that what is the future as you're anticipating it for some of those big tech names? Do you think that they will continue to be under pressure, or do you think that who's going to be the next leader in this market?
So as I mentioned, I think the leader is going to be the more traditional cyclical sectors, right? The vaccine means that we're going to see some kind of normalization in service spending. And obviously the goods economy has been a huge beneficiary of COVID. So you have to assume
at the very least, that goods demand just stops growing, and maybe there is even a little bit of a payback effect as we've pulled forward a lot of that demand in terms of consumer goods and retail. So I do think those sectors are at risk, or at the very least, they're not going to be kind of the main growth driver. So I think, a lot of it is going to be in the service economy, which is not necessarily represented in the market. But I think within the market, I mean, obviously airlines, hotel chains, restaurant chains, I think those are the types of sectors that will, clearly benefit. I would also say that, within the goods economy, although consumer demand is slowing and clearly losing momentum there, retail inventories are still at incredibly low levels, lowest since the 60s. So even if consumer demand slows, I think there's still a lot of production that has to happen just to rebuild and get back to more normalized inventory levels. So I would say, that our theme is sort of short the consumers, but, kind of move over to the producers, because I still think there is quite a bit of upside there.
And just before this conversation, we were talking with a doctor about coronavirus right now. As I mentioned, roughly 11.4 million cases in the United States right now. And as she's seeing it, it's going to be getting worse, especially as we don't have any mask mandates. We're seeing this virus surge across the country. Now, I know that we have not one, but two vaccine candidates, and their efficacy rates have blown everyone really out of the water here. But how much of a headwind are you seeing the virus continuing to play, not just on this market, but honestly on the US economy right now, over the next several months until we do get that vaccine start to be rolled out to most Americans?
So we track a lot of high frequency data, and so far we have not seen really any material impact from this latest wave of COVID infections. I think it's going to come down to government mandates and to what extent, do they roll back the reopening measures? That's where the real risk lies, because I think the consumers can sort of adjust and function in this, maybe more risky COVID environment. But if governments force businesses to shut down, obviously you will see another wave of layoffs. So we're not quite there yet, but it's obviously a risk. It's just, I would add that this is happening at a time where that fiscal support, which really drove the early phase of the recovery, is being withdrawn and prematurely. So even without this wave of COVID infections, I would say that there is downside for consumer demand, through January probably, and the COVID situation certainly, kind of creates further downside risk. But, and you mentioned the vaccine efficacy is high, and that's obviously fantastic news, but that really hasn't changed the time frame, right? The expectation is still that, we won't get to mass vaccinations until the spring. So we still have this period of 3 to 6 months that we have to get through. And the next 3 months in particular, are going to be challenging.
All right, Annetta Markowska, Jefferies Chief Financial Economist. Thank you so much for jumping in and joining us to have that conversation, even though it was a little bit earlier than we had anticipated. Thanks for talking with us today.
Thank you.
All right, well, Yahoo Finance will be right back after a quick break.
Welcome back to Yahoo Finance Live. Checking market action, the S&P 500 and the Dow have now both flipped into the red, down roughly 0.08% for the S&P 500 and down just over 0.1 of a percentage point when looking over at the Dow. So right now, the NASDAQ is the only major index right now in the green, up roughly 0.1 of a percentage point. Materials, financials, and industrials continue to lead today. Industrials, the leader, up roughly 0.75 of a percentage point. So we're going to try this once more again with Jonathan Kinloch, who is the vice chairman of the Board of Canvassers in Wayne County. He's going to be joining us now by phone from Detroit. Jonathan, thank you so much for hopping in and dealing with all of those technical. So I know you heard some of the tweets from President Trump earlier, where he was alleging fraud in Wayne County and specifically even in the city of Detroit. He mentioned that 71% of the votes were out of balance. So just to throw it over to you, are the votes out of balance? And are you guys seeing evidence of fraud in the county?
Absolutely not. And President Trump and his description of what occurred in the city of Detroit, in the state of Michigan specifically, is totally not true. When you speak about a precinct being out of balance, we're talking about most likely clerical errors as relates to how individuals closed out the night, how individuals basically notated issues that they had inside of the particular precinct. It's not that votes were not tabulated and that it's not that votes weren't counted or that weren't supposed to be counted or any of those things that they're claiming. Dead people voting, all those allegations have been found to be unsupported. And it's just that the president and his team failed to recognize the fact that they lost the election in the state of Michigan, and they are attacking the Black vote in Detroit and elsewhere around the country because they knew that was a place that his base would likely expect these challenges.
Now, Jonathan, I hear what you're saying, but 70 or 71% of votes out of balance, does that not at all cause any level of concern? It does seem like a pretty large number, or is this kind of pretty typical with elections, that you're going to see this sort of mismatch in the ballots and in the votes?
It's not about the ballots. We're talking about when you say a precinct is out of balance, you're talking in this canvas, and he's absolutely wrong. There's no comparing the August primary to what we saw in the general election. Absolutely no comparison. The issue that we're talking about is probably around 438 ballots, 436 ballots that we're talking about that are questionable. That's what we're talking about. Out of 800,000 ballots that were cast in Wayne County. So we're talking about individuals not notating properly when ballots were jammed inside of the tabulator. They did not notate. They may have ran envelopes twice through the machines. So we're talking about just human errors. We're not talking about fraud. We're not talking about corruption. We're talking about the typical issues that are seen in every election across America. And what he's doing is playing with people's lack of understanding of election processes. And at the top of the individuals who don't obviously understand how elections are run in this country is the President of the United States of America.
All right. So we talked a little bit earlier at the show about that recount in Wisconsin, the president asking for a partial recount there. And, when the Republicans on the Board of Canvassers failed to certify the result, you called it reckless and irresponsible. I'm wondering if you think that Detroit voters are being undermined by all of these allegations of fraud that are being levied right now by President Trump and a lot of his Republican allies. Let me say this. They never have had a respect. I think his entire life he's never had any sort of respect for Black people. And I'm going to say that from the way that he has treated them as employees to the way that he's made statements, or his lack of willingness to push back against white supremacist organizations. So no, this president and his base has continued to disregard Black folks' contributions in this country, and more importantly, our involvement in this election. They are, if you look at what they're targeting, where they're targeting places where there's no humanly chance possible for them to actually gain any doggone realistic votes that would turn or change the outcome of the election. They are actually focusing in on Black and communities in every one of these places where they're saying that they have issues with the election votes. So no, I believe that this is not. This is just more fanning the flames of division in this country. Is building up what I believe a point of him acknowledging the fact that he lost the election and sort of keeping him ready and mobilizing his people for a possible run in 4 years. That's all that I believe this is about at this particular point. He knows he has lost this race.
All right. Well, strong words there. Jonathan Kinloch, Vice Chairman on the Wayne County Board of Canvassers. Thank you so much for joining us. I'm glad we were finally able to have that conversation.
Thank you. I appreciate that. And I look forward to talking to you soon.
All right. Well, let's talk China now. It has been a while since we focused on the U.S.-China trade deal. We're joined now by Dan Blumenthal, Director of Asian Studies at the American Enterprise Institute and author of the book, The China Nightmare, The Grand Ambitions of a Decaying State. Dan, thank you so much for joining us. You know, it seems that all we were talking about in 2019 was the U.S.-China trade deal. Every single day, it was at the time the main focus of our conversations, and also the cause of huge market swings, both to the upside and to the downside. I'm wondering if you think that the Biden administration is going to be placing the same kind of priority on the relationship with China that we saw from the Trump administration.
Well, I think they absolutely will be putting the same priority on China as the Trump administration. It is by far the most important foreign affairs question in this country. And the President-elect Biden has talked about it very much in his campaign. No less tough rhetoric than President Trump. Maybe a different focus, maybe some more areas of cooperation, but there's no question that it'll be on the top of his foreign policy priorities.
So then to that point, what do you think we can expect from a Biden administration, at least moving forward on this point of the U.S.-China trade deal? I know that you say that he's not going to be less tough than President Trump was, but what do you think we can expect from that relationship after January 20th?
I think there'll be more policy stability on our side, so we won't see tweets that define the relationship. But substantively, I think many of the tariffs will stay in place, maybe a bit of a reduction across the board tariff, maybe more targeting of tariffs. Technology policy, I think many of the export controls that we've attempted to put on our companies selling to state-owned enterprises in China like Huawei remain because their security concerns, their competitive concerns. I think technology policy, the intersection of national security and technology policy will continue to define our relationship with China.
If you had to look in your crystal ball, Dan, do you think that 2021 is going to be the year that we get a U.S.-China trade deal signed, sealed, and delivered?
I don't think so. I don't think 2021 will be that time. And there's a number of reasons for that. First, the Chinese economy is doing better than it was at the beginning of COVID, but still is not doing very well. Our economy has to recover as well. I don't think the political appetite for a big trade deal will be there. I think fixing things around the margins, how many tariffs are imposed, what level, what the technology policy and restrictions look like, that'll all be in the cards. Some kind of climate change deal, some kind of energy deal. I don't think a comprehensive trade deal is in the works in 2021.
So then when? 2022? Do you think that Biden will be able to pull it off in his 4 years in the White House?
I think he will fix certain things. I think he will reduce tariffs in exchange for greater purchases of agricultural items. I think he's going to pivot to see how to leverage trade deals and leverage the tariffs to get Xi Jinping, the Chinese leader, to agree to certain climate pledges. But a comprehensive trade deal in this environment, it's hard to forecast exactly when that would come. I think the phase one deal is effectively over.
So Dan, I'm hoping you can kind of give us some insight from the other side, which would be from the Chinese. Do you anticipate that they'll perhaps react to this new administration any differently? And do you think that President Trump has caused some damage to the U.S.-China relationship? We've seen this, kind of improving, but also weakening of the relationship between the United States and some other countries. Wondering how you think the Chinese are going to react.
Well, the Chinese do view us, no matter who our president is, as their chief rival for geopolitical power in terms of the economic and technological competition. So structurally, it's going to be difficult for that to change. I think they're looking more forward to a Biden administration because he's a known quantity and his advisors are known quantities. I think they'll see more predictability. I don't think, when reading the Chinese press, I don't see anyone who thinks that the relationship will be better, more stable, more calm, but not better. Not better in terms of our pushback on the military front, our pushback on the trade front, our pushback on the IP front. One area of cooperation that they're looking forward to is in climate change, perhaps some other issues in terms of reduction of tariffs, perhaps some non-proliferation issues relating to North Korea.
Dan, last question for you here. I'm hoping you can kind of expand on something that you have in your notes, but you also talk about in your book, which is the fact that a, quote, decaying China creates a nightmare scenario for the United States. Can you explain briefly what that means?
Absolutely. So what I say in the book is that China is actually under a lot more political pressure than we see back here in the United States. And a lot of their activity, including large embarrassment over the handling or mishandling of COVID-19, letting the epidemic spread to a pandemic, has put pressure on Xi Jinping. And as a lot of their institutions are, in fact, in decay because Xi Jinping has so centralized them. Decision-making is paralyzed. So what he's doing in response, Xi Jinping, is being more aggressive internationally to distract from some of these problems. It's a nightmare for us, as we've seen with COVID-19. They are unable to contain these epidemics. It affects all of us. And then instead of looking inward to try to solve their problems, they've been lashing out, as we see in Australia, in Europe, in Taiwan. And that's really a nightmare, very difficult to deal with a frustrated great power.
All right, Dan Blumenthal, Director of Asian Studies at the American Enterprise Institute and author of the book, I want to get the title right here, The China Nightmare, The Grand Ambitions of a Decaying State. Dan, thank you so much. Absolutely fascinating conversation.
Thank you so much.
All right, well, coming up next after the break, it will be our Funding Our Future segment. welcome back to Yahoo Finance Live. Taking a look at the markets right now, all three major indices are now in the red, with the Dow and the S&P 500 even right now, down 0.2 of a percentage point, with the NASDAQ down just under 0.1 of a percentage point, or just should say just over a 10. All right, I want to talk now about this coronavirus pandemic and how we have seen employees, of course, needing emergency savings. Well, UPS, of course, the shipping giant, is partnering with Commonwealth to essentially help employees save for emergencies. We're joined now by Nick Maynard, Commonwealth Senior Vice President for this Funding Our Future segment. So Nick, I know that UPS is essentially allowing their employees to save money in this emergency savings initiative for about 100,000 of their employees. I'm wondering if you can explain really how does this all work? I know it's within the 401k scheme.
Yeah, that's a great question. It's an exciting milestone and moment for emergency savings and for employees having that as a benefit offering. I think one of the places to start in this conversation is that emergency savings is a foundation of financial security, and it's a missing piece of the puzzle in the financial services ecosystem, surprisingly, but it's also missing as an employee benefit. And so Commonwealth is part of the BlackRock Emergency Savings Initiative, which has a keen focus on this issue of emergency savings, but especially for low to moderate income employees. And as part of that, our work is to really unpack the need and the job that emergency savings can do. And there's three jobs that it can do. It can handle the day-to-day movement from expense and income volatility. It can handle income shocks that come along, or expense shocks. And the third is it can really handle moments like this with COVID. So the collaboration that you mentioned really delved into those issues with UPS and Commonwealth and Voya to look into the 401k as a place to provide an emergency savings option for those 90,000 employees.
Now, Nick, of course, when I was reading this news, I immediately thought about taxes, because one of the benefits of putting money into your 401k is that you essentially can do so tax-free. And it's typically for retirement. And I imagine, of course, emergencies don't really care what age you are and whether you're going to be facing tax penalties on the back end if you have to withdraw early. So I'm going to put that question to you. Will folks, if there is another emergency, hopefully we do not have another global pandemic for ever or quite some time, but will folks be penalized tax-wise if they do have to pull money out of this emergency savings account? Because that's typically what happens when you pull early from your 401k.
Yeah, that's a great question. And a key part of this, partnership with UPS was the involvement of Voya Financial, which has been UPS's 401k plan provider for its non-union employees for a very long time. And so as we looked into issues like that around taxes, it really became clear that the after-tax in-plan account that exists in that 401k plan was a real opportunity to provide an emergency savings account for folks, but also reduced the amount of penalties that you're referring to, because the money comes in after tax, and then the small penalty, if removed for any emergency, is on the small earnings. Remember, the goal here is to create small balances that are liquid that folks can use when emergencies come up. And so it turns out that after-tax pocket in working with UPS and Voya made a lot of sense.
All right. Well, we will have to leave that there. Wish we had more time. This is, of course, a fascinating initiative. Nick Maynard, Senior Vice President at Commonwealth. As a reminder for everyone, this is, of course, as a part of our Funding Our Future segment. Funding Our Future is an alliance of organizations dedicated to making a secure retirement possible for all Americans. Thanks so much, Nick.
Thank you.
All right. Well, coming up after the break, we will be chatting the Business Roundtable and how they're going to be pushing for more stimulus and tariff reliefs under a Biden administration. That's next. Welcome back to Yahoo Finance Live. Well, the Business Roundtable, that is, of course, the large influential group of corporate leaders and executives, has decided on their policy priorities for a new administration. And they've decided to focus in on stimulus and tariff relief. So I want to bring on Yahoo Finance's Rick Newman with more details and what we can expect from some of those corporate leaders to be pushing under a Biden administration.
Hi, Kristen. You know, one of the things that I notice is that the corporate world is not playing this silly game that a lot of the Republican politicians are playing, which is, oh, we better not admit that Joe Biden won the election because it might make President Trump upset, and we can't afford to upset him. You know, you're hearing business groups and individual CEOs. I mean, they're just coming right out and saying, Biden won. Congratulations, President-elect Biden. Now let's start talking about what's going to happen during your administration. So as you pointed out, the Business Roundtable is now asking the Biden planning team and probably having a lot of communication with them behind the scenes. What can we do on stimulus? And we'd love to see those China tariffs repealed. So stimulus is not really up to Biden. It's up to Congress and especially up to Republicans in the Senate. We have to get through those Georgia runoff elections in early January, I think, before we know what's going to happen. But, you know, I mean, all business groups, and there are other groups representing small businesses as well, really want to see at least one more very muscular stimulus package over $1 trillion, perhaps more than $2 trillion. And, they're all lining up for their lobbying wish list for what they want from the Biden administration. No different from any other transitions to a new administration in Washington.
And of course, as you mentioned, corporate leaders, they've moved on with this election. They've decided that President-elect Biden is going to be the one to lead us in this next administration. Doug McMillon from Walmart, even acknowledging that during the earnings call. I'm wondering from you, as you see it, and we're about to run out of time, if you think that a Biden administration, how they're going to work with business leaders moving forward.
It's a real unanswered question. Part of it will involve the makeup of the Senate for sure. So if Democrats do get control of the Senate, better chance that we could see a higher corporate tax increase, for example, perhaps some tougher regulations on business. But I don't think we're going to get a lot of the progressive wish list items. We're not going to get that alternative minimum corporate tax. We're probably not going to get a huge crackdown on Wall Street in any form. And Biden campaigned as a moderate. I think we should take him at his word at this point.
All right. Well, we will have to leave that there. Yahoo Finance's Rick Newman, always a pleasure to have you join us. Quickly taking a look at the markets right now, all three major indices remain in the red, accelerating some of the losses. The S&P 500 down now 0.25 percentage point. The Dow down 0.2 percentage point, with the NASDAQ down just over 0.1 percentage point. But Yahoo Finance Live will be continuing, and Alexis Christophorus is going to be checking in on BioNTech, asking for emergency authorization along with Pfizer for their vaccine candidate. That is coming up next. everyone, and welcome to Yahoo Finance Live. I'm Alexis Christoforous. We got more good news on the COVID-19 vaccine front today, but that is failing to lift stocks right now. In fact, in just the past few minutes, stocks have turned negative. A week after saying its vaccine proved to be 90% effective in protecting people against the coronavirus, Pfizer today said a larger study finds the vaccine is 95% effective. And of course, this news comes a day after Moderna said its vaccine had an efficacy rate of 94.5%. Pfizer says it now has the safety data required to be able to submit for emergency use authorization from the FDA within days. With 2 hours to go before the closing bell. Here's how things are stacking up on Wall Street right now. We have the Dow Jones Industrial Average lower by about 45 points. The NASDAQ Composite off about 16. We've got the S&P 500 down just about 8 points right now. Investors also sifting through a fresh batch of earnings reports from some big name retailers today, Target and TJ Maxx among them. Jared Blickery is here to break it down for us. And Jared, both of these retailers crushing it on the earnings front.
Oh, they did. Let's take Target first because their same-store sales were up 20.7%. And if that's not good enough, comparable digital sales, e-commerce, those were up 155% in the period. I was reading one article saying they combined a year's growth. They fit it all into one quarter. Now, they have been having this store as a hub strategy that they've been pushing for a while with their CEO, Brian Cornell. And they had what he called unprecedented revenue gains. And also 95% of all sales were fulfilled from its locations. A couple analyst notes, R5 Capital saying that while recent comp sales strength might make comparisons tough next year, think 1 year ahead, they're saying that multiple factors should keep the company comp. So expecting even better sales and being able to beat this year's next year. Plus they're taking business from JCPenney, Destination Maternity, and the Children's Place as well. Now, the stock is up about 4.75% right now, and we've had this incredible run in it. But I want to get to TJX as well, because even though they've really been hammered by the pandemic, they reported earnings that were good enough to get their stock up about 3% today. Now, their revenue at open stores they fell 5%. But that's only half the drop analysts expected, so better than feared. They have a very small e-commerce business. So just taking a quick look at the stock here, we can see year to date, still, now they're up 3%. So just barely climbing into the green for the year on this report. Alexis.
All right, want to stick with retail for a moment and talk about Lowe's because their earnings beat expectations, but I guess they're warning investors that the boom is not going to last.
Yeah, that's unfortunate because they have come so far. I mean, you take a look at the stock. So over the last 6 months, up about 28% right now. But if you look at year to date, they just got crushed early on in the pandemic. Given this outperformance, so over the last 6 months, a lot of analysts are thinking, well, this could be a valuation issue. So while it looks like on the earnings call, Lowe's was able to quell some of those fears, a lot of the analysts are saying that it is frothy in terms of their stock price. And despite same-store sales gaining 15 to 20%, they're just wondering what are they going to be able to do next quarter and also 1 year from now, Alexis.
All right, want to switch gears and talk Tesla. We know it made news this week after the announcement that it will be added to the S&P 500 index December 21st. And analysts are weighing in, at least one analyst saying Tesla is a buy right now.
Yeah, Morgan Stanley hasn't been bullish on Tesla for a number of years, but they're finally coming to realize that there are services in the business that can represent recurring revenue. And so their call is based on that. They said to only value Tesla on car sales alone ignores the multiple business embedded within the company. And so they are upgrading the shares from equal weight and raising the target price by 50% to 540. Now let's take a look at what the stock has done. It's up 10% today, 480% year to date. And if we take a shorter term look over the last 3 months, we can see that they have now, and this is only as of yesterday being added to the S&P 500, really broken out of this multi-month continuation. And an upside technical target based on this breakthrough to the upside points to $600 per share. And just look at the EV space, what's happened in the last month. I'm going to sort by performance. You can see some of these names like Solo, electromechanical vehicle, that's up 144%. And then X Motors, 121%. So the space is just really flying right now.
I want to get back to our top story regarding the vaccine, because just a short while ago, we learned that Pfizer and BioNTech are going to try to get emergency authorization for that vaccine as early as Friday. What are the stocks doing right now, Jared?
Right now, Pfizer is up about 1.6%, and it was already up on the good news this morning. Now, you can see over the last 3 months kind of treading water. Over the last 6 months, they have been getting a boost from this vaccine news. As you said earlier in the show, the efficacy rate is now 95%. And I would add that it's especially effective on the older generations. The only problem being that really cold temperature that it has to be shipped at, negative 116 degrees Fahrenheit.
All right, Jared, thanks a lot. And of course, that really good news about the vaccine coming as daily virus cases and hospitalizations continue to hit records. More than 160,000 new cases were reported today in the U.S. alone. But a vaccine, of course, is no good if people don't take it. A recent Harris poll found 58% of people said they would get vaccinated as soon as one was available. That is down from 69% in August. Our next guest says one way to get people to take a vaccine is to pay them. Please welcome economist Robert Lighton, a Brookings Institution non-resident senior fellow. We also want to welcome in Yahoo Finance's Sabine Marcellus. Good afternoon to you both. So, Robert, you say the government should pay people $1,000 to take the vaccine. Is that a small price to pay for herd immunity, or is this the government overstepping?
Well, I actually proposed this idea back in August at a time when the public opinion polls, as you said, were showing about 65% or so people were willing to take the vaccine. And at a time when we didn't think the vaccine was going to be as effective as it may turn out to be. At that time, Dr. Fauci was saying maybe it would get to 75% effectiveness. I did a back of the envelope calculation and showed that you don't get to true herd immunity with that level of effectiveness until about 80% take the vaccine. And since the polls were showing around 65, I just suggested one possibility as a plan B, and I really want to underscore this as a plan B, not as a first choice, but if you couldn't get up to the 80, then why not consider paying people? Now, since then, as you've said, we've had Moderna and Pfizer come up with 90 to 95% effectiveness, if it turns out to be true. And so when you do the math, that reduces the required vaccination rate for the country as a whole to get true herd immunity to somewhere in the 65 to 70% range. And as you just said, Harris is now saying 58% will be willing to take the vaccine. So that's not that far from 70, but we still have a ways to go. We don't know what the side effects are going to be. We don't know that once the vaccine gets deployed, whether it's really going to be as effective as advertised. So I would still advocate having that idea in the closet or as a plan B, the idea of paying people to take the vaccine. And yes, it would be worth it to get back to normal, get Main Street back to normal so we can go to sports events and basically get our lives back to normal. I think it'd be a small price to pay.
I want to double down on the fact that you said that you still think that it's an option to pay people $1,000 each to take the coronavirus vaccine so we can get to that post-pandemic life as quickly as possible. Do you still think that amount is enough, $1,000 per person, or would you advocate for possibly doubling that $2,000 per person for taking the coronavirus vaccine?
Well, unfortunately, we have no good data and no good studies to know what price it will take to convert people who are otherwise reluctant to take the vaccine and, have them go over that hump and then actually take the vaccine. So I just threw out the $1,000 on the theory that with a family of four, you're talking about $4,000 for families at a time when a lot of people need it. And I thought, that's my own judgment, that would be enough to convert a lot of people. And I had one additional wrinkle in the additional proposal, which I would keep. And that is, if you're going to pay people, pay them only like maybe $200 when they take the vaccine, hold out the other $800 and say that if the country reaches a national herd immunity target, like 70% vaccination rate, then we'll pay you the other $800. And by holding back that extra $800, it gives people who have taken the vaccine a very strong incentive to go on social media, tell their friends, tell their church members and so forth, take the vaccine, because then we can all collect the money. And then society would get two benefits from the payment. One is we'd get to herd immunity, true herd immunity, without people dying unnecessarily. And two, we get an additional fiscal boost to the economy. So
I think with that two-step feature, we have a greater chance of reaching true herd immunity if we actually need the payment.
And speaking of the payment, so obviously there are anti-vaxxers out there, people who would refuse to take the vaccine. Do you think that giving them that incentive of $1,000 eventually, a little bit here, a little bit once they take the second shot, do you think that's going to get anti-vaxxers to take the vaccine?
Well, we don't know really what the true proportion of anti-vaxxers are of the total population, but I don't think it's as high as 30%. It may be 10 to 20%. So really what we're talking about is converting those people on the edge, people who are maybe distrustful of the FDA, people who just don't want to get the shot because it hurts, they're worried about the side effects, et cetera, or they just don't want to go to the trouble of going to the doctor or the hospital to get the shot. It's those people that maybe 10 to 20% of the population, if we can flip them and get them to take the shot, if we really need it, that's who I think the payment is for. I am not counting on the money converting a true anti-vaxxer.
I know that this idea has been met with some criticism, but it's really not a new concept when you think about it. There are a lot of companies who waive or reduce health insurance premiums for employees who say participate in wellness programs. There have also been experiments with paying people to stop smoking or to lose weight. So do you think that sort of goes along with that sort of line of thinking, Robert?
Yes, absolutely. And you gave some great examples. And I think it's better than the alternative. The alternative, if we don't get to the 70%, let's say, target, the only alternative, if PSAs don't work, if the government urging doesn't work, and the employer urging and all that stuff doesn't work, the only other alternative is mandates. And people have talked about mandates. And I've looked further into this. I don't think the federal government has the legal authority to impose a national mandate, but states and localities probably do. The question is whether they would do it. And if we look at the mask example, we have this checkerboard where we've got, some states are willing to mandate a mask and others are not. And you have people that are threatening governors and mayors for imposing masks. So if you have all this opposition to masks, imagine what a mandatory vaccine requirement would do. And by the way, the government really can't force you to take the vaccine. What most they can do is say, we're not going to let you into public places unless you show a vaccine ID card, like into a restaurant or to a sports event and so forth. But even that, a mandate like that, I think in our very politically divided citizenry would cause a lot of angst, if not, severe trouble. And so I think I'd rather induce people to take the vaccine with honey rather than vinegar and actually pay them to do it. That's just my personal preference. And I think politicians would be more amenable to that than a mandate.
In your estimate, if we were to pay certain people to get a vaccine, other people would just take it voluntarily. How quickly do you think the U.S. economy would bounce back?
Well, this depends a lot on the supply constraints, on how rapidly you can get the vaccine out. And as we know, people have talked about a 4-stage process. So really, we're talking about people that are in their 20 to 60 age range. They're not the highest risk group. They're in the level 3 and level 4 category. And according to published reports, I don't think the vaccine will be available for those people until spring or early summer. But if the vaccine is available then, and you haven't gotten to the 70% or so that we need to get true herd immunity, I think within a couple of months after that, if you actually said we're going to pay people, you could get people vaccinated. But it all depends on how rapidly the places that administer the vaccine can deliver the shot. So we're talking maybe late summer, early fall, getting to what we call nirvana or normalcy again.
All right, economist Robert Lighton of the Brookings Institution and our own Sabeel Marsalis, thank you.
Thank you.
Boeing's grounded 737 MAX jet could soon be back in the air. We've got details coming up.
Boeing 737 MAX has been cleared to resume flying by the FDA, or the FAA rather, 20 months after it was grounded following 2 fatal crashes. Yahoo Finance's Emily McCormick has been following this story, and she joins us now. I guess, Emily, the question is, which airlines are going to be placing orders to put this thing back in the air?
Absolutely, Alexis. That is going to be one of the big questions here for Boeing going forward, just following this FAA announcement this morning. Now, I want to also note that this does open up Boeing's ability to deliver planes that it's already had on order and still in the company's possession as well. Now, just amid all this news, do want to call attention to Boeing's share price action. We do see shares of that stock actually trading just slightly lower. They had been up as much as 5.9% earlier today following the announcement. And I do want to highlight that the company does still have to go through a number of procedures in order to actually get this plane back in the air. Now, as the FAA actually said, the company does need to install new software on all of the aircraft and also instill pilot training. That does take additional time since pilots may need to actually go through simulators. That's something that Boeing has also recommended, and it's also a step further than using a computer program in order to complete this training. Now, Boeing must also fix a wiring issue that's separate from the problem that had brought down those 2 flights in 2018 and 2019. And it also must de-preserve the aircraft that it has had on hand since those have been sitting idle for so long. Remember that this was a 20-month grounding of this aircraft. Now, also want to highlight the resumption of flights and deliveries of the MAX is going to be critical for Boeing, especially given its weak order book so far this year amid the dual crisis of the pandemic and the 737 MAX groundings. So far this year, I want to note that Boeing has removed from its order backlog or outright canceled 1,043 737 MAX jets from that order book. It also reported 0 new sales in October, an extension from what we actually saw in months earlier this year as well. I also want to highlight that today's news does not change the fact that air travel demand is still highly depressed by the pandemic. So that will continue to exert downward pressure on Boeing's customers, even when it comes to the fact that the 737 MAX can actually get back up in the air. Now, that said, some of Boeing's airline customers have already said today that they're working to get the 737 MAX back on their schedules. We had American Airlines saying that they're taking a phased approach to return the jet to service. It plans to begin non-commercial flights in early December and then resume twice daily scheduled service flights starting on December 29th, and then in early January begin to phase in even more flights out of its hubs. And then now Southwest, which is Boeing's largest global 737 MAX operator, that company is set to restart its own commercial flights in the second quarter of 2021. So again, some light at the end of the tunnel here for Boeing, still some hurdles it will have to overcome to get these planes back in the air. But for now, again, seeing those shares trading slightly lower and still down 35% for the year to date. Alexis.
All right. Thanks, Emily. It is one of the biggest changes to Apple's App Store ever. Apple says it is cutting App Store fees for the vast majority of developers from 30% to 15%. Our tech editor, Dan Howley, is here now. So, Dan, I got excited when I initially saw this, but when you dig in, you realize they're saying this reduced commission only applies to developers who pull in less than $1 million a year. So I guess the question is, does this thing go far enough?
Yeah, I think this is basically part of Apple's plan to kind of get out of or out from under the thumb of kind of the antitrust investigations that are going on surrounding it. Unlike Amazon, which, I mean, it's a major part of their business, the Basics program that is under scrutiny for antitrust issues, or Google, which, I mean, their entire business is under scrutiny, and Facebook with their Instagram and WhatsApp purchases. Apple's issues with antitrust are relatively small, and they relate to the App Store and how much they charge the developers that put apps in the App Store, and the fact that Apple offers its own competing apps and doesn't have to pay in-store commission. So what's going on here is it looks like Apple is trying to kind of split in the middle ground and say, we'll reduce the commission fees for some developers, those that you said make less than $1 million a year in App Store sales. That's a calendar year, and then the others will continue to pay that same fee structure. Now, what fees stand at now is 30% for every purchase made of an app goes directly to Apple, and then developers keep the 70%. And then if it's a yearly subscription, it's 15% after that first year.
goes to Apple for each subsequent year, and then the developer gets to keep the rest of that. But so what they're doing here is essentially cutting the main commission in half to 15%, so that they say smaller startup developers can get greater access to the capital that they raise through sales of their apps in the App Store. And this may be something that placates lawmakers. Part of the issue is that Apple does offer competing services that could shut down smaller developers. But the biggest kind of folks that want to take action against Apple for this are huge companies like Spotify, right? They are one of the biggest companies fighting Apple for the amount that it charges, as well as Epic Games. We've talked about part of the issue there has to do with Apple not allowing those companies to offer a secondary payment option. So, for instance, Spotify or Epic Games would want to put in an option for users to pay them directly rather than having to go through Apple's payment system. So it really is kind of a way for them to do a little bit without doing too much that would hurt them, while still looking like they're doing a lot. And I think that's basically what Apple's plan is here, to kind of assuage the concerns of lawmakers to a degree, but not hurting them. And we had Gene Munster at Loop Ventures saying that he reduced the estimated revenue from the App Store based on this from $15.8 billion to $14.2 billion. So it's a $1.6 billion reduction for Apple, which is
that's like a spit in the bucket for Apple. I know.
Yeah.
All right. You summed it up nicely. Dan Howley, thank you. The resale sneaker market is on fire during the pandemic. We're going to talk to the CEO of StockX coming up. Welcome back to Yahoo Finance Live. Are sneakers on your holiday shopping list this year? I'm not talking about just any sneakers. I mean those coveted, Jordans and the Yeezys, the hard to find sneakers, pre-worn sneakers. It is big business, currently a $19 billion industry, expected to jump to $30 billion over the next decade. The resale platform StockX says business is booming. And here to talk about it is StockX's CEO, Scott Cutler, and our resident sneaker guru, Reggie Wade. Hi to both of you guys. Thanks for being with us. So Scott, just tell us how business is right now. We're in the middle of the holiday shopping season. What does it look like?
Well, 2020 is a new normal for holiday shopping. As you know, online shopping has been accelerating over the years, but the pandemic has caused shifts for consumer behavior that
quite frankly, accelerated maybe 10 years of e-commerce activity just in the last couple of months. So sales will primarily be online this holiday season. And with consumer preferences changing, more people will be shopping on the secondary market. And for us, it's really about having great products that are available to customers. And we can talk about what those trends are, but it's really being driven by a next generation of consumers. For us, that's 75% of consumers under the age of 35. These are the trendsetters. These are the ones defining what's hot, what's not.
Scott, Reggie Wade here. I wanted to know, do you guys see that the secondary market is actually turning into the primary market? I know for myself and a lot of my fellow sneakerheads, if we see a big time drop, we're like, you know what, we're probably not going to be so quick on the draw, so we're going to go straight to StockX to get this. Are you seeing that more and more people are doing that?
So we're at the center of a couple different convergence streams in this space. And when we look at this next generation consumer that wants access to items that represent current culture, there's convergence happening between sneakers and fashion, and now even new categories such as electronics. And what's happening in this is that there's so much demand for these products that consumers are now going to the secondary markets as their first place to purchase, because the secondary markets and platforms like StockX provide those customers access to products that you can't find from the brand or from retailers, and they trade live in marketplaces like ours. And so that notion of getting access to those great products for these consumers has been a real driver for this convergence between primary and secondary in the mind of the consumer.
Scott, how has the pandemic affected the authentication centers? I know when it comes to clothes and sneakers, that's probably the biggest part of the entire transaction. So what's going on there now?
So we stand in the middle of the seller and the buyer in our platform, and we authenticate every product on the platform. And for us, that involves a very complex supply chain and operations around the world. We've expanded our authentication center footprint by 50% just this quarter. We've opened up Toronto and Hong Kong. We'll be at 10 authentication centers around the world. But that process of authentication means trust for the consumer in these high demand consumer categories. And for us, delivering that experience that the customer expects for great products is the value proposition for us when we're getting supply from hundreds of thousands of sellers all around the world to, again, power this marketplace.
Scott, you mentioned the opening of that authentication center in Hong Kong. I know you also launched a localized business in mainland China. Tough time to be doing something like that, I would think, during a pandemic. Why do that now, and why China?
So when we look at the opportunity, we're servicing customers in over 200 countries and territories around the world. And most major brands are releasing product out to those consumers around the world. And so the reason that we're open up authentication centers in other places is really to provide an opportunity for sellers to be able to provide product to us in those regions. We have the opportunity to authenticate those products in region and then connect those sellers with buyers in the same region. So the reason that we go to Hong Kong, Canada, the reason that we're so large in Europe has been that we've had a strong base of sellers and buyers in those regions. And so it's really a part of expanding that customer experience. We've had to open up these authentication centers virtually. These are team members that are joining us, opening up these authentication centers in the middle of the pandemic and in the middle of surging volumes in the marketplace. And so it's been dynamic for us to be able to operate with our frontline team members around the world in this environment.
Scott, I'm mesmerized by this, rotating Jordan over your shoulder. Talk to us about what is in demand right now on your platform when it comes to these sneakers.
So 2019 was all about Jordans and Yeezys. I think this year, I think the most popular brand of sneakers will still likely be the Jordan 1 silhouette that you see here rotating behind me. There's been a new recent release, the Jordan 1 Retro Mocha Black Toe. Reggie knows this sneaker, patterned after a great release called the Travis Scott Jordan 1. We expect that Mocha to be a top seller. In women's, there's a Jordan 1 Retro High Lucky Green that's really based on a colorway back in the 1986 Bulls versus Boston Celtics. That's going to be hot for women. We're seeing Telfar bags, a shopping bag, a small black bag represented by your own AOC, worn with style. This is really driving a great amount of demand. Oprah had this bag in particular on the favorite things, most coveted holiday gifts. And for us, just last week, we introduced something new into the catalog, electronics. So this year, PlayStation 5 and the Xbox Series X consoles are trading on StockX. We're trading thousands of consoles every single day. This is likely the holiday gift of the season in electronics, and it's largely only available on StockX.
All right, Scott Cutler of StockX, thanks so much for being with us. Good luck this holiday season.
Thank you so much.
I want to bring you some breaking news now regarding New York public schools. We heard from Mayor de Blasio just moments ago. I want to read to you a tweet. De Blasio says New York City has reached the 3% testing positivity 7-day average threshold. Unfortunately, this means public school buildings will be closed as of tomorrow, Thursday, November 19th, out of an abundance of caution. We must fight back the second wave of COVID-19. Again, that is New York City Mayor de Blasio. Reggie, I know that you cover education for us here, in addition to covering things like sneakers for Yahoo Finance. What do you think teachers are thinking about all this right now?
Well, teachers have been frustrated for quite a while because you're kind of in this middle situation. You don't know what to expect. And as a teacher, that's one thing. You always talk about planning. You want to have your lesson plans. You want to have your supply plans, but you do not know what's going on. So I think out of an abundance of caution, the city is deciding to close schools. And that's something that unions like the UFT and the AFT have called for, to listen to the science and listen to the data and plan accordingly. But teachers are very frustrated because they don't know what's next, not for next semester, but even the next few days or few weeks.
Yeah, I mean, it just seems to be flip-flopping all the time, not just for the teachers, but of course for the parents who have to work and deal with childcare. And of course, at the crux of all this are the kids themselves, not really knowing what's going on day to day. I can tell you, though, from personal experience, that the parochial schools remain open in New York City, and the Archdiocese has been doing a great job. They have said even if New York City public schools close, they're going to keep their doors open. So it's sort of the tale of two schools, Reggie, right now. I can speak at least for New York City, where you've got these Catholic schools remaining open, many of them gone to hybrid learning, and the public schools, it seems like it's a day-to-day situation.
It really is. And when you speak to the parochial schools, especially the Catholic schools in New York City, they've been planning for this not only with school, but with their churches. We've seen them fight back about having churches shut down. And they say, listen, we know the social distancing policies. We have the PPE, we have the sanitizer. So that's been something that the Catholic Church has been thinking about, not only with schools, but as well as for their parishioners. So it's not hard to see that they might be more prepared here than the New York City school system.
Yeah, it is a smaller school system. I'll give them that to have to oversee, but grateful that they're able to stay open. We wish the public school folks well. All right, Reggie Wade, thank you. And coming up next, more on the market. Stay with us here at Yahoo Finance Live.
Time now for our ETF report brought to you by Invesco. I want to welcome in Reggie Brown, principal at GTS. Reggie, good to have you here. So we have the election behind us, well, sort of. What are some of the investor themes you're seeing right now? What are investors interested in when it comes to exchange-traded funds?
Well, thanks for having me back. Well, the election is resolved, and I think investors are starting to understand how to position themselves into the Biden administration. So what we're seeing is interest in Chinese ETFs in particular. Perhaps it could be a new approach to foreign policy. So stocks like KWEB, for example, and stocks like Chinese consumer, CHIQ is a ticker there. So we're seeing interest in China. And I think largely also an approach to European developed markets. So ETFs that are focused on Germany, for example, or ETFs focused on the UK, there's interest there. So I think we're seeing a broader approach to global investing, giving a reset to foreign policy.
Okay, so then with this sort of focus on the new administration, what about healthcare? That's a biggie. Are investors looking at opportunities there in the ETF space?
Well, absolutely. I think I think with the news around potential vaccines for COVID-19, we saw a big run up with pharmaceutical stocks. But largely, what we're seeing is that there's a break in the momentum factor trade where you buy the winners and sell the losers of the last 12 months. And with the pharma companies roaring back to life, given the fact that there's a vaccine, we're seeing a lot of interest in the healthcare-related ETFs in particular. And so what we're seeing particularly is selling technology and buying small cap and mid cap value ETFs. So SPYV is one ETF, for example, MDYV, which is all mid cap values and SP value securities. But healthcare in general, we're seeing an emergence in biotech, for example. We're seeing an emergence of investors wanting to have exposure in that space.
And what about travel as a theme for investors right now? We know that it was hit real hard during the pandemic. Some of these airlines are adding more flights, more routes. Are you seeing investors having an appetite for that now?
Well, I think the way that you can characterize what we're seeing in the marketplace is a return to work or work from home. So I think the work from home rotation is rotating closer back to return to work. Thus, the value stocks are starting to come back into play. And then with the travel in particular, we're seeing, well, first of all, we're seeing Tesla going to SP 500, which is a big news item for electronic vehicles and different types of technology. So there are two ETFs in particular that's had a great run and a lot of creations. One ticker is called HAIL, and that is innovation around the future of travel, the future of car vehicles. And then New Technologies, which is another ticker, KOMP, that offers also a view around innovation around electric and innovation around supply. So we're seeing those themes emerging. And I think largely over the next year, they'll continue where Tesla and its new competitors and cult-like stocks wrapped up in an ETF will become in favor for investors. And then investment infrastructure through the Biden administration, investment and COVID-19 practices to prevent additional flare-ups will drive more demand in those market cycles.
All right, Reggie Brown, principal at GTS. Thanks for bringing along your picks today.
Well, thanks so much. Appreciate it.
Coming up, Senator Marsha Blackburn of Tennessee joins us to talk about yesterday's big tech hearing and a whole lot more. Don't go away.
Big tech was in the virtual hot seat on Capitol Hill yesterday. Facebook CEO Mark Zuckerberg and Twitter CEO Jack Dorsey were grilled by members of the Senate Judiciary Committee as they testified about their platforms, misinformation, and the 2020 election. Senator Marsha Blackburn, the Republican from Tennessee, was among the lawmakers who drilled down on Facebook and Twitter and how they moderate content.
Facebook and Twitter don't get to be the last word in what counts as real news in this country, even though you're beginning to conduct yourself as news publishers and distributors. My colleagues and I have asked you all repeatedly through the years for greater transparency and to accept responsibility. You've chosen to do neither, so it is going to be up to us to change existing law.
And Senator Blackburn joins us now. Senator, thanks so much for being with us. So after more than 4 hours of questioning by lawmakers yesterday, did you learn anything new from these CEOs about how they are handling content on their platforms?
Yes, we learn something new every time they come before us or every phone call that we have with them. One of the takeaways from yesterday is that, yes, they were fully aware that they had basically been caught, if you will, exercising some censorship and some throttling. That came forward as the New York Post story was discussed, that the posting on Hunter Biden prior to the election. Also, there is an admission that they realize that they are getting over in the news business. As we talked about how we're going to reform Section 230 to modernize it and to make it applicable so that it applies to new entrants, but not to these big tech giants who have grown to the point that they really do not need, nor do they deserve Section 230 protections.
Hi, Senator. Jessica Smith here. As we're listening to this conversation, as we were watching the hearing yesterday, it seems that Republicans and Democrats have two different ideas of what this actual problem is. We have Republicans saying that these companies are moderating too much, while Democrats are saying they're not doing enough. So how do you even start to bridge that gap and find compromise?
You know, it is going to take time. I've worked on the Section 230 reform issue for about 3 years now, and getting the legislation into shape to move forward. The Online Freedom and Viewpoint Diversity Act, that is something that we will see individuals come forward from both sides of the aisle to support this. It is going to be marked up in Judiciary Committee tomorrow. Now, what you noticed yesterday was the Democrats wanted to talk more about antitrust violations. There is the DOJ lawsuit against Google. There are concerns about their data mining practices, as there are with Facebook and Twitter. And also, concurrently, we have the privacy bill, which is bipartisan, moving forward in the Commerce Committee. So finding common ground is something that we will be able to do. Democrats have long joined Republicans in protecting free speech. You may not agree with something, but you will protect someone's right to say that. I think they will return to that position of protecting free speech. I'm certainly hopeful that we are going to see that. But people do agree that Section 230 is to be there for new market entrants. It is not to be there for tech giants, that there has to be clarification around the liability protection as to who can use it, when, and how they can also use it. There needs to be a cleanup of the nebulous language. If you're going to censor, it needs to be for something specific. Adding that specificity in is something we've done in the Online Freedom and Viewpoint Diversity Act, making certain that we designate who is a publisher, because we have some sites that have been supposedly blocked or throttled because of something said in a comment section, not something that the site themselves was posting.
So therefore, we have some agreement that this does need to be shaped up. I'm just so pleased that we are moving forward with the legislation and that the conversation is now moving from the back burner to the front burner.
You know, part of this debate has been about the labels that these social media companies are putting on the president's tweets, the president's posts. Do you think that these tech companies have an obligation to stop the spread of disinformation that can cast doubt on the democratic process?
They have an obligation for consistency with the people that are on their platforms. When they will censor or block Donald Trump 65 times or 100 times or however many, and never block anything or question anything from Joe Biden, when you have the Ayatollah shouting death to America on Twitter, but you do not see that being blocked or him being censored or Putin or Xi Jinping, then you have to say, is this being done politically? Especially when Jack Dorsey says, well, I think world leaders need access to my platform. Then it is, okay, do you consider Donald Trump a world leader, or why are you censoring and blocking only him and not censoring or blocking or having some form of moderation put on anyone else? Especially when you look at the fact that in China, Twitter is blocked. In Iran, Twitter is blocked. So it does cause you to question why it is that they only seem to block a conservative and not block someone who has a different point of view.
Senator, I want to pivot for a moment to the pandemic and the millions of Americans who are struggling financially right now, waiting for another stimulus package to come out of Congress. What is the likelihood we could actually get that, say, before Christmas?
Oh, my goodness. I so wish we could. We have twice put our bill on the floor in the Senate, which, of course, as you well know, you have to pass something in the Senate before you can go to conference in the House. And the bill has been defeated each time on a party line vote. That is incredibly unfortunate. And our legislation would have done another round of PPP. It would have repositioned leftover funds in the CARES Act. There would have been a plus up of $300 a week for those that are on unemployment, those that lost their job through no fault of their own. It would have also had extra money for developing testing and vaccines and for getting children back to school. I have a constituent in Tennessee who the other day said to me, I want my old normal back. I don't want a new normal. And so many people are in that position. And, you know, we had looked at one point, for every one person that had been adversely impacted by the virus physically, we had 33 individuals who had been adversely impacted financially. And my heart just breaks. And our team is working so diligently with these small businesses, with employers, with individuals. We would very much like to see a bill. And I think that people were really disappointed when the president offered $1.9 trillion as a deal with Pelosi, and she turned it down. It's, you know, everything that she wants or nothing at all. And that's not fair to a lot of people who are really hurting and wanted another round of PPP or wanted a plus up in unemployment. A great example of this is with our live entertainment industry in Tennessee. All of our concerts, tours, these studio musicians, these guys that do the lighting and sound and the techs, those that set up the staging, break it down, the guys that drive the trucks and haul it all across the country, their income went from a very good year to zero overnight. They did nothing wrong. They need the help. And we have worked every way we can, whether it's the Restart Act or Save Our Stages Act, trying to help these guys to weather this storm and to get to the point that they can move into a recovery phase.
All right, Senator Marsha Blackburn, thanks so much for being with us. We appreciate your time.
Good to be with you. Thank you.
Coming up, what to expect from tonight's NBA draft. The 2020 NBA draft is happening tonight at 8 p.m. Eastern. And here to help us break it down is Vincent Goodwill, senior NBA writer at Yahoo Sports. So, Vincent, it's going to be the strangest draft we've seen, I think, ever. What should we expect from tonight?
A lot of things that we're doing right now, as opposed to us sitting in the studio next to each other. We're doing this teleconference-wise. That's something the NBA will be doing. They'll be doing this from ESPN studios, where Commissioner Adam Silver, as opposed to being at Barclays Center in downtown Brooklyn, he'll be doing everything telecommunicatively, and a lot of the players will be being interviewed and everything else in the same way. There will be nothing in person. I think we'll get a chance to see a lot of players with their families, with the cameras set up and everything else. So if there is some family drama, we won't be able to be shielded from it. So I think the entertainment aspect will be a little bit different tonight.
Yeah. And we've seen that with the other drafts too in other sports. So to break it down, who are the top NBA draft prospects and where do you think they're going to land?
Well, honestly, this year is kind of a little bit different, Alexis, just because there was no NCAA tournament, and so many of the professional sports was cut off around mid-March, right when the NBA stopped. So you didn't really get a chance to evaluate the top players. But Anthony Edwards from the University of Georgia, James Wiseman from Memphis, and LaMelo Ball, who, of course, has a famous last name because of his famous dad and famous brother, they are the top three prospects in the draft. Now, Wiseman only played 3 games at Memphis before the NCAA ruled him ineligible. Ball, of course, didn't go the traditional route, didn't play in the NCAA. He played overseas. So a lot of this is almost like paint by numbers or close your eyes and saying any, mini, miny, mo. I'm just hoping that I'm selecting the right player, not necessarily as a player, but also, Alexis, as a face of the franchise moving forward. I think this is our multi-million-dollar decisions that these franchises are making, and you're putting it in the hands of a 19 or 20-year-old. You're hoping that he has the maturity and the wherewithal to understand the responsibility that's being bestowed upon him.
Yeah, that sure puts it in perspective for us. Vincent Goodwill, senior NBA writer at Yahoo Sports. You've got a busy night ahead of you. Thanks for being with us.
Thank you, Alexis.
All right, the markets have turned mixed. NASDAQ slightly higher, but Dow and S&P under some moderate pressure. Much more to come on Yahoo Finance Live. I'm Alexis Christoforous. Thanks for joining us.
Big news for Boeing as the FAA clears the way for the 737 MAX to take off again, but the coronavirus pandemic hit airlines hard and Boeing's order book even harder. It took some big hits. We're going to dive deep to see if that stock could soar again. Target shocks investors with a COVID-19 third quarter earnings blowout that saw revenue hit more than $22 billion. We've got Jefferies analyst Stephanie Wissink to break down the numbers and explain why the firm has a hold on Target, but a buy on Walmart. And the COVID-19 pandemic continues to hit horrifying numbers in the United States. Former Secretary of Health and Human Services, Kathleen Sebelius, joins us with advice for President-elect Biden on ways to fix the Trump administration's faltering coronavirus prevention policies. We're heading towards the closing bell on Yahoo Finance Live. I'm Adam Shapiro.
And I'm Shauna Smith, and taking a look at the markets here with just around 60 minutes to go in the trading day. It's been quite a choppy day for stocks. As you take a look at where we stand right now, the Dow and the S&P both off just around 0.3%. The NASDAQ not trading too far from the flat line. A couple of reasons why we're seeing investors get a little bit skittish here today. Of course, we had that rising COVID case number. That continues to be the case day in and day out, but today leading to some more restrictions out of some states. And then we also got a headline on the stimulus front, an aide to House Speaker Nancy Pelosi saying that she has not heard back from Senator Mitch McConnell about stimulus. So that, of course, is not helping investor sentiment at this point. But I want to bring your attention to Pfizer because it's one of the more encouraging headlines that we got today. And taking a look at the stock, it's up nearly 2% right now, but final data analysis showing that COVID-19 vaccine is 95% effective. Now, Pfizer is saying that it becomes highly effective against the virus just 28 days after that first dose is taken. The elderly, now this is a population that's at high risk, obviously, of a severe illness from COVID, saw vaccine effectiveness of more than 94%. So Pfizer is expected to apply for emergency use authorization in the coming days, and Pfizer, one of the winners today in a down market. On the flip side, though, on the retail front, Lowe's is under pressure, off just around 7% right now. Now, shares are falling despite pretty solid results from the company. They posted same-store sales growth of more than 30%.
Online sales, that's been a bright spot for the company over the last couple of quarters, especially during COVID. That's up over 100%. In the earnings release, their CEO, Marvin Ellison, noted that they delivered over 15% growth in all merchandising departments, over 20% growth across all geographic regions. But as you can see, it's not enough for the street. So it seems to be a case of it matched analyst expectations. It didn't live up to what investors were hoping to see. So that stock, Adam, off almost 7% today.
And Sean, I want to go back to the Boeing story because the shares had been trading higher, over 1% in midday trading, but right now they're off about 1.5%. We got the news, the FAA clearing the way for the 737 MAX to return to the airwaves, to the air. Want to put into perspective for you what's happened to Boeing stock over the last 2 years. Now, the 52-week range for this stock was $89 to $374. But remember, it was March 13 of 2019. When the 737 MAX got grounded. So the stock is off more than 43% since that event, which, by the way, the dates are just ironic because that's also when we got a lot of lockdowns for COVID-19, but in 2020, a year later. So again, the crash that killed, two crashes that killed 346 people appear to be in the rearview mirror for Boeing. The question we're going to address in about 15 minutes is where does Boeing go? Because the order book took some big hits on all of this. Regarding the airlines, because those are the firms that are going to be buying Boeing jets, one would assume in the future. Love, Southwest, those shares were up 3% during midday trading. They have the largest number of MAX jets, 737s, in the United States right now. Shares up about 1.25%. Gary Kelly, CEO over at Southwest, he said every pilot will be trained on the MAX before we'll have a revenue flight. They're not going to start flying the MAX again at Southwest until next year. American Airlines has 24 of the jets. They are going to start phasing them in before the end of this year. United has 14 of the jets. Their shares were up almost 5%, United, in midday trading. Delta got bupkis. They don't have any of the 737 MAX, but Boeing is courting Delta to purchase them at discount prices. So let's move back to the big news that we got regarding Target, because it was a surprise. The Brian Sozzi headline used the word shock, and a lot of investors were very pleasantly surprised by it. So let's bring in Stephanie Wissenk. She's Jefferies analyst, and she covers a lot of retail in addition to Target, Walmart. Want to get your first impressions of this Target beat. I mean, the revenue number was really enormous, 22 plus billion.
Yeah, I think to use their tagline, I think they hit the bullseye with this quarter. 20.7% comp was staggering, frankly. And it really shows some good momentum carrying forward from the second quarter. And what I think is so fascinating about this as an observer of the retail industry is a couple of things. Number one, even as competing stores reopened coming out of the pandemic lockdown, Target retained its momentum. So there's something sticky and intriguing about that market share they've captured. The second thing is Target is a fantastic place to shop in store, but they have absolutely crushed it with their omni-channel initiatives. Things like buy online, pick up in store, buy online, curbside utilization and pickup and sales were up over 500%. So I think what they're building here is an ecosystem of convenience for consumers. And it's really hard to argue that any other retailer has that proficiency that they're demonstrating. And then the last thing, I think you have to give it to them, Target Boutique, they have an unbelievable way to curate merchandise, and in things like home and beauty and electronics, they're winning in those general merchandise categories alongside some of their core consumer staples categories. So those baskets are getting bigger. She's spending more at Target, and there's clear market share gains for Target this quarter.
Target Boutique, Stephanie, I like that one. What stands out to me, though, I think when we go back to last quarter, when we were talking about a lot of these retailers outperforming during the second quarter, a lot of questions going into the third quarter was whether or not that type of growth is going to be sustained. When we go back to the fact of what we mentioned at the top of the show, we still don't have a stimulus package. It's a little bit surprising that we're not seeing that reflected a little bit more in numbers, especially from a name like Target. Why do you think that is?
Yeah, I think this is the eye-opening moment in that
if you think of all of the things that moved from tailwinds to headwinds quarter on quarter, they were still able to deliver the comp at a north of 20% level. So I think there's something more behind the numbers that we really need to explore. We think we saw the same thing at Walmart. These companies were both deemed essential. They both carry food and basic commodities and consumables, but they're gaining a customer, and that customer is proving to be a little bit more resilient and sticky. I think we also have to recognize when you look at Target versus Walmart, Target putting up a 20% comp, Walmart in the 6.5% range. Target is benefiting from stability in the employment picture among the upper income households. They do skew higher on an income basis, so there's not quite as much volatility. But I also think we have to recognize that many consumers are what we call kind of lost shoppers right now. They used to shop at Bon-Ton department stores or Macy's or Penny's or Kohl's or mall-based retailers, and they're entering those domains and they're not finding those to be as enjoyable anymore. And so when we look at the mass class of retail and look at merchandising and experience, Target tends to win. And so we are mindful that there might be a drifting consumer that is finding a new home at Target on a relative basis.
Stephanie, for the people watching in Cleveland, Ohio, I want to add Higbee's and Hallie's to that department store list. But let me ask you a question. Why does your firm then have a hold rating on Target but a buy on Walmart?
Yeah, I think we're going back and thinking through our valuation context. We used to look at these two companies together and try to determine, should one be worth more than the other? But I think we're starting to rethink that a little bit. Can Target actually coexist and coexist successfully well alongside Walmart? And can they take share from a different domain of retail than maybe Walmart is taking from? So I think we're thoughtful about or going back and thinking through how the valuation needs to square up between the two. And maybe we don't need to benchmark them against one another anymore. Maybe we can start thinking about them on an individualistic and holistic basis around what their opportunity sets are.
Stephanie, Target and other retailers like Walmart, like you were just talking about, a lot of them pushed forward their holiday deals, started them earlier this year. We saw a number of deals beginning back last month in October. How much of the holiday sales do you think was pulled forward to the third quarter?
Yeah, this was an unresolved question that we still have coming out of the quarters. I think some of the vendors are talking about upwards of 20% of the December business might be pulled forward into October. Certainly Amazon kicking off Prime Day in October was a kickstart to the holiday. But I do think there's going to be some smoothing out of the average weekly sales across more weeks than what we typically see. And when you look at some of the external studies, the National Retail Federation, some of our own proprietary studies, it does suggest that about 25% of holiday spending is already complete. So it would square up with some of those vendor measures that maybe there was a bit of a pull ahead. And we're not really going to know how impactful that pull ahead was until we get into the core weeks of holiday, which really are, living between Thanksgiving and Christmas. So we're watching those weeks pretty carefully to see if we see some volatility in the retail measures.
All right, Stephanie Wissink is Jefferies analyst, and I get to say you're the first. Have a happy Thanksgiving. It's a week early, but I don't think we're going to see you till after the holiday. So all the best to you and the team at Jefferies.
Thank you.
Coming up, big news for Boeing as the FAA clears the way for the 737 MAX to take off again. So is Boeing's stock price and is the company's prospects, are they back on track? We're going to discuss that after the break.
Boeing, it was initially a leader in the Dow today, but right now the stock is off just around 2% with 45 minutes to go in the trading day. The big news this morning, the FAA clearing the way for its 737 MAX to resume flying. We want to bring in Alexis Keenan. She has been following the story very closely for us. And Alexis, this has been news that Boeing has been waiting for quite some time. The decision coming, I believe, just around 20 months after the 737 MAX was grounded. When can we expect the airlines to resume flying this aircraft?
Well, so far we have a couple of the airlines speaking out saying that American, they have said that they'll resume their first MAX flight on December 29th, so sneaking in there before the end of the year. But Southwest and United that also have MAX aircraft, Southwest for its part has said no sooner than the second quarter of 2021. United also saying it'll be next year. Now, basically, this resumption of passenger flights is what the FAA's move did today, though there are some contingencies that go along with the big picture of whether these flights will actually be able to get back up into the skies. One is that all of these aircraft, as far as Boeing is concerned, will have to go ahead and install the new flight computer, the new cockpit display software. Both of those things need to go into all of the planes. Also a wiring issue that was separate from the issues that brought down those two aircraft and killed 346 passengers and crew on board. Also, the flight manuals will have to be updated, and there will have to be done by the airline's pilot training, and that'll happen through aircraft simulators as well as through computer training. Now, there was some controversy earlier in the month, just a few weeks ago, with pilots unions for both Southwest and American saying that the FAA should really improve what they're proposing for these training scenarios. Yet today's Southwest CEO Gary Kelly said in a statement that the company is confident of what the FAA has put forward. Now, while the FAA's decision will permit Boeing to start, in theory, delivering these aircraft to its customers, right now the aircraft manufacturer has 450 approximate aircraft just sitting there that haven't been delivered to customers. But now, of course, they have a demand problem that wasn't there at the beginning of this pandemic. I asked Boeing today how many of those 450 planes are not currently under contract with a buyer, and a spokesperson for the manufacturer said they didn't give me a number necessarily, but they said that their sales team is, quote, exploring options to remarket some of these airplanes to other customers. In the third quarter earnings call, the CFO, Greg Smith, had said that they expect to deliver half of those planes by the end of 2021, and then the rest of them in the following year in 2022.
Hey, Alexis, very quickly, are they going to rename the plane? Would that help them in the marketing efforts?
You know, it's a big question, and there's lots written about this. I've seen everything from it'll get phased out, but it'll still be called the MAX initially. Also, customers for some of these airlines are going to be told, yes, indeed, this is a MAX, and if you'd like to reschedule your flight, you can do so. But that is a question that has not been answered yet, and I think it'll weigh on a lot of people's minds. I was just kind of going through Twitter today and looking through people's responses to this news, and there were an overwhelming number of people who said, look, if it's a MAX, I'm not going. Others said, sure, I'll go. This plane has been inspected backwards and forwards, up and down. But definitely it is something that is on people's minds, Adam.
Certainly is there, Alexis. All right, Alexis Keenan, thanks so much for bringing us the latest on Boeing. Coming up here on Yahoo Finance Live, the housing market getting another good reading. We got that U.S. housing start number out this morning, beating expectations. Coming up next, we're going to talk to housing expert Jeff Taylor. He'll discuss why we're in the midst of a W-shaped recovery and what that means for homeowners and also for investors. We're back with that in just 2 minutes.
About 40 minutes to the closing bell. Dow is off about 99 points at this juncture. We want to bring into the stream right now Jeff Taylor. He's co-founder and managing director at Emphasis Digital Risk. We want to talk specifically how technology and applying the technology that they do at Emphasis can help us understand what's going on with the U.S. housing market. Because we saw housing starts beat expectations in October, and there's a lot going on there. So first, thank you for joining us, Jeff.
Thanks for having me, Adam. Really appreciate it.
Want to start with one thing in particular, because there was a digital risk survey that found 61% of Americans are concerned about the state of the housing industry. Some are worried that it's too expensive to get in. Some are worried that they're missing out and can't get in. What do you take away? What are you seeing happening across the country in housing?
So, across the country in housing, compared to where we were 10 years ago, when people say that they're concerned that they can't get what they want, right? The housing market is as tight as it's ever been in the last 7 to 8 years. Housing starts are up. People are looking for more space. People are realizing, look, going through this pandemic, I may need to have to school my children, work from home. So they're worried about, am I going to be able to find the house that I want at the price points that we have right now? And then when you look at the overall housing market, we're going to be somewhere between a 3.39 trillion market and a 3.9 trillion market. To give you perspective, that will be the second biggest residential housing market in the history of the U.S. And from where we see this digital risk as the largest fulfillment company in the country for residential mortgages, it could be 4.5 if there was the capacity. So the housing market is extremely healthy. From a consumer perspective, it's just, can they find that right house that fits their needs that are ever changing today?
Jeff, when you look out into 2021, when do you expect that a lack of demand then to meet, or a lack of supply, I should say, meet demand? You mentioned the fact that it's the tightest that it's been in 7 to 8 years. When can we expect it to balance out a little bit?
I think you have to look out to maybe 24. Because if I look at companies like Lennar and DHI, specifically Lennar, their home building, they cannot buy enough land and build the houses quick enough, because finally you have those millennials that were on the sideline for so long that are now coming in to the marketplace and that are buying. And then on top of that, you have people living in big cities that were in apartment buildings saying, you know what, we can probably leave here. We can go into the suburbs and we can work remote. So specifically that builder segment, I see an incredible one through 21 and 22, coupled with interest rates probably staying around, the Fed rate around 0. So it's a perfect storm and a great wave ahead for the building market.
Nothing in this indicates to you that there might be a bubble forming that could end perhaps poorly in 2023, 24?
So it's a great point, right, Adam? Because we go back 10 years ago, the problem with the housing market was nobody really had equity in their houses. Therefore, when times got tough, they gave back the keys and we had a tremendous amount of foreclosures. Let's fast forward to where we are right now. Home price appreciation is still pretty much flat. It's going to be probably up 1% this year. But going forward, we have close to $20 trillion in home equity right now in the entire U.S. housing market. So I don't see a scenario in the next couple of years where you have, on a mass scale, people walking away from their houses saying, look, we don't want them. If people have a life situation where they want to get out of the houses, they'll sell them, make a profit, and maybe become renters or what have you. But I don't see a bubble ahead.
Jeff, mortgage applications rose 4% for the week. And I bring this up because when you take a look historically at November, it's not usually a strong season for home buying. Is it all because of the pandemic? Does some of it have to do with the election outcome? What's your read on that?
It's still, so to my comment a few minutes ago, it's right now you have so much demand for refinancing and for purchase that, basically this could have been a $4.5 trillion market. So what you're seeing right now is people still trying to get that refinancing or that purchase in, and where the summer might have been the buying season, it got pushed into the fall for reasons like maybe they couldn't get into the house, they had reasons at work, or they were stuck. So the whole season has adjusted, and I expect to continue to see the housing market on fire through at least the first half of 2021, maybe slowing down a little bit in that refinance component in the second half of 21, but very strong through June of 2021.
Help us understand something from your fall 2020 housing survey. I get why lots of people go to Florida, no income tax, right? Makes sense, especially when you're coming out of New York.
But California, the survey found 11% indicated an interest to move to California. No water, high taxes. Explain that.
It's the East Coast, West Coast phenomenon, right? Still, at the end of the day, if you're retiring, downsizing, you still see a lot of demand going to either coast, whether it be Florida or California. Look, I live in Miami. I agree with you. I left New York. I'm back in Miami. I'm very happy in Miami, Florida, but we're still seeing that that the California and Florida are high demand. In California, even with the taxes, we still see 11% of people in that survey saying they were looking to move to California.
Jeff, also going off that survey, it was interesting to me what you saw just in terms of the forbearance and the need for that from some of your participants. 24% saying that they do anticipate needing to ask for further forbearance if government relief for COVID-19 is not extended. How do you see that affecting the housing market in the near term?
It's a great question. So first, let's talk about what the forbearance programs actually work, right? So they can opt in. They get 90 days, they can re-up for 6 months, and they can go up to 12 months. So when this survey was done a few months ago, and again, time is moving so quickly these days, I still think that people were thinking we may need to take forbearance, which is, do we feel really good about our jobs and when are we going to be back on our feet? So right now, it feels like the job market and unemployment's down to 6.9%. It feels like maybe that 24% will be lower than what it is going forward. But I think that's people also still saying, I have a little bit, potentially a safety valve. If I need it, I know it's there. I know I can pay the loan back on my terms later on. And they're probably saying this is something that we're still keeping in our arsenal to pull out just in case we need it.
Jeff Taylor is the co-founder and managing director at Emphasis Digital Risk, joining us from the shores of Biscayne Bay, Miami, Florida. All the best to you. Thank you for being here. Coming up, the COVID-19 pandemic continues to hit horrifying numbers in the USA. Former HHS Secretary Kathleen Sebelius is going to join us with some advice for President-elect Biden on ways to fix the Trump White House's faltering coronavirus prevention policies. Right after this.
We've got 30 minutes to go in the trading day. All three of the major averages in the red, with the NASDAQ actually right around the flat line. Dow, though, off 125 points. Jared Blickery, what are you watching as we get closer to the closing bell?
but pretty quiet day overall, as we've been talking about. Now, we do see some of the big tech stocks in the red, but not by much. You look at Apple, Amazon, and Facebook. Facebook is down the most, off about 0.2%. Looking at some of the biggest winners and losers here, Tesla, another outstanding day, up 12%. Zoom up 4.7%. Applied Materials up 2.5%. Looking forward to those NVIDIA earnings after the bell. To the downside, Moderna's off the most, 4%, and Trip.com down 3.8%. But now I want to get to our Yahoo Finance premium investment idea of the day, and that is Home Depot. So let's see what Argus Research is saying about HD. They're saying they have a bullish trend, and they are raising their price target to $325 from $320 on strong sales. So they're looking at their earnings report, which they released earlier in the week. Specifically, they're saying, talking about their comp sales at U.S. stores, they rose 24.6%, and U.S. comps were up 22.6% in August, 28.5% in September, 23% in October, all very good numbers. Also, they're saying that the company said in the third quarter call that customers are saying that their home has never been more important. The company's surveys show that customers have a continued willingness to invest in their homes over the next 6 months, and HD's customer satisfaction scores are improving. Just looking at the stock over the last 6 months, you can see kind of flatlined over the last, let's say, 3 months here, but still up about 10.7%. And then looking at the year to date real quick, we can see it is up 24%. Shauna?
All right, Jared Blickery, thank you. Well, Home Depot, one of the losers here in the Dow today, with the Dow off just around 175 points. For more on today's moves and what we've seen play out over the last couple of weeks, we want to bring in Ryan Dietrich. He's LPL Financial Chief Market Strategist. And Ryan, outside of today, it's been a very, very strong month for the market. We had the Dow up just around 12% since the start of November. What do you make of this move and the theory out there that maybe some of this move to the upside has been overextended?
Yeah, it's not just the Dow, right? Literally, as we speak, the Russell 2000's up over 16% for the month, which is the greatest 1 month gain ever for small caps. S&P 500 looking at potentially its second best November ever. So yes, in the very near term, I think it makes a lot of sense. We're probably overextended. I know I was on with you guys about a month ago and said, hey, listen, historically, you get a little weakness ahead of an election in October, and then November of an election year is usually pretty strong. We didn't quite expect it to be this strong, but you know, when you add it all up, I mean, this is a new bull market, right? I mean, small caps just made new all-time highs this week for the first time since August 31st of 2018. So there's different ways to look at this. In the very near term, though, it does feel like being bullish is a crowded trade. What I mean by that, look at the investor sentiment polls, look at the flows, look at put to call ratios. You know, market can keep going up in the feel-good time of the year that we're in, but it's a little more dicey, I think, is what we'd say, with everyone getting optimistic about so much good news that we're seeing. You know, on the vaccine front, and as the economy continues to defy the odds and do better, it seems like with just about every economic data piece that we see.
Many investors might agree with the caution, the red flag that you might be waving right now. But if you're looking at March and the vaccines are going to, look, they're going to get emergency use authorization. Mm-hmm. That's no secret. Everyone knows that's coming in the next week or two, if not tomorrow. They're going to get the vaccine. Isn't the market just going to keep going higher? Forget the red flag. And I'm talking for an investor who's looking at a horizon of just March.
Mm-hmm. Well, I mean, it could, I guess, Adam, is the best way to put it. Market's a forward-looking mechanism. We know that. It's looking past potential issues. I mean, I guess the thing that got our attention is that retail sales number yesterday, a little weaker than expected, and restaurant sales actually decreased for the first time in 6 months. I mean, look, New York City obviously just told students to do virtual learning. So there are these rolling shutdowns that likely are going to continue. And again, when everyone's getting too excited, that's when we want to pull back a little bit. I mean, at LPL Research, we upgraded our view on equities the last week of March. When we did that, we got some really weird looks. Unfortunately, things have worked out with a pretty big rally, obviously. So it's just kind of how you look at it. But at the same time, what's the market telling us? What's happened? Well, the strength around the election is truly almost mind-boggling in some ways. We saw almost over 70% of companies in the S&P 500 made a new monthly high right after the election. All that means is since 1990, guys, that's only happened 8 other times. That much breadth and that much strength in a short-term time frame.
1 month later, you get negative returns on average. You can get a pullback because you're just so extended. But a year later, S&P is actually higher every single time, 8 for 8. Small sample size, I get it. But again, one I wouldn't want to ignore. So this blast of strength is a good thing longer term, just more near term. Maybe let the pitch come to us is kind of how we're looking at things.
Ryan, what would you want to see just in order to justify the market being at its current level?
Oh, earnings. I mean, earnings matter. And we're wrapping up earnings season, right? It's pretty much over. I mean, it's just historic. 6 weeks ago, we're looking at maybe 21% decline in earnings. Now it's going to be negative 7%. 85% of companies beat. There's all these different stats. It was an incredible earnings season. I get it. The bar was really, really low. But what corporate America had to say about the third quarter and even into the future was really good. Earnings estimates actually increased during the first month of earnings season. That's really rare. That usually doesn't happen. Usually estimates kind of decrease is how it works. So if we keep seeing companies optimistic about the future, that's what we want to see to justify things. And, at LPL Research, we think this bull market's alive and well. And we think, this time next year we're sitting here, we might have, potentially double-digit returns from where we're sitting right now with the market still looking quite healthy, just a little stretch near term.
All right, Ryan Dietrich, great to have you back on the program of LPL Research. We look forward to talking with you soon.
Thank you.
All right, coming up next here on Yahoo Finance Live, we're going to dig a little bit deeper into that news we got out this morning. That, of course, is Pfizer saying that its vaccine is 95% effective. Coming up next, we're going to talk to former HHS Secretary Kathleen Sebelius. She'll join us with her advice to President-elect Joe Biden. That's coming up in just 2 minutes.
A lot of people like to complain about government bureaucracy, but never before in any of our lifetimes has the bureaucracy been more important to helping steer us through a global pandemic. That's one of the reasons we have invited into the stream Kathleen Sebelius, the former Health and Human Services Secretary during the Obama administration, as well as our correspondent on health, Anjali Gamlani, to discuss the steps that are going to happen in the next several weeks and months to protect us all from coronavirus. Secretary Sebelius, it's good to have you here. And I wanted to ask you, we're expecting the emergency use authorization any day now for one of these vaccines, either Moderna or Pfizer. What advice would you have for the rollout to get this to us for, for President-elect Biden?
Well, I think a couple of things are really important. First of all, the vaccine news is very good and encouraging. What we need people to understand is we're talking about spring of next year before
average Americans can really expect to receive a vaccine. So we have to take some steps now to not lose a couple 100,000 more people. That's what we're on track to do. 200,000 more Americans could die if we don't take steps immediately. And that's a very scary situation. I think the Biden team is trying to do what they can to prepare for the enormous logistics of vaccinating an entire country. But frankly, they need outgoing President Trump to cooperate. They need to get into the key agencies. They need to see what plans are already in place in terms of logistics and distribution. They need to start a very clear communications message, because the worst of all worlds is to have a safe and effective vaccine, either not be able to get it to the right people at the right time, or have people say, we don't believe it's safe. We don't believe it's effective. We've heard so many mixed messages over the months that we're actually not going to get vaccinated. Secretary Angela here. I know that we've heard a lot about Operation Warp Speed, and even Secretary Azar today was on a call with media discussing the operations and the idea of distributing the vaccine. But that's, again, going to take place during a Biden administration. What would you say is the likelihood of Operation Warp Speed in its current sort of existence continuing? And should the Biden administration look at it to continue, or should they change certain things about it?
Well, Anjali, I for one don't know much about what is in the next stage of the plan. What we knew is that the government infused a lot of money into possible vaccine candidates and manufacturing slots, and that's very good news. That expedited the stage of developing a safe and effective vaccine. We hope that the FDA will move quickly. What exactly is their logistics plan? How far along are they? My understanding is they've contracted with one of the 3 potential distribution companies. If we have 2 different vaccines, we're probably going to need to amplify that distribution. How are they going to get vaccine to tribal communities, to lower served areas? What is the responsibility of the governors versus the federal government? All of those questions, I think, are ones that the Biden team is trying desperately to answer, but they need to be able to directly communicate to the people who are in charge right now, to know what the handoff looks like, to know if there are gaps in the planning. My understanding is governors are being told to figure out when a vaccine arrives, how to get it to people in their states. That's very complicated, particularly since most state and local governments don't have the resources to do that. So what is the federal government going to do? What's their responsibility? Where are the gaps? And how can a new Biden team work very quickly to fill the gaps? 9 weeks from today is the inauguration. That's not a long period of time to get ready for this massive 2-dose vaccination of 330 million people.
Secretary Shawn, when we talk about the vaccine for the general public, like you said, it's still months and months away. What should the Trump administration be doing today, right now, when we see record number of cases day in and day out? What would you like the national response to be today?
Well, I keep hoping that the president, first of all, will allow the transition to go forward. That's step one. Get the GSA to sign the documents, let the Biden team into every agency, let the COVID task force that Trump put together communicate with the new COVID task force. That's really, really important. Secondly, the president has to acknowledge we are in a dangerous time. People are dying. Our caseload is up over the last 2 weeks is up 80%, 80. Hospitalizations are up almost 40%. We have 1,100 to 1,200 people a day dying. This is a very, very dangerous period, and we need some straight communication coming out of this administration. Wear a mask, social distance, keep home as much as you can. Don't gather with relatives or friends and family for holidays, as difficult as that may be. You want to see future holidays with them. I mean, we're talking about a deadly disease
that right now America is not got under control in any way, shape, or form. So we also need to really ramp up testing. That's on this administration. Get tests out to communities so they can do asymptomatic testing and begin further quarantining and isolating folks who have the disease, and make damn sure we have enough protective equipment to deal with the surge that's coming. What we know is case identification is 2 to 3 weeks ahead of a surge. And right now we have hospitals all over this country that are jammed with COVID patients, starting to cancel elective surgeries again. If you have a heart attack or a stroke right now and you're in the middle of the country, like where I live in Kansas, you're not going to have a hospital bed. You may be in really terrible trouble in an emergency. So we're in a crisis right this moment. And we have a president of the United States who hasn't spoken about this in weeks.
So you were at HHS. You came in around the time the country was first dealing with SARS, and you were leaving HHS around the time that Ebola was threatening the United States. So you dealt with these kinds of. But let me ask you personally. When the agencies of the federal government refuse to cooperate with a president-elect, and then members of Congress enable that stance, personally, what goes through your mind?
Well, I think it's criminal, frankly. I think we are in a life and death situation for far too many people. This is not about a petulant president who can't admit that he lost an election. This is about people's lives every day, and refusing to share information, refusing to allow the team coming in to get ready for what would be, under the best circumstances, a massive logistic effort, a massive national undertaking. We have a federal government who, other than Operation Warp Speed, which was solely aimed at the vaccine, that's good news, but it shows what the muscle of the federal government can do in partnership with the private sector. We need that kind of effort on every front. We need it on logistics. We need it on mask wearing. We need it on communication. We need to have priorities spelled out. Joe Biden has a view that the federal government has to take the lead, but he can't even get the information to find out where the gaps are right now from the outgoing administration. Staying on that federal agency platform, I think one of the most interesting things has been the damage done to the credibility of some of the agencies, including to the HHS, for not taking a stronger stance and not doing more. I just wonder, what would you say to Secretary Azar right now, or what advice would you give him just with just a few months left in order to help change the course? Well, I continue to be optimistic. I'm not quite sure why, but I continue to hope that the health officials in place right now will step up and tell the truth to the American public, will step up and deliver the kinds of services and support that they need. We've seen sidelining of the CDC, which is the public health backbone of this country, and enormously important for both communication, but also priorities of who gets vaccinated first, how we track the disease, what kind of information comes in, how transparent that is. They need to be front and center once again. I think in the incoming team, Joe Biden knows these federal agencies well. He also went through H1N1 at the beginning of the Obama administration, and he went through the Ebola crisis. So he is well suited, as his team is, to deal with this. But right now they are being blocked in a way that we've never seen before in this country. And the United States Senate not only is empowering the current administration from not conducting the transition, not sharing information, putting us in a very precarious, I would say, threatening our national security. But Mitch McConnell also is sitting on a relief package. If you want people to stay home, if we want people to think about restricting their commercial activities, we need to be sure and put some resources to those individuals. We need to make sure that cities and states are ready with the resources, with hiring additional personnel to get ready for a national vaccination effort. We need to have some resources available to counter what could be the economic downturn. So again, Mitch McConnell sort of has the keys to the castle. Both they could insist that the president move ahead and that the GSA move ahead with the transition, and they can pass a financial aid package, even if it isn't all of what is needed. Get some money out to cities and state, get some additional unemployment insurance going. So when people think that it may be a better choice to stay home and not spread the virus, they can feed their kids and pay their rent.
Secretary, you mentioned before how so much pressure has been placed on the governors here over the last several months because of the lack of a national strategy. I'm curious from your perspective, from how you've seen various governors handle the situation. Are there any states that you think that have handled the pandemic exceptionally well up to this point?
Well, I think a number of governors stepped up and stepped out and spoke up and tried to follow the science as much as possible. They have been in what I would say is an impossible situation. The Democratic governors who tried to do this, like Gretchen Whitmer, like our governor here in Kansas, like governors in Virginia, were attacked by the White House. A president of the United States chose to play partisan politics with the governor trying to keep his or her citizens safe and secure. We've never seen that before. Governors have been told since March they're on their own. Go find your own protective equipment, bid against one another, and in some cases bid against the federal government. Never seen that before. Never have had the federal government literally walk away from a national health crisis and say, you are on your own. So I think governors, Republicans and Democrats, will welcome a defined federal role, will welcome the notion that the federal government will use and muscle all of the financial resources, the logistical resources, the communication resources to help us get through this. So they won't be trying to fight this a state at a time, a border at a time, and fight with the White House at the same time.
Kathleen Sebelius, the former Health and Human Services Secretary, thank you. We're going to be right back.
Thanks.
Welcome back to Yahoo Finance Live. We want to bring in Yahoo Finance Editor-in-Chief Andy Serwer. And Andy, one of the things that we have been talking about today, one of the big stories has, of course, been the worsening coronavirus pandemic and the threat that this could pose to the economic recovery at this point. We still don't have a stimulus package. We got some headlines out earlier this afternoon that still shows the two sides
very far apart. And of course, this begs the question just in terms of the position that President-elect Joe Biden is going to be in once he is sworn in, once he does take over the White House, and really, I guess, the challenges that are presented to him on that first day.
Yeah, that's right, Shauna. And of course, it's not just him, but it's in his entire administration, including his next Treasury Secretary. And speaking of Treasury Secretaries, earlier today, we spoke with Larry Summers, who was once a Treasury Secretary, of course, now back at Harvard, and asked him a little bit about this economic environment and what it would be like for someone in that role. Here's what he had to say.
Broadly, the challenge is restoring reasonable economic growth and maintaining it in the post-COVID environment. I think it's going to be a very different environment than most of us grew up in. It's going to be an environment where there's going to be slow and sluggish growth of demand, where interest rates are going to be essentially on the floor. So there's not much that the Fed can do. It's going to be an environment where the issue is going to be more insufficient inflation than excessive inflation. It's going to be an environment where, because of the shortage of investment opportunity, there's going to be a tendency for savings to flow into purchasing existing assets and bid them up, leading to more leverage and more possibility of financial instability. So I think it's going to be a challenging environment. On the other hand, an environment of such low interest rates is an opportunity with historic opportunities to invest and earn very high returns. And so taking advantage of this high saving, low investment, low private investment opportunity to do really important public sector things is going to be a major challenge for the next Treasury Secretary.
Yeah, and so Shauna, understanding that it sounds like he's looking at potential financial bubbles, say in the stock market, and then the challenge of finding investments for the government itself to get into infrastructure, for instance, that makes sense, is going to be an interesting, as he says, challenge going forward, Shauna.
Yeah, a huge challenge here going forward, especially over the next several months. Andy Serwer, as always, thanks so much for jumping in and joining us. We're going to take a quick break, just under 5 minutes left in the trading day. All three of the major averages seeing some selling into the close. We're back in 2 minutes. Just a minute left here until the closing bell. All three of the major averages in the red. We've seen some selling action here into the close. The Dow now off just around 300 points. Jared Blickery has a closer look at this sell-off for us. Jared.
Let's go straight to the charts. And taking a look at the Dow, you can see how the losses have really accelerated over the last hour, and not any one particular catalyst or news item that appeared in the last hour that I'm saying. Just in general, we have all this lockdown news, and that could be contributing to it. But if you take a look at, for instance, a 3-month chart, you can see we're still consolidating near those highs after breaking out in the Dow and the S&P. So back to the Dow, kind of failed at 30,000 once again. Not too troubling, but we want to see what happens for the rest of the week. Similar story around the S&P 500. Well, let's take a look at some heat maps, and we got the NASDAQ 100 showing some red here. It looks like the big cap guys are selling off into the close the most, although energy is still the most down for the day. And one of the outstanders here is Tesla, and we are seeing that up 10% right now.
And that does it for the trading day today. Again, some selling into the close here as we shake out the final trades of the day. The laggards being energy, utilities, and healthcare among the worst performers here when we take a look at the sector action, pointing to some of that broader market selling that we've seen over the last couple of hours. For more on this, we want to bring in John Stoltzfus. He's a chief investment strategist with Oppenheimer. We're also joined by Matthew Lazzetti. He is Deutsche Bank's chief U.S. economist. John, first to you, when you see this type of selling into the close, the market, I think, over the last several days has been leaning towards more of some of those positive headlines. What do you make of today's action and some of the weakness that we're seeing?
Shauna, thanks for having me on the show. I've got to say, where we are today, we think, the market has really been in a celebratory mode since election day and rode through it again last week. And I think the idea now is people are beginning to consider taking some profits ahead of expectations. The taxes related to capital gains could rise in 2021. I also think, there's the consideration of the transition in COVID to post-COVID. Even with the resurgence, all the vaccine news tells us there is a post-COVID ahead. Transition in the presidency, transition within market cap, growth and value. There's a lot of excitement here, and the gains have been substantial if you consider that on a year-to-date basis, with all the trouble we've had, the S&P 500 up around 11%, 10.43% year-to-date. You've got infotech up over 30% year-to-date, discretionary 27%, consumer service, communication services 17%, materials 13%, even industrials up 7.7%, over 7%. And so there's an opportunity for profit taking. We don't think it's a big deal yet, but we do think January 5, that runoff in Georgia, is a big date for the markets here.
Matthew, I'm curious that no one ever got poor taking profits when markets were high. What should an investor who's looking at maybe pulling a little profit out today, if they're going to try and not necessarily time the market, but have a time-based strategy, be looking at next? Is it the December FOMC meeting? Is it the virus and the distribution of the virus? Or is it the January 5th election that could determine control of the Senate?
Yeah, thanks very much for having me. I think from a fundamental economic perspective for the U.S. economy, we're of two minds right now. One of which is in the near term, with the lack of fiscal stimulus likely until after Inauguration Day, and with COVID cases, both case growth and hospitalizations at record high levels, we think consumer spending really comes under some pain here in the next several months. We see sequential declines in consumer spending. The real economy kind of stalls out here a little bit, and the labor market also stalls out. Now, we have to distinguish that, I think, from Q2 and likely beyond, where we've gotten better news, particularly on the vaccine front, from Pfizer and Moderna, promises to deliver 100 million doses of vaccine each during that period. It suggests that we may be able to bring forward some of the consumer spending and rebound in services that we were expecting to see later in 2021. I think critically, the fiscal outlook helps to bridge the gap between those two. We don't think you get a lame duck bill. We think the next point that you get a fiscal stimulus package is after Inauguration Day. But as you noted, that January 5th election outcome is critical to that. We think we have a divided government. We think Republicans will win one of those seats, and therefore we get a smaller fiscal package. But if Democrats somehow win both, you are in a situation where we could see a $2 trillion plus package legislated in early 2021.
John, do you think a smaller fiscal package, do you think that will be enough just to meet what the market has been expecting?
Yeah, I do, Shauna. I think a smaller fiscal package is digestible. It's the big one, particularly related to the size of the fiscal packages that we've had to put in as rescue packages because of COVID, right on back of all the stimulus that we had as a result of getting out of the GFC or the great financial crisis. It's a little bit much to think that the market won't get into a bit of a tizzy trying to consider a massive stimulus package. But a small one, I think, is fair enough. I think it'll digest that. It'll still likely tip its hat somewhat and decline somewhat if with that. But I don't think for long, because then it will look for the recovery process that we believe is ahead.
Matthew, if we see the economy return to its pre-virus level of activity before the end of 2021, which are the sectors that investors should want to position themselves for that rise?
Yeah, you've had a very different recovery and downturn than we've had in the past. You've seen housing data we got again this morning, which was solid from housing starts, basically at pre-virus levels and above on some metrics. We see CapEx has already returned to pre-virus levels. Both the decline was very shallow and the recovery was very rapid there. At this point, it's mostly about the services sector for the consumer spending. That's the one category that remains well below pre-virus levels. We think will continue to lag as it's going to take some time for households to get confidence to either go back out for traveling or go out to restaurants or movie theaters. A lot of these leisure and hospitality categories. Those are the things that really should start to pick up and get back to pre-virus levels of activity. As we have the vaccine brought on board, we get more people vaccinated throughout the course of 2021.
John, how are you looking at the travel and leisure sector? Because I think some of our guests come on and say that this sector has been so beaten up over the last several months. They are trading at such a discount to where we were heading into 2020 that maybe now is the time to buy. How are you reading that? Do you think it might still be a little bit too soon from an investor's perspective?
I think from an investor's perspective, it might be a little too soon. They may be better off waiting for a pullback on any disappointment in terms of adaptation of the vaccine. I think we're pretty sure we're going to get a vaccine here by year end that'll begin to be distributed. And with that, the big question will be how quick will people be to have access to it as well as to accept it and take it. We think that, however, that said, we think that leisure has a good opportunity to come back, but it will take some time. The effects of COVID-19, whether it's social distancing or wearing masks, and the fact that it had the potential, which was realized tragically on the people who passed away from this illness, it's serious enough. So we think they're going to be slow to get back into the cruise ships. We think they're going to be slow to do a lot of heavy business travel, and in terms of personal travel, we think it'll come back modestly, but perhaps in the second half of next year, if the vaccine is well distributed and well adapted, you could see a real big jump up in those areas in terms of improvement in prices.
Matthew, we're seeing some really good earnings, for instance, Walmart and Target. But I'm curious, as we go into the holiday season with the spiking coronavirus cases, could consumer discretionary take a hit just when everybody's expecting people to be spending a lot of money? And could that hit stocks as we get ready for first quarter earnings after we get through the holiday season?
Yeah, I think a lot of the surveys that we see, Gallup was one, others are suggesting weaker spending around the holiday season than we've seen in the past several years. Certainly that makes sense in the context of still pretty elevated unemployment. We're still at 6.9% unemployment. We've had more than 20 million households lose the additional benefit that they've seen from the unemployment benefits. So you still have a labor market which has deep scars, is in a pretty deep hole, income which is depressed, and a lot of near-term uncertainty about job prospects given the COVID case growth and the return of restrictions. So I think it shouldn't be too surprising if we see some underperformance in consumer spending metrics over the next several months. My own view is that is not really factored into consensus expectations yet. The consensus still thinks 4% real GDP growth plus for Q4 makes sense. Still thinks 4% plus for consumer spending growth for Q4 makes sense. I don't think that's factoring in the sequential decline we are likely to see in November and December for consumer spending.
Matthew Lazzetti and John Stoltz. It's always great to have you on the program. We'll talk to you both soon.
Thank you.
Coming up here on Yahoo Finance Live, as coronavirus cases spike, we're going to talk to health expert Suzanne Judd of the University of Alabama, Birmingham, on what exactly needs to be done right now ahead of the holidays here, because it's such a critical time when it comes to containing this virus. We're back with that in just 2 minutes.
Welcome back to Yahoo Finance Live. We've been talking a lot about the expectation for emergency use authorization of the Pfizer COVID-19 vaccine and eventually the Moderna vaccine. Let's talk more about the impact of all of this with Suzanne Judd. She is a PhD epidemiologist at the University of Alabama at Birmingham School of Public Health. Thank you for joining us.
You're welcome. Thank you for having me.
It's not lost on me that a representative from Alabama, I think it's Outerhort, is in quarantine right now because of potential exposure to COVID-19. I mean, anybody can be in proximity to anybody these days and then have to quarantine. So where we are in the pandemic, why are people not getting the message? Wear a mask, wash your hands, and limit your contact with friends and family?
We call it pandemic fatigue. People are just tired of COVID, so they're not following the social distancing requirements. They're not wearing their mask. They're going to gatherings that have just 15 or 20 people. And if one person is COVID positive, 10 people walk out with COVID. So people have just become really relaxed about their gatherings. I was just looking through some contact tracing data earlier this week, and it was from a church, and folks were saying, oh no, I just took my mask off to sing. That's the only time I took it off. Well, that's the worst time to take it off because that's when you can really expel a lot of virus.
Suzanne, when you take a look as to what we could be seeing now in a month or 2 months from now, because I think the numbers that have been reported over the last week might be more intense, and I think it accelerated at a faster pace than many had been expecting. So what do you think that situation is going to look like once we're in the middle of winter?
It doesn't look good for the middle of winter, depending on what your definition is. I would say January is when it really isn't looking good, especially if people don't take Thanksgiving seriously, followed by the holidays in December. If this weekend people get together and have small gatherings to watch sporting events or go to church, or even children's elementary basketball games, and they're not wearing their masks, then they go to Thanksgiving and another gathering of 20 or 30 people.
we're going to see this rise in cases. Canada saw a large rise in cases following their Thanksgiving, which is more the beginning of October. So we really have to be vigilant in these times and try not to have gatherings of more than 10 people, just a couple of households together for Thanksgiving, which is just not the way Americans typically celebrate Thanksgiving.
They just announced here in New York City that they're going to close the public schools to in-person schooling. But yet you point out there's a bright side in the midst of all of this sad news, that the transmission rate within classrooms is lower than expected.
Yeah.
What does that mean going forward? And why is that? It sounds hopeful. Is it?
It is hopeful. We want to have kids in school, and the data showing that transmission is down when they're using universal precautions like masking and staying 6 feet apart and keeping the kids in small groups. The fact that we're seeing not very many cases coming from K-12 is an opportunity to potentially keep the schools open after January. It's an opportunity to continue to examine how the virus is transmitted in children. So to me, that's a bright spot. That plus 2 vaccines that look very promising may mean a much better first, second quarter in 2021.
Does that mean that maybe these closings of schools, that's a little bit preemptive at this point? Because like you were just saying, as the data has shown us over the last several months, that it's not spreading in classrooms at the same rate as it is outside and amongst other social gatherings.
It probably is a bit preemptive. I don't know what the data are like in New York. I haven't seen them directly. It could be they have a few examples of in-classroom transmission. It could be a lunch event or a playground event. So they may actually have something they're concerned about. But here in Alabama, we haven't seen too much transmission in the schools. A few schools have had events, largely around sporting activities, basketball games, football games, where people have taken their masks off and they're very close to one another.
You're an epidemiologist, you have a PhD, you spend your life, this is your specialty, tracking diseases.
It is.
What is it like for you to see the most powerful nation in the world essentially on its knees to this pandemic?
It is so hard to watch. It's so hard to watch and to see the way that it's political, although this is not the first time we've seen it. HIV was the same way back in the 80s. It was considered to be a gay-related disease, which was absolutely crazy. We knew in public health there was no such thing, but that was the way it was marketed. And so we see this over and over again in public health because people don't like the idea of having their behaviors controlled to keep somebody else healthy. So I wish I could say I've never seen it before, but unfortunately, this continues to play out over and over again.
Dr. Suzanne Judd, PhD epidemiologist at the University of Alabama at Birmingham. Thank you very much for joining us from Birmingham School of Public Health. All the best to you.
Thanks for having me.
Coming up, we're going to hear from Richmond Fed President Tom Barkin, why he still sees a rough several months coming up as we battle the latest COVID-19 surge. We're back right after this.
Welcome back to Yahoo Finance Live. The Fed has warned in recent weeks that the U.S. economy really could suffer as the coronavirus pandemic gets worse. We want to bring in Yahoo Finance Fed reporter Brian Chung. And Brian, earlier today, you sat down with Richmond Fed President Tom Barkin. What did he have to say about all this and the implications for the economy?
Well, Shauna, a lot of developing news, obviously, on the economic front with the amount of COVID cases hitting a new record this week. But then on the other side of the coin, the positive development with Pfizer, BioNTech, in addition to Moderna just this week. So the question is, with both of those things together, net, are those developments causing a revision up or downward in the economic forecast? Here's what Richmond Fed President Thomas Barkin had to say in response to that question.
Well, you've got near term and you've got medium term. Obviously, one of the scenarios that we were all worried about 1, 2, 3, 4 months ago was a second wave scenario. I think if you look at the case rate or the hospitalization rate today, you have to say that it's elevated. And I take from it that as cold weather comes and people spend more time inside, the infection rate is going to increase. And so I think for the next few months, it'll be a challenge. And it'll be a challenge as people try to adapt to their perception of increased risk. I think it'll be a challenge as governments try to adapt to what they can do to handle that. On the positive side, I think these vaccine results have put a light at the end of the tunnel. And most people I talk to suggest it's summer when you're finally going to see the light as opposed to next month. But I think that's a very positive thing for businesses who, now might see a path to invest, and certainly for some people in those harder hit industries who now might actually see some hope at the end of that ride when we get that vaccine distributed.
Now, at the same time, it seems a lot of businesses and economists, for that matter, are not hanging their hat on that vaccine, saying that it's still going to be some time before we get that, as you just pointed out. But in the meantime, if it is indeed, not until next summer that we get something, would that force the Fed to do more if we're on the trajectory that we're on with the amount of COVID cases and deaths right now? And if so, the Fed having to do more, what might that mean or look like in your view?
Well, we're doing quite a lot. We've taken rates down to near zero, as you know. We've put forward guidance in place that says we're going to keep rates low until such time as we're through all this. And we're engaging in asset purchase, which are incredibly high by historical standards. I'd also say that every month we engage in those asset purchases is more stimulus. In other words, we did it last month, but if you do it again next month and the month after, that's more stimulus. And I think that's a lot of support to the economy. In terms of whether we would do something different or more, let's just see how it goes. I mean, we're projecting a lot. Let's see how it goes.
So I want to shift gears now to the framework review. The Fed saying that it'll tolerate inflation rising moderately above its 2% target for some time, in addition to trying to get to maximum employment. But an important caveat to that, it sounded like, was that the Fed could tighten or adjust its policy if it felt like financial stability risks were emerging. In your view, what might be a financial stability risk that could be substantial enough to cause the Fed to rethink or recalibrate its policy?
Well, in this review, we acknowledged, I think, a couple things that were certainly clear to me beforehand and perhaps to others. One is that there's nothing bad about low unemployment, and the notion of being preemptive with low unemployment without signs of other risks was probably not the move we need to make. And so I think we made that clear. I think I certainly was in the mood of being willing to tolerate moderate overshoots of inflation. I think it made that clear as well. And then I think it made clear that a sound economy requires financial stability. And so all those came clear in both our framework discussion and also our most recent statements, which have said we'll keep rates low until a quite long time, certain conditions on that. And then that'd be true unless we saw risks develop. I think we'll have to see what kind of risks develop. I do personally look closely at the implications of lower for longer policies on people's reach for yield behaviors and on the buildup of leverage. And so the thing I personally spend time looking at is leverage, and leverage on personal balance sheets and leverage on corporate balance sheets. I'd point out that while corporate leverage is somewhat up, personal leverage is actually still somewhat down.
We've seen credit card payments actually go down quite a lot over the last 6 months. Credit card balances go down quite a lot over the last 6 months. But that's what I focus on. Now, how that plays into, what we do with rates or asset purchase or whatever, I think would be to determine. But that's what I look at, because if you're not going to have a sound economy without a stable financial system.
And I guess just to be clear, that's not necessarily saying that you see that as the case right now, financial leverage building to a level that would be of concern. I mean, we've heard people flag, for example, leveraged loans, but where do you see, I guess, those pressures right now?
Yeah, there are elements that historically elevated, but in total, I don't think leverage at this point is at historically elevated levels. That's what I'm watching.
So another part of the framework review is the real focus on inflation. We did get an interesting remarks from Vice Chairman Rich Clarida this week, saying that his approach to personal consumption expenditures, one of those measures of inflation, is going to look at the average PCE using August as kind of the start timeframe, which is when the framework review was unveiled. It wasn't clear to me, based off of that speech, if that's uniform, whether or not each member of the FOMC is beholden to that same interpretation. So I guess from your vantage point as one of the members of the FOMC, is that also your interpretation of how to measure when inflation is moderately above its target, or are you kind of free within a range to kind of evaluate inflation on your own criteria?
Well, I think what I'd say first and foremost is, we're pretty explicit in the communication around the announcement of the framework review that we're not going to a formulaic concept. We're not talking about add up this, divide by that, and if the average is greater than X, we do Y, and less than Z, we do something else. So I think we've made that pretty clear. So I don't have an average formula focus, and I think it's judgment based against the words we've got in that statement. So that, I think maybe I'll just pause there.
Mm-hmm. Yeah, well, I mean, I guess what's interesting too is that the vice chairman was saying it's not just core PCE as a lagging indicator that we're looking at. It really is more about inflation expectations and a dashboard of other data as well. What do you watch on that front?
I watch actual inflation. I watch inflation expectations, and as a lot of people have said, including the vice chair, there's a lot of different ways to measure inflation expectations, and it's hard to get precise. I also try to, as best I can, access the minds of those people who are price setters in the economy. I spend a lot of time, as you know, engaged with businesses. We do, for example, a CFO survey, which has pricing as one of the key things they're looking at. I'm just trying multiple ways to see what are people expecting in terms of inflation, and how much pricing power do they feel they have. I think you can learn a lot there on the ground.
So you mentioned on the ground, again, you're in Hughesville, Maryland right now, meeting with contacts. You're a person who's been very storied in the business world as well. Switching to the other side of the dual mandate from inflation to employment, we know that the Federal Reserve is really pinning its hopes on trying to get back to where we were before the crisis. Based off of your conversations with business owners, workers, those who have lost their job in the 5th District, the Richmond Fed, how far away are we from full employment right now in November?
Well, we're certainly far away from where we were in February. If you held participation constant, the 6.9% unemployment that we've reported would actually look like 9.4%. Today. It's about 10 million jobs, and that's about 6.6% fewer jobs than we had before the crisis. And that compares to, at the peak of the Great Recession, we were down 6.3%. So we're still pretty far from where I think would be full employment. Now, the challenge we've got is that the jobs that have been surplus are disproportionately all in one type of job, personal contact service workers. And those personal contact service workers are disproportionately young, and they're disproportionately people of color. They're disproportionately in the bigger cities. And the jobs that are actually, if I talk to employers, I hear a lot of people talking about they can't find workers. And those employers that can't find workers are disproportionately in manufacturing, they're disproportionately in technology, they're disproportionately in healthcare, and they're disproportionately in some of the smaller towns. And so one of our challenges here is making that match. And it's hard to make a match when we may have a vaccine and it may roll out in a couple months, and we may go back to normal anytime soon. So people's willingness to invest in retraining or reskilling or invest in moving to a new geography is limited. So I think we've got a mismatch issue right now that is leading some people to actually have to raise wages well before you would think it was full employment, because we've got this, I'll call it a temporary mismatch between the people and the skills that have been surplused and the people, the skills, locations where they need to hire people. And that's a place I'm very focused right now as I talk to employers, as I talk to people who are out of work.
So when we talk about building the bridge for some of those disproportionately affected people, in the meantime, at least they've had unemployment insurance to turn to. But there's something interesting about how the pandemic emergency unemployment compensation, which is the extended benefits for longer term unemployment, in addition to pandemic unemployment assistance for gig contract workers that aren't normally eligible for UI, those benefits that are part of the CARES Act are going to expire December 26th. We know this is going to be longer than that, even that these people will be out of work. What would that cliff do based off of what you were just saying about how dire it is for those people to get help? And do you think that puts an onus on policymakers to do more?
Well, those benefits do expire. And certainly for a number of those individuals affected, I think the question of whether they can get access to additional benefits to bridge them is an important issue. I don't know how big a cliff that'll be for the economy on any given day. And the reason for that is there's been a lot of stimulus already put into the economy. And I've been intrigued with numbers that have shown excess savings, if you will, in the US population, somewhere in the range of about $1.2 trillion since April. And that $1.2 trillion, unlike most savings rates, is actually pretty evenly distributed across the population. So if you want to think about it this way, the bottom quartile has about $300 billion in excess savings. Now, not everyone has that. And so some people who are really close to the edge are going to be in trouble. I was talking to a utility today about some of the issues in terms of people not paying their electricity bill. Those are people close to the edge, and they will need a bridge of some sort. But in total for the economy, I think that money will continue to bleed into the economy, at least, you know, in the bottom quartile, bottom half for some time, and that'll bridge the total numbers somewhat. And so I do think we've got to think about the folks at the bottom end. We do have to think about them individually and how they're going to bridge to what comes next. That's different from the impact on the economy in total.
So you can hear the commentary from the Richmond Fed president right there saying that he does think that the vaccine developments present a light at the end of the tunnel, but that we could be in for a difficult few months. We also did have the chance to talk about the Federal Reserve's liquidity facilities, those 13 liquidity facilities, 12 of which are set to expire in December. President Barkin saying in an additional part of the interview, which is going to be clipped and added to our web, that he does think that it's a positive risk management, but he said taking away those liquidity facilities obviously means taking a risk. And again, for anyone interested in seeing the rest of that interview, you can find it on yahoofinance.com in addition to the transcript, which is also on our site. Shauna, Adam?
Brian Chung, thanks so much. And again, like Brian just said, if you want to check out that interview, again, the full extent of the interview, feel free to check it out on yahoofinance.com. Brian Chung sitting down with Richmond Fed President Thomas Barkin. All right, we want to get to some breaking news that we have after hours. NVIDIA is out with its results. Shares under a little bit of pressure here after that earnings release. Jared Blickery has the numbers for us. Jared?
Yeah, we've been seeing the stock swing from positive to negative territory here. And overall, the numbers are really good. Some huge beats, record revenue, and it was a beat as well. So third quarter revenue came in at $4.73 billion. That's up 57% year over year. Estimate was for lower at $4.42 billion. Adjusted EPS came in at $2.91. The estimate was for a bit lower at $2.58. Gross margins. Now, that may be something that the street is concerned about here, investors concerned about, because that came in at 65.5%. The estimate was for just 10 basis points higher. But when you're a high-flying stock like NVIDIA, investors want those big beats. So let's get into some of their segments. Data center revenue, $1.9 billion. Estimate was for lower at $1.8 billion. Now, this represents a 162% increase from a year earlier. Now, last quarter, they were up 167% from a year earlier. Most analysts did not think they were going to match that. They just about did. Some of those analysts thought it'd only be coming in at 50% growth. So big beat there. Gaming revenue, $2.27 billion. Estimate was for lower at $2.1 billion. That was a record. And then finally, professional visualization revenue, 236 million. That was a nice beat. Oh, and I got one more. Automotive revenue, kind of a new place for them, 125 million, estimate for 114.6 million, but that is a big part of their future growth case. Now, Jensen Huang, he's the founder and CEO of NVIDIA, came out with a statement. We are firing on all cylinders, achieving record revenues in gaming, data center, and overall, continuing to raise the bar with NVIDIA AI. Our A100 compute platform is ramping fast with the top cloud companies deploying it globally. We swept the industry AI interference benchmark, and our customers are moving some of the world's most popular AI services into production. So big beats all around. Margins, not exactly what the street were expecting, but overall nice work. And we see the stock up about 37 basis points right now. Just looking at a longer term chart, this is over the last 6 months, up 53%. And you can see kind of going sideways as a lot of tech stocks have, but we'll have to see if there's another catalyst in the near future. So far, doesn't appear this earnings is going to be that catalyst.
Jared, we're also seeing in the post-market, L Brands getting a bit of a boost, up more than 3%. How did they do in the third quarter earnings?
Now, L Brands is doing very well. That stock is up, let's see now, about 5-6%, only 3% right now, but had been higher. And they had some really big beats. So third quarter adjusted EPS, that came in at $1.13. The estimate was for 11 cents. And some Wall Street analysts were expecting a loss, but they swung to a positive. And their third quarter EPS was $1.17. A year ago, it was 91 cents to the downside. So that was a loss. So really in the midst of a turnaround here. Their Bath and Body Work direct sales were 446.5 million. That's up considerably from the prior year, 192.4 million. And this is an area of growth for them. So we'll have to see what comes in the call today, but so far looking good for L Brands as well.
All right, Jared Blookery, two names that investors should keep on their radar as we look ahead to tomorrow's opening bell. All right, we're going to take a quick break, but when we come back, they're the Airbnb of Latin America. We're going to talk to Kasai's CEO on what's next for the home sharing business and also what factors could push the industry even higher. We're back with that in just 2 minutes.
Welcome back to Yahoo Finance Live. We want to talk about the Airbnb effect with hospitality startup in Latin America, Kasai. And one of the things that's important is that despite the pandemic, we're watching people who will get on airplanes go to locations in Mexico and in the Dominican Republic. You can see that data. at the Airlines for America. But somebody who knows that on the front lines is the CEO of Kasai, Nico Barawid, and he's joining us now to talk about what you're seeing as far as people who are booking in Latin America. So do you expect this trend to continue? I mean, we've got the Airbnb IPO coming up, but it seems as if people are willing to go to warm, lovely locations. And for that, you have to head south of the border.
That's true. Thank you for having me, Adam. Yeah, you know, what's interesting about the travelers that we have now is that previously, prior to COVID, we had primarily international travelers that we saw in Mexico City. We have about 200 units in Mexico City. And what happened in April and May was that whereas previously our shift was majority international travelers, now it was mainly domestic travelers, so travelers traveling within Mexico. Since September and October, the international travelers, as you say, have come back. And so, you know, we see travelers both coming to Mexico City in addition to travelers, you know, working from the beach destinations of Mexico. But I think what's going to happen as a result of COVID is that the heavy focus that a lot of international brands had on international travelers is going to totally change because now the majority of the business locally, as is the case in every country around the world, is local domestic travelers.
Nico, I'm curious how this has affected your pricing strategy, because we've seen Airbnb raise prices on some of their one-night stays as a result of the fact that not as many people are booking trips. What are you guys doing because of this?
Our pricing strategy has very much reflected the shape of the curve of the business since COVID. So just like the rest of the industry in April and May, we did have very attractive discounts for travelers that were staying for a month or two. Whereas now, our average length of stay has gone down from over 30 days in April and May to now back to where it was prior to COVID and about 4 or 5 days. And so as a result, our pricing strategy has reverted back to what it was in January and February. An interesting thing to the point that I was just making was that previously we were pricing primarily in US dollars, whereas now, as I mentioned, we see a lot of domestic travelers. And so now we're pricing as well in Mexican pesos.
When you talk about boutique travel apartments, I mean, you've got to have a plan, I would assume, for expansion into other parts of perhaps not, we keep saying Latin America, but Central America, even South America. You just raised $48 million. What's next on the target?
Totally. As I mentioned, we have about 200 units in Mexico City, and we are looking primarily at expanding to the primary business sort of tier one cities in Latin America. And so we're actively exploring an expansion to Sao Paulo and Brazil, in addition to other corridors across the region.
To what extent are you competing with Airbnb? Because as I understand it, their exposure, at least to Latin America, is relatively small.
Yeah, what was interesting about their S1 was that Latin America had actually the smallest percentage of room nights in the entire portfolio of Airbnb. So they had about 7% of their room nights were in Latin America, and then 10% of their revenue was from Latin America. But from our perspective, we have a very close relationship with Airbnb. What's interesting about our business prior to COVID versus now is that prior to COVID, about 85% of our inbound traffic came from platform channels like Airbnb. It wasn't just Airbnb, it was also Booking.com, et cetera. But we relied mainly on these platforms. As a result of COVID, we focused internally a lot on building our sales and marketing efforts to the point where now over half of our revenue comes directly. And so we work closely with Airbnb because they are very much a leader in the space, but we are also diversifying our own channels.
Would you sell to them if they called?
We're focused on executing, so we're building our brand.
Let me follow up real quick, because is it difficult? I was just in Buenos Aires before the pandemic. Love the city. Hope that there are plans for you to expand in Buenos Aires. But is there a problem with currency exchange and the different economic situations that different cities might experience that you would grow into?
Not really. I mean, as I mentioned, prior to COVID, we were pricing mainly in US dollars, and now we have a mix of guests that are paying both US dollars and local currency. But the reason that it's not really that much of an issue for us is because most of our expenses are in local currency. And so, I think FX challenges happen when
income and liabilities are in different currencies. But for us, it actually makes it more closer to having all of our expenses and income in the same currency.
Nico, who is your demographic? I mean, is it mostly millennials? Is it the younger generation, Gen Z? Is it older travelers? Is it a bit of everyone? Who is it?
Yeah, Shauna, that's a great question, and also something that's also changed a lot since COVID. So prior to COVID, I would say our prototype was, a technology executive from New York or LA that was coming to Mexico City for the weekend and had heard that Mexico City had great food, right? So we were primarily targeting international travelers, and all of our marketing was in English. Whereas since COVID, as I mentioned, since so much of our traveler base has become domestic, now I would say we don't have clear data on this, but just anecdotally, we see more older travelers. So, businessmen and women from other cities in Mexico coming. And whereas previously our marketing was in English, now we're beginning to do some marketing in Spanish for the local audience.
Adelante, forward. All the best to you. Nico Barrow, Kasai CEO. We're going to be back right after this. And when we do come back, we're going to let you know that game on. Esports is getting bigger and bigger, especially for hard-to-reach Gen Z. Brandon Snow of Activision Blizzard's esports division on what they have coming in the pipeline and why Big Blue is coming on board too. We're going to be back after this.
Esports is a booming industry. It's projected to hit more than $1.5 billion in marketing revenue by 2023. So here to talk a little bit more about this, we want to bring in Brandon Snow. He's the Senior Vice President and Chief Revenue Officer at Activision Blizzard Esports. Brandon, great to have you on the show. Let's just start with Activision reaching a new multi-year deal with IBM. This is a huge deal, not only for your company, but also for IBM, because it's really their foray into esports. What kind of edge do you think does this give EA just in terms of the greater success that you could see, or give Activision Blizzard just in terms of the greater success to see in esports?
Yeah, super excited. Thanks for having me on board. Super excited about our partnership with IBM. They, as you mentioned, it's their first time into the esport business. And what we've got on store for the coming season for the Overwatch League, which is the league that they'll be a partner of ours on, is really going to be cool. It's going to be basically using their AI technology to sort of build interactive stats that learn as the game is being played. So imagine while you're watching our matches on YouTube, which is where you can exclusively see the Overwatch League,
our fans will be able to engage in a much deeper way with the action as it's happening. And IBM will be bringing that to the table using their tech to really imagine stats happening in real time and being able to predict what might be happening in the action in the upcoming piece. It's going to be, I think, mind-blowing for what we do in the industry. And we're super excited about partnering with them and their cloud technology to be able to do that.
Brandon, help me understand. I'm not a Luddite, but I am old. I mean, the idea of sitting and watching a digital game with these stats, look, the games are blockbuster, World of Warcraft. You can't deny with the green that these things earn. But to the people who play these games, what is the payoff for them that they're going to get this new AI delivered stats as they're playing these games and watching these competitions?
So look, the thing you have to think about is there's 200 million people that have played the game Call of Duty, right? And while I may be a little bit outside the current age group of the 25-year-olds that play it, I've played it in its lifetime. And what we've created is a competitive esport world, no different than what you might see in traditional sports, city-based local franchises, New York, Chicago, LA, Dallas, playing each other in a 5-on-5, a 4-on-4, a 6-on-6 match, no different than the way that you would watch the Lakers play the Celtics. The fandom that exists around these teams is the same fandom that you would have if you were going to a New York Knicks game, except that they're playing the game that they love, which is Call of Duty in this instance. And so we've tapped into that culture of local fandom tied into fans of the game and who have played this game, and we've brought that to life in competitive sports.
Brendan, how has COVID affected esports? Because on one hand, I guess you can argue it's good for streaming, but then of course, the live events and in-person gatherings clearly haven't been happening.
Yeah, it was, it changed a lot. You know, as you mentioned, COVID has been great to the gaming industry, right? There's been something like 7.5 billion hours of gaming content streamed and consumed over the last year. But our model, as you mentioned, has these local events in it, right? And this idea of two teams playing each other in a local market. And we had to pivot. We definitely had to pivot and go online. The benefit is our product is an online product. You played this game online, and it is a digitally centered and native product. And so while the rest of the sports world took a pretty significant pause in their live events, we were able to take about 2 weeks off. We shipped rigs to all of our players' houses and homes and apartments, and we were back online and running our games online. No different than perhaps how we were doing it in an event, other than we just didn't have an audience. We had the occasional cat or dog walking across the background while these guys were playing, but other than that, we were able to pull it off, and we got better and better as the year went. And culminated in a final that was fully online, that had the most views ever for our final match on YouTube, with over 340,000 concurrent views of our finals. So a lot happened, but we were able to make it happen and get back online pretty quickly.
What are the payoff purses for the competitors who are playing in these kinds of things? And I imagine that's only going to get bigger.
Yeah, we have a $5 million purse for our finals. And then we have different tournaments throughout the season that have different prize pools as well.
Brandon, what do you see just in terms of some of those industry trends as we head into 2021? Because I think going back to what we were just talking about with COVID, it's a very unstable marketing environment. I think it's introduced a lot of challenges here for a number of companies across a wide range of industries. But what are you seeing just in terms of esports?
So one of the things, I come from the world of traditional sports. And one of the things that I really value about what gaming and esports brings to the table is measurement. You're watching our product in a digital atmosphere, right? And if you're a marketer or an advertiser and you're a partner of a product like ours, it's a lot more measurable, the investment you're making, right? So as an example, when our partners are able to get into not only the traditional sports types of programs like IP rights or events, they also can be partners in our broadcast. We bring brands into the broadcast because we own and control the broadcast. So now you're able to deliver media value into the broadcast to a one-stop partnership rather than having to have a deal with a traditional broadcaster and then the IP rights holder and then perhaps the teams and the players. You do it all through us. And so that value exchange is quite high because now your media dollars are working more harder for you and they're more measurable because it's living in the digital space like YouTube.
All right, Brandon Snow, Senior Vice President and Chief Revenue Officer at Activision Blizzard Esports. Great to have you in the program. We wish you all the best. Thanks for taking the time.
Thanks for having me.
Coming up here, we're going to take one last look at how the market settled and also what we're focusing on as we turn our attention to tomorrow's opening bell. We're back with that in just 2 minutes.
And welcome back to Yahoo Finance Live. We're going to take a look at some of the things we've got our eyes on for tomorrow. And one of those is we get the initial claims for unemployment. We've seen them slowly ticking down, but with all of the discussion about the recovery and who is benefiting, who is not, these become really important because it gives us a sense of the trend and where we're headed. We're past the election. We've still got the election outcome to deal with. But the question is stimulus in Congress. There's going to be something, but a lot of people need it now. And that initial claim for unemployment number could assist in getting Congress, doesn't matter which party you belong to or what you believe in, get them off their tushes to get into gear to help some people. Shauna?
Adam, I'm going to be taking a look at existing home sales because this has been an area of the market, of the economy that has just really outperformed over the last several months. We were talking to Jeff Taylor earlier in the show, and he was basically saying that supply simply cannot keep up with demand. And that is what we're seeing play out in this market. So existing home sales jumped 9% last month. We'll see what that number is tomorrow. U.S. housing starts today, beating expectations. So housing in focus once again.
All right, Yahoo Finance has you covered starting at 9 a.m. So you have a wonderful evening. And join Julie Hyman and Miles Udland at 9 a.m. tomorrow.